next chapter that we are going to discuss is audit of different types of entities. I changed my plan. Now I want to discuss audit of different types of entities. As a part of it, we shall have a discussion on audit of cooperative societies, including audit of multi-state cooperative societies. This chapter is general in nature, and most importantly, if you have good knowledge of this chapter, it will help you a lot in understanding the concept of watching, which is included as a part of another chapter called as audit of items of financial statements. There is a chapter called as audit of items of financial statements. That chapter includes two modules or two topics. The first one is watching, the second one is verification. Watching and verification. In order to understand the concept of watching under the heading audit of items of financial statements, you must have a thorough knowledge about audit of different types of entities. In fact, the origin of this chapter, that is audit of items of financial statements, is from SA 500. You know very well about the content of SA 500. According to SA 500, as an auditor, you are required to obtain sufficient appropriate audit evidence. In order to obtain sufficient appropriate audit evidence, auditor is required to follow some audit procedures. The audit procedures to be followed by the auditor to obtain sufficient appropriate audit evidence were classified broadly into two categories. The first one is risk assessment procedures as per SA 315. The second one is further audit procedures. Such further audit procedures are divided again into two broad categories. The first one is tests of controls, otherwise called as compliance procedures, and the second one is substantive procedures. The first one is compliance procedures and the second one is substantive procedures. These substantive procedures were classified again into two broad categories. The first one is tests of details of transactions and tests of balances. Tests of details of transactions and tests of balances. The second one is substantive analytical procedures. What is meant by tests of balances? Balances generally appear in the balance sheet. Whether the balances appear in the balance sheet are correct or not is to be checked by you as an auditor, for which you need to follow a procedure called as verification of assets and liabilities. In other words, tests of balances can be carried out by the auditor through following a procedure called as verification of assets and liabilities. Then what about tests of details of transactions? If a transaction is to be tested by the auditor in detail, if a transaction is to be tested by the auditor in detail with the help of supporting documentary evidences, then it is nothing but technically called as watching. So watching and verification of assets and liabilities have been termed as tests of details of transactions and tests of balances in SA 500. In order to explain these two terms in detail, what are those two terms? The first one is watching, the second one is verification of assets and liabilities. A separate chapter has been included called as audit of items of financial statements. That is the base on which chapter called as audit of items of financial statements has been derived. So, in order to have an understanding of the term watching, it will be beneficial for you if you have a good understanding of audit of different types of entities. That is the link between this chapter and another chapter which is going to be discussed in near future is about audit of items of financial statements. Now, let's have a discussion on audit of different types of entities. Audit of different types of entities. Generally speaking, for any type of organization, revenue may be generated for any type of organization, revenue may be generated either through sales, sale of goods, or through providing services. These two are generally considered as the sources of revenue for any type of organization. I repeat, for any type of organization you take, the sources of revenue are generally two in number. They are, the first one is either through sale of goods, or the second one is through providing services. But there are some organizations in which case there may be several sources of revenue. Some organizations may have several sources of revenue. Such organizations are generally considered as non-profit oriented organizations. Those organizations having several sources of revenue are generally considered as non-profit oriented organizations. We are going to have a discussion about how to conduct audit of such non-profit oriented organizations, in which case there will be several sources of revenue. So, in this chapter, the main focus in this, I repeat, if you are unable to understand, I will repeat. Generally speaking, for any type of organization, sources of revenue are either of the following two, or in some cases, both may be treated as sources of revenue for a particular organization. You may generate revenue either through sale of goods, or you may generate revenue through providing services, or sometimes you may generate revenue through sale of goods as well as providing services. A supermarket is the best example of an organization which is generating its revenue through sale of goods. Masterminds is said to be the best example of an organization which is generating its revenue through providing services to the students. Some organizations may maintain hostels also. In such case, they may try to generate revenue not only through sale of goods but also through providing services. So what you need to understand from this is, for any type of organization, sources of revenue is one or a maximum of two. But for some types of organizations, the sources of revenue are very high in number. Usually, such organizations are termed as non-profit oriented organizations. We are going to have a discussion on how to conduct audit of such non-profit oriented organizations which may generate their revenue through different sources. And the first point that we are going to discuss about under this heading is audit of an educational institution. Audit of an educational institution. We can call it as audit of a school, audit of a college, audit of even a university. Audit of a school, or audit of a college, or audit of a university. Generally, non-profit oriented organizations may be constituted. Generally, non-profit oriented organizations may be constituted either as a trust, or as a society, or as a company limited by guarantee. They are technically called as Section 8 companies. I repeat, generally these types of non-profit oriented organizations may be constituted either as a trust under Indian Trust Act, or as a society under Societies Registration Act, or sometimes they may even be established or constituted as a company limited by guarantee. We call them as Section 8 companies. Why should we focus on the constitution? Because if the entity, non-profit oriented entity under your audit has been established as a trust, the basic document evidencing the constitution of the organization would be available in the form of trust deed. I repeat, the basic document with regard to constitution is available in the form of trust deed. In case where the entity under your audit has been established or constituted as a society, then rules, regulations and bylaws are available in respect of such a society. And in case where the organization has been constituted as a company limited by guarantee, the basic documents relating to constitution of the organization are available in the form of memorandum of association and articles of association. Why I am dealing with all these things? Supposing that you have been appointed as the auditor of an educational institution. Before starting the actual process of audit, what you need to do is you are required to go through basic documents concerning the constitution of the entity. Assume that this educational institution has been established as a trust. In such case, before commencement of your audit, it is necessary for you to go through the trust deed. So where the entity under your audit has been established as a trust, you are required to go through trust deed. You are required to go through trust deed. Where the entity under your audit has been established as a society, usually educational institutions will be established as a society. Charitable organizations will be established as a trust. Clubs are generally established as a company limited by guarantee or Section 8 companies. So, when the entity under your audit has been established as a trust, it is necessary for you as an auditor to go through the trust deed before commencement of the audit of that organization. Similarly, if the entity under your audit has been established as a society, then it is your responsibility as an auditor to go through the rules, regulations and bylaws of the society before commencement of audit. The last one is well known to you. If the entity under audit has been established as a company limited by guarantee, before starting the actual process of audit, you are expected to go through the articles of association or memorandum of association. This is in fact known to you. For example, if you have been established as an auditor of a partnership firm, what will you do? Before commencement of audit, you need to go through partnership deed. Why the auditor is expected to go through the partnership deed before commencement of audit of a partnership firm? There are several provisions in the partnership deed which will have a direct effect or direct impact on the entity's accounts and thereby will have a direct impact on the entity's financial statements. Can you please list down some of the provisions of the partnership deed which will have a direct impact or effect on the entity's accounts and thereby will have a direct impact on the entity's financial statements? The capital contribution, profit sharing ratio, interest on capital, drawings, interest on drawings, who is authorized or who is made responsible to operate bank accounts. These are all the points that will have a direct impact on the accounts of the partnership firm. Without having knowledge of such things, you cannot commence your audit. Even if you commence your audit, the audit carried out by you cannot be said to be qualitative. So to ensure that your audit is qualitative, thereby to ensure that the report given by you is appropriate, I repeat, to ensure that the audit carried out by you is qualitative and thereby to ensure that your report is appropriate. Do you know what is audit risk? What is audit risk? Audit risk can be defined as risk arising to the auditor in a situation where the auditor expresses an inappropriate audit opinion when the financial statements are materially misstated. When the financial statements are materially misstated, what type of opinion do you express as an auditor? A modified opinion is required to be given by the auditor when the financial statements are materially misstated. In cases where it is necessary for the auditor to issue a modified opinion, but if the auditor had given an unmodified opinion, then issuing a modified opinion is said to be appropriate. Unfortunately, you have given an unmodified opinion. That means the opinion given by you is wrong. The opinion given by you is inappropriate. When the opinion given by the auditor is inappropriate, there will arise a risk to the auditor. That risk is technically called as audit risk. I know very well that most of you people do not know what is audit risk. And even if you know the definition of audit risk, you do not know why audit risk arises. let us assume I am the auditor of an entity. I have given a wrong report or inappropriate report. She is one of the shareholders of the company for which I conducted audit. She relied on the report given by the auditor. By relying on the report given by the auditor, shareholder made some decisions. The shareholder made some decisions. Since the opinion given by the auditor becomes wrong, the information in the financial statements is also wrong. She made use of wrong information for taking some informed decisions, and finally decisions taken by the shareholder based on auditor's report would go wrong. In that case, shareholder may suffer with some loss. Let us assume that shareholders suffered with a huge financial loss because the shareholders depended on the opinion given by the auditor, and unfortunately the opinion given by the auditor is a wrong opinion or inappropriate opinion. Decision taken by the shareholder becomes wrong. Shareholder suffered with a loss, and hence shareholder has gone to court of law against the auditor, stating that I made use of auditor's report for taking these decisions. Since auditor's report is inappropriate, decisions taken by me were also inappropriate. Hence, I suffered with a loss. This is because of the wrong opinion given by the auditor. Therefore, the auditor should indemnify my loss. This is the allegation made by the shareholder on the auditor before court of law. And court of law also observed that auditor is very much negligent in performing his duties. That is the reason why the auditor has given a wrong or inappropriate report, and hence shareholder had suffered with a loss because of such wrong or inappropriate report. Therefore, court ordered the auditor to indemnify loss to the shareholder worth rupees 1 crore. Now, as an auditor, you need to pay an amount of 1 crore to the concerned shareholder. In that audit, you get a remuneration of just 5,000 rupees. The remuneration that the auditor received from the company for conducting audit is 5,000, but the amount of penalty paid by the auditor to indemnify the loss to the shareholder is 1 crore rupees. If you were the auditor, will you treat it as a risk to you or not? Yes or no? Why this risk arises to the auditor? Because the auditor has given a wrong report or inappropriate report. So if you give any wrong or inappropriate report, there will arise a risk to the auditor. That risk is technically called as audit risk. Always, as an auditor, we will try to reduce our audit risk. So if you want to reduce your audit risk, the reports given by you should be appropriate. If you want your report to be appropriate, you should have to carry out your audit with effectiveness. If you carry out your audit with effectiveness, the report given by you would become appropriate. When the report given by the auditor is appropriate, risk to the auditor will get reduced. How the auditor can carry out an effective audit without knowing the provisions that will have a direct bearing or impact on the accounts of the entity? How it is possible for the auditor to express an appropriate opinion? So in order to express an appropriate opinion, what the auditor should focus on? The auditor should focus on basic documents relating to the constitution of the entity. The auditor is expected to go through such documents before commencement of audit, and particular attention should be paid by the auditor in respect of those provisions which will have a direct bearing or impact on the entity's accounts. That is the basic reason why it is said that before commencement of audit, it is necessary for you as an auditor to go through trust deed, or to go through rules, regulations, bylaws, or to go through articles of association or memorandum of association respectively, in order to have an understanding of provisions which will have a direct bearing or direct impact on the entity's accounts, thereby a direct impact on the entity's financial statements. This is point number 1. Point number 2 is, in every case, you can say like this: the auditor need to evaluate internal control systems before commencement of audit. Evaluation of internal controls is a mandatory requirement on the part of the auditor, whether the auditor is carrying out audit of a profit-oriented entity or even a non-profit-oriented entity. Fraud is everywhere. Fraud may take place either in a profit-oriented organization or even in a non-profit-oriented organization. So both the types of organizations are made responsible to prevent as well as to detect frauds and errors. For that purpose, every organization, whether it be dash or it be dash, whether it be a profit-oriented organization or it be a non-profit-oriented organization, is expected to establish internal controls. And hence, it is our responsibility as an auditor to evaluate such internal controls before commencement of audit. These two are said to be the preliminary points. These two are said to be the preliminary points that the auditor should follow before commencing the audit of a non-profit oriented organization, whether it be an audit of educational institution, audit of a hospital, audit of a charitable organization, whatever be the type of audit under this heading, it is necessary for you as an auditor to go through basic documents concerning the constitution of the entity. If possible, you need to evaluate internal control systems as well. Now, my suggestion to you is, as a student, you should be able, to visualize different sources. As a student, you should be able to visualize different sources from which these types of organizations may generate revenue, and you should have some knowledge about the major heads of expenditure incurred by such type of organizations. Are you able to follow me? Whenever you are carrying out audit of non-profit oriented organizations, you are expected to visualize the sources from where the entity may generate revenue, and you are also expected to visualize the heads of expenditure. Once you are able to visualize sources of revenue and heads of expenditure, and once you elaborate them, specifying the way in which those sources and expenditure are required to be audited, it is nothing but said to be a audit of different types of organizations. It is nothing but said to be audit of different types of organizations. In other words, two things are required to be done by you as an auditor under the heading audit of different types of entities. The first one is, auditor should be able to visualize different sources of revenue. Auditor should also be able to visualize major heads of expenditure. Once the auditor visualizes sources of revenue and heads of expenditure, then the auditor had to carry out audit on such sources of revenue and heads of expenditure. And if you write down how sources of revenue are to be audited and how heads of expenditure are required to be audited, it is nothing but technically called as audit of different types of entities. So, in this case, in this heading, under this heading, first of all, your duty is to visualize different sources of revenue. Now I will try to explain you how to visualize different sources of revenue. Later, I will try to explain you about how to visualize different heads of expenditure. Once you learn about how to visualize sources and how to visualize expenditure, then I will try to focus on how to conduct audit of such sources and how to conduct audit of such expenditure. This is the way in which you need to learn this chapter. If you try to by heart the chapter, and if a new question is asked from this chapter, you would not be in a position to provide an answer for that question. So if you really want to answer a question from audit of different types of entities, you must develop the art of visualizing different sources as well as different heads of expenditure. So first of all, I will try to explain you the way in which sources of revenue are required to be visualized, then the way in which heads of expenditure are required to be visualized. Let us first focus on the sources of revenue. What are the sources of revenue for an educational institution? You can certainly visualize some sources of revenue for an educational institution. If you are unable to visualize such sources, I will tell you a small story. If you are able to understand the story, you will be able to visualize different sources of an educational institution. Let us assume that the educational institution is a government college or a government school. When the educational institution is a government college or government school, they do derive some revenue from government in the form of government grants. You know very well about what is a government grant. You had knowledge of AS 12, which deals exclusively with the concept of government grants, which specifies that grant may be provided by the government either in the form of subsidy or in the form of duty drawback or even in the form of cash incentive. So where the educational institution under your audit is a government school or a government college, they do get revenue, they do derive revenue from government grants. And sometimes the educational institution may even receive donations. This is particularly applicable to say government schools. The old students of the government schools may donate some amounts for the development of the school. So the school or college may get donations from their old students. So government grants is said to be the first source of receipt of revenue for an educational institution. The second source may be said to be donations. And the third one is easily understandable to you, tuition fees. Tuition fees is said to be the major source of revenue for any type of educational institution. Under the heading tuition fees, I am going to discuss with you three important aspects. These things may have been given in a scattered way in your material. I don't want to refer to your material. Everything that is there in the CA Institute material is going to be discussed with you. There may be more number of points that I am going to discuss than what is there in our material. Keep your material aside and try to listen to my discussion only. Once I complete the chapter called as audit of different types of entities, you will get confidence that you will be able to write down the answer for any given question even without any preparation at all. So that is the confidence that I am going to give to you. Just listen to me, trust me. I will tell you how to visualize the sources, how to visualize heads of expenditure, how to conduct audit of such sources and expenditure along with some general tips so that you will get more knowledge about conducting audit of different types of entities. Under the heading tuition fees, I will try to focus on three things. The first one is admission fees. The second one is fees collections. The first one is admission fees. The second one is tuition fees. The third one is caution deposit. These three things are going to be discussed under the heading fees collections along with some other points. So I started visualizing different sources of revenue for an educational institution. That educational institution may be either a school or a college or a university. The first source of revenue is government grants. The second one is donations. The third one is fees collections. Such fees collections of an educational institution can be classified again broadly into three categories. The first one is admission fees. The second one is tuition fees. The third one is caution deposit. And apart from this, sometimes a hostel may be attached along with the college. Particularly for intermediate colleges, hostel will also be attached. Even for CA inter students, a hostel has been attached. Therefore, they will generate some revenue through hostel. They are technically called as hostel receipts. Sometimes an educational institution may even maintain a bookshop from which the students are expected to purchase books. So the educational institution may generate some revenue through sale of books. The best example is Masterminds only. You may get material at free of cost, but I don't know. I don't want to make a comment on that also. Of course, it is good for you to understand this in a better way. So you are not getting your books freely. You are making some payment. That means you are purchasing books from the institute. That means institute is generating some revenue through sale of books. So sale of books is said to be another source. Sale of books is said to be another source from which the organization may generate revenue. Fortunately, there is no canteen in our college. If there is a canteen, no. In that canteen, you can use the services at free of cost. But there are some colleges wherein there will be canteen from which you can purchase you can purchase. So an educational institution may even have a canteen. An educational institution may even have a canteen. And sometimes the educational institution may derive some rent. Educational institution may derive some rent. That rent may be derived by the educational institution through hiring their ground or through hiring their premises for marriage, other religious ceremonies, etc. So rent is said to be another source of income for an educational institution. Similarly, educational institution may collect some fines from the students. The educational institution may collect some fines from the students. Fine is said to be another source of revenue for the educational institution. Because there are more number of students in the educational institution, they are generating a lot of revenue, and the revenue so generated by them is being invested by them in different types of investments, and hence they do derive some income from investments. And because the educational institution is having furniture, sometimes it is possible that the educational institution may sell its old furniture and other equipment. Thereby, they may generate some revenue. I am saying it not as income, but as revenue. Sometimes the revenue so generated may be an income to the educational institution. Sometimes the revenue generated is only a source of receipt for the educational institution. These are all said to be the sources of revenue for an educational institution. In order to remember all these sources, I will tell you a small story. Please try to understand it, try to remember it, so that it will be easier for you to remember all these sources. Let us assume that just now you have joined an intermediate college. You have joined in an intermediate college along with the hostel facility. You are utilizing the hostel facility also. Immediately on joining the college, you paid some fees to the college. So fees collection is said to be the best way of generating revenue by a college or any other educational institution. Today is the first day of your classes. You started from your hostel. So hostel is another source from which college will generate revenue. And because this is the first day of your classes, you have to attend the classes at least with one book in your hand. So you purchased a book from the shop being organized or run by your educational institution. That means educational institution started getting revenue through sale of books. And in the middle of your way, a canteen appears. That canteen is being run by the educational institution. You have some breakfast in the canteen. Then while going to the college, you found the ground of the college. In that ground, somebody is playing cricket. They are not the students of the entity. Ground has been given on rent by the organization to others for the sake of conducting tournaments, etc., which is being called by us as ground rent. And immediately on entering the premises of the organization or entity, the college, you observed that some portion of the college has been let out for conducting marriages or other religious ceremonies. Because you attended the class late, you have been penalized. Some penalty has been collected from you. Because the educational institution is even collecting penalties from the student, it is getting lot of income. The income so generated by the entity is being invested in several investments, and hence they started getting income from investment also. Similar to that, they are getting income through our revenue through sale of old assets like furniture, etc. If the educational institution is a government institution, they do derive some revenue either in the form of government grants or in the form of donations. This is the way in which you need to remember the sources of revenue for an educational institution. Whether it be a college or it be a university or it be a school, whatever be the type, all are technically called as educational institutions. This is a generalized view about the sources of receipt for an educational institution. Similar to this, I will try to explain you the way in which we need to visualize sources of revenue for a hospital. How do you visualize sources of revenue for a hospital? Let us assume that there is a hospital. There is a hospital. A person visited the hospital as an outpatient. A person visited the hospital as an outpatient. Doctor suggested the outpatient to have some scan. Hence, the patient utilized services like X-ray or laboratory facilities that are available in the hospital itself. Later on, the doctor suggested the patient that an operation is required to be carried on the patient. Because of that, the patient joined as an inpatient in the hospital. Later on, some operation has been performed, some procedure has been performed on the patient by the hospital. Because patients are there, obviously there will be pharmacy or medical shop in the hospital. Through sale of medicines also, hospital would be able to generate some income. Apart from that, hospital is also having a canteen. The services of the canteen may be utilized either by the patient himself or by persons who visit the hospital for the purpose of the patient may try to utilize the canteen facilities. Because the hospital is having several patients, it is generating lot of revenue, and such revenue is being invested by the hospital, and hence they are getting some income on investment. And hospital is selling the old surgical equipment. Several operations have been performed by the hospital on patients, although it is not required, and hence the hospital sold old surgical equipment through which it may be able to generate some income. If the hospital is a government hospital, if the hospital is a government hospital, it may generate revenue from government grants or in the form of donations. Now you can easily list out the various sources from which a hospital can generate income. Can you repeat all the sources of a hospital? The first one is government grants. The second one is donations. The third one is receipts from outpatients. The fourth one is labor X-ray theatre facilities. The fifth one is receipts from inpatients. The sixth one is operation theatre receipts. The seventh one is pharmacy. The eighth one is canteen. The ninth one is income from investment. And the 10th one is sale of old surgical equipment. These are all said to be the sources of income for a hospital. Like this, you should be able to visualize the major sources of income or revenue for a particular type of organization under audit. When you are able to visualize, you will be able to elaborate it. When you elaborate it, it is nothing but an audit. So audit of different types of entities should have to be written in your examination only in this way. So till now we had a discussion about 2 points, 2 types of organizations. The first one is audit of an educational institution. The second one is audit of a hospital. Now let us assume that you have been appointed as the auditor of a temple. This point is not included in the CA final syllabus and hence CA enter syllabus, and hence this point was not there in the CA institute material. But unfortunately in the examination you were asked to write down about how to conduct audit of a temple. It is not there in our material. In that case, what will you do? You cannot simply say that audit of temple is not in our material, so we cannot write anything about audit of a temple. First of all, you should be able to visualize different sources. Then you should be able to visualize different heads of expenditure. Once you are able to visualize the sources and heads of expenditure, it will be easier for you to write something about any type of audit under the heading audit of education, audit of different types of entities. Now I am asking you about what are the sources you need to visualize, what are the sources from which a temple may generate income. What are the sources from which a temple may generate revenue? Usually temples do get some grants, government grants from the endowment department. If the temple is operating under endowment department, they do get some grants from the respective state government. Therefore, government grants is said to be a major source of income for a temple. The second one is, as you said, temples do receive different types of donations from different persons or general public. So government grants and donations are said to be major sources of revenue for a temple. Apart from that, temple may be able to generate sources of income in the following way. One, sale of darshan tickets. Sale of darshan tickets is the way through which a temple may generate some form of revenue. Toll gate receipt, by charging some amount in the toll gate, that is nothing but parking fees, temple may be able to generate some revenue. Another major head of receipt for a temple is hundi collections. Yes or no? Hundi collections is said to be another major source of revenue for a temple. The next one is sale of prasadams is said to be another major source of income for a temple. And the next one may be, say, income from investments. Temples do have investments and they do derive some income from investment. The next one is sale of old assets. Temples do have old assets. They will sell the old assets. Thereby they will generate some revenue. It may be either receipt or income through sale of old assets. These are all said to be the major. Sometimes there may be a shopping complex in the temple and that may be leased out by the temple authorities to outsiders for establishing different types of shops related to the temple. Thereby they will generate some income or receipt in the form of rent. These are all said to be the major sources of revenue for a temple. Like this, a student should be capable of visualizing different sources from which the entity under the audit is able to generate revenue, income or receipt. Then only you can write down something about all those things. Similarly, how a recreation club generate revenue? How a charitable institution generates revenue? How a cinema theater generates revenue? These are all the things that we are going to discuss elaboratively in the chapter called as Audit of different types of entities. Now, if you have keenly followed all these things, you would have observed, if you keenly followed all these things, you would have observed that there are some common sources. There are some common sources in all the 3 points that we discussed. Have you observed any common points in all these 3 sources? What are the common points? Government grant is a common point. Donations is a common point. Similarly, canteen. In most of the cases, there will be a canteen. A hospital may have a canteen. An educational institution may have canteen. A cinema theater may have canteen. Like this, canteen is a club may have a canteen. Like this, canteen is another general point of revenue. The last 2 points are most important. Income from investment. Every organization may have investment and such organizations having investment may generate income. That income from investment is said to be another general source of revenue. And the next one, sale of old furniture is also said to be a major source of revenue for any type of organization. By this, what you need to understand is there is no need for you to prepare separately for this chapter. Once you are able to visualize receipts or sources of revenue, the common sources that we identified till now are 5 in number. The first one is government grants. The second one is donations. The third one is income from investment. The fourth one is receipts through sale of old assets. And the fifth one is say canteen. These 5 are said to be major sources of revenue which are common for every type of organization. Not for clubs or not for cinema theaters. You cannot write government grant and donation points for clubs and cinema theaters, because government will not give any grants either to a cinema theater or to a recreation club. Similar to that, nobody will donate anything either to a cinema theater or to a recreation club. Barring those two things, in all the cases you can write government grants and donations as a source. Similarly, these last two points can be written for any type of audit, that is sale of old assets and receipts through canteen. Now I will try to explain you in detail about how to conduct audit of government grants, how to conduct audit of donations, similarly how to conduct audit in respect of sale of old assets and income from investment. Let's first have a discussion about how to conduct audit of a government grant, or what aspects do you watch in respect of receipt of government grant. These points are general in nature, so everywhere you can write the same points under the heading government grants. So where the entity under your audit is in receipt of some government grants, such government grants are required to be checked by you as an auditor in the following way. Point number 1, the auditor is expected to watch the receipt of government grant. The auditor is expected to watch the receipt of government grant into cash book with the help of supporting documentary evidences. I repeat, government grant may appear at more than one place where the entity under your audit is generating some revenue through government grants. It is our responsibility as an auditor to verify such government grant. The following are the points that are required to be checked by you as an auditor under the heading government grants. The first one is, the auditor should watch the receipt of government grant into cash book with the help of supporting documentary evidences. The question is, what documentary evidences are available to the auditor in respect of receipt of government grant? Generally, when government is giving any grant to any entity, government used to write a letter called as grant letter. Sometimes it is also called as grant memo. Grant letter or grant memo. I repeat, when government is giving some grant to any organization, government is expected to write a letter to that organization. That letter written by the government to the organization which is in receipt of grant from the government is technically called as grant letter. Sometimes we do call it as grant memo. In that letter, government will clearly specify the purpose. In that letter, the government will specify the purpose for which the entity is required to use the proceeds of such a grant. So in the grant letter itself, government will specify the purpose or purposes for which the proceeds of the grant are required to be utilized. Along with the grant letter, government will attach a check for the amount of the grant. This is practical in nature. If you are able to follow these things, there is no need for you to visualize any supporting documentary evidences. You will be able to write down 3 to 4 points under the heading supporting documentary evidences. So when the organization under your audit received any grant from the government, government will provide them with a letter called as grant letter. Along with the letter, the government will also provide a check for the amount of the grant. After receipt of this grant letter along with the check, what the organization do is, the grant letter will be separated from the check. The grant letter so separated will be filed in general communication or correspondence file. And this check received from the government will be deposited into bank account. Usually, government will not ask you for any cash receipt. Sometimes there is a possibility that government may insist the organization to provide a cash receipt for the grant received by the entity. In that case, the entity is under obligation to provide a cash receipt to the government. So cash receipt, if any issued, cash receipt, if any issued by the entity to the government, is said to be another supporting documentary evidence. I repeat, the first documentary evidence is available in the form of grant letter, otherwise called as grant memo. The second documentary evidence may be available to the auditor in the form of cash receipts issued. This cash receipts issued were termed as counterfiles of receipts in our CA Institute's material. Counterfiles of receipts. They both mean one and the same. Cash receipt issued by the entity or counterfiles of receipts. They both mean one and the same. You know very well that every organization is required to maintain every important document in duplicate. You know very well that every organization had to maintain every important document in duplicate. Cash receipt is also an important document. So cash receipts are required to be maintained by the entity in duplicate. There are two ways through which an entity may maintain cash receipts. The first way is carbon copy, otherwise called as duplicate. The second way is called as counterfile. What is the difference between counterfile and carbon copy? There is a lot of difference. When the entity is following the system of maintaining carbon copy for a duplicate, then there will be a cash receipt. Below that, there will be another cash receipt. The first one is technically called as original cash receipt. The second one is technically called as duplicate cash receipt. So two cash receipts will be there containing the same number. For example, the serial number of this cash receipt is say 151. On the duplicate also, serial number 151 will appear. This is original, this is duplicate. When the organization is required to issue a cash receipt, in between original and duplicate, they do insert a carbon paper. By inserting carbon paper, original will be prepared, and the original so prepared will be teared off and given to the party making the payment. Since you had inserted a carbon paper in between original and duplicate, the impression of original will be there on the duplicate. This duplicate is being called by us either as duplicate or as carbon copy. This duplicate is being called by us as carbon copy. This is one way through which cash receipts may be maintained by an organization. There is another way called as counterfile. This counterfile type of system of issue of cash receipts is easy to understand. In that case, organization is not required to maintain original and duplicate. Instead, the entire cash receipt will appear like this. This is just like a bank pay-in slip that you find in a bank. In a bank, you may find some bank pay-in slips. Similar to that bank pay-in slip, organizations do maintain cash receipts. This is the pro forma of a cash receipt which look like a bank pay-in slip. This is the left side portion. This is the right side portion. This is cash receipt. This is also a cash receipt. When a cash receipt is issued, details will be recorded by the organization on both the parts of the cash receipt. Here, the organization is not inserting any carbon paper. Details are written both on the left side part of the cash receipt and the right side part of the cash receipt. Once cash receipt is prepared, the organization will tear off the right side portion of the cash receipt and it will be issued to the person who is making the payment. Whereas the left side portion of the cash receipt will be retained by the organization for its record purpose. That left side portion is technically called as counterfile. Here we are not calling it as a duplicate, or here we are not calling it as a carbon copy, because we haven't used carbon paper for preparation of cash receipt. These two are the ways through which generally organizations do maintain cash receipts. Most of the organizations do follow approach number 1, The first one is original, the other one is duplicate, but some organizations do follow even alternative number 2. In that case, the slip with us is technically called as dash. Counter file of cash receipt or counter file of receipt. That is all about the meaning of the term counter file of receipt. Without knowing what is counter file of receipt, how can I explain you that this is the way in which you need to watch the entry into cash book? First of all, you should have knowledge about what is carbon copy and what is counter file. That is the reason why I explained you both ways of maintaining a cash receipt. Coming to the original point, the entity under your audit may be in receipt of government grant. When the government is giving grant to any entity, it usually government will write a letter to the entity. That letter written by the government to the entity is called as a grant letter. We call it as grant memo also. In the grant letter itself, government will specify the purpose or purposes for which that grant amount is required to be utilized by the company, by the entity, and along with the grant letter, government will provide a check to the entity. After receipt of that grant letter and check, the organization will separate them. The grant letter will be filed in a file called as general communication file, and sometimes immediately after giving grant, government may ask the entity to provide a cash receipt. In that case, the organization will issue a cash receipt to the government. One copy original will be issued to the government. Carbon copy may be retained by the organization, or second way, if second way is followed, then the organization will have dash in their hands. Counter file of receipts is another documentary evidence. Since you have received a check from the government as a government grant, what the organization is expected to do? The organization is required to deposit this check with their bankers. When the organization deposits the check with their bankers, then some counter file of check deposited, counter file of check deposited, counter file of check deposited will be provided by the banker to you. When you deposit a check or cash into bank, you know very well that, like I said earlier, this is the way in which a bank paying slip appear. The left side portion of the bank paying slip will be stamped, and the banker will put his signature on the stamp. It will be teared off and given to you. That left side portion of the bank paying slip is technically called as dash. Counter file of check deposit or cash deposit issued by the bank. Later on, the banker will send the check for collection, and the banker will get the amount. Your account gets credited. So credit entries in the bank passbook or bank statement may be said to be another supporting documentary evidence. By this, what you need to understand is like this, where the entity under your audit is in receipt. The entity under your audit is in receipt of government grant. Is in receipt of government grant. The very first point to be checked by you as an auditor is you need to watch the receipt of government grant into cash book with the help of supporting documentary evidences. The supporting documentary evidences in respect of government grant are available in the form of grant letter. The second one is counter files of cash receipts. The third one is counter files issued by the banker. The fourth one is credit entries in the bank passbook or bank statement. These are all called as supporting documentary evidences, but in our institute's material, it was not given like this. Instead, the institute material says that the auditor should watch the receipt of government grant into cash book with the relevant papers. With the relevant papers. What is relevant paper has not been explained either in your CA material or in your masterminds material. Without understanding that, how can you carry out watching of government grant? That is the reason why I explained you all the documentary evidences that are available for the auditor for the purpose of watching of a government grant. Can you please list down what are the documentary evidences that are available to the auditor in respect of audit of government grants without going through what is appearing in the screen? The first one is grant letter. The second one is counterfiles of cash receipts issued by the organization. The third one is counterfiles of bank issued by the banker. The fourth one is credit entries in the bank passbook or bank statement. With all these supporting documentary evidences, you need to verify or watch entry recorded in the cash book. Why the auditor is watching the entry recorded in the cash book with all these supporting documentary evidences? Because even in case of these organizations, there is every possibility that although the government grant has not been received, they may either recorded a fraudulent entry or recorded a fictitious entry. So in order to check whether entries recorded are genuine or are fraudulent or real or are fictitious, it is necessary for us as an auditor to watch the receipt of government grant into cash book with the help of all these supporting documentary evidences. And I said to you earlier that in the grant letter itself, government will specify the purpose for which the grant amount is required to be used. Generally, for the sake of accounting, grants given by the government can be classified broadly into two categories. The first one is general grant. The second one is specific grant. This is subject to what you learned under AS 12. The first one is general grant and the second one is specific grant. What is general grant and what is specific grant? If the grant is given by the government for a specific purpose, it should be called as a specific grant. For example, government may have given you a grant of 1 crore rupees. In the grant letter itself, government specified that the amount of 1 crore shall have to be utilized by the organization only for the purpose of construction of a building. You cannot make use of that amount of 1 crore for any other purpose other than for construction of a building. So this amount is made or given specifically for this purpose, and hence it is technically called as dash specific grant. Sometimes the purpose for which the grant amount is to be utilized will not be provided by the government. In that case, it will be treated as a general grant. You can make use of a general grant in the way you like in order to achieve your stated objectives. In order to achieve the objectives of your organization, you can make use of the general grant in the way you like. There is no specific way of utilizing the proceeds of the general grant. That is the basic difference between the terms general grant and specific grant. Now, accounting of the grant is dependent upon the type of the grant. The accounting of the grant is dependent upon the type of the grant. For example, if you have received a specific grant, the amount of grant so received shall not be recognized by you as income. It should be treated by you as a liability. The balance sheet of the organization which receives a government grant will appear like this. I am preparing the balance sheet in a traditional T format, ignoring the format mentioned in the Companies Act because this is not a company. Just now the organization received a government grant, a specific grant of an amount of 1 crore only for the purpose of construction of a building. Then how they disclose this amount of 1 crore in their balance sheet? On the liability side of the balance sheet, they need to write like this: building fund. What is that? Building fund, 1 crore rupees. So 1 crore rupees is not being treated as income. It is not being credited to income and expenditure account. It is being reflected in the balance sheet as building fund. And this amount will be there in bank, cash at bank, 1 crore. This is the initial recognition of the transaction in the balance sheet. Later on, you may withdraw this amount of 1 crore for the purpose of construction. Then 1 crore will become cash in hand. Later on, this amount of 1 crore may be utilized by you for the purpose of construction of a building. Then cash in hand will get converted into building. Initially, the amount is in the form of cash at bank. Later on, it gets converted into cash in hand. Later on, it gets converted into building. Now, against the building, an amount of 1 crore will be recorded. And these two things will always appear permanently in our balance sheet. On the liability side, building fund worth rupees 1 crore, and on the asset side, building worth rupees 1 crore. This is the way in which you need to account for a grant which is received for a specific purpose. And you need not record all these things, write all these things in the examination. You can simply write like this. The auditor should also verify whether the amount of grants so received has been properly accounted for. Only this terminology has been used in our CA material also. But how to account it properly should be known to you. That is the reason why I am explaining all these things. You are not required to write all these things in the examination. Instead, simply say that the auditor should watch government grant with supporting documentary evidences. The auditor should also verify whether grant amount so received has been properly accounted for. Then general grant, if any received, will be treated as income of the organization. This is all about grants. So 2 points are required to be checked by you as an auditor under the heading government grants. As and when you want to write something about government grant, you need to reproduce these 2 points. What are the 2 points that you should write under the heading government grants? Point number 1, the auditor should watch the receipt of government grant into cash book with the help of supporting documentary evidences or relevant papers like grant letter, counter files of receipts issued, counter files given by the bank, credit entries in the bank passbook or bank statement. That is point number 1. Point number 2, the auditor should also verify and satisfy that the government grant so received has been properly accounted for. For the purpose of accounting of government grants can be classified broadly into 2 categories. The first one is general grant. The second one is specific grant. Specific grant is required to be recognized as a liability, whereas general grant can be treated as income of the organization. As I said earlier, there is no need for you to write all these things elaboratively. Instead, you can say that auditor should check whether government grant so received has been properly accounted for or not. This is all about government grant. The second one is donations. How do you conduct audit of donations? If you are able to understand grants, it will be easier for you to understand the duties of the auditor under the heading donations. Duty number 1, the auditor should watch the receipt of donation into cash book with the help of supporting documentary evidences. If you keenly observe, you could have identified that point number 1 under the heading grants and point number 1 under the heading donations is one and the same. Under the heading grant, you need to watch the grant amount. Under the heading donation, you need to watch the donation amount into cash book with the help of supporting documentary evidences. Now the question is, what documentary evidences are available to the auditor in respect of receipt of donation? Point number 1, donation letter. Under the heading grants, I said to you that documentary evidence is available in the form of grant letter. Under the heading donations, it is available in the form of the donor will write a letter to you specifying the way in which donation amount is required to be utilized by you. That is called as donation letter. Then the organization will issue cash receipt for that. We are calling it as a counter file of receipts. Counter file of receipts. If the donor has given a check, then the previous 2 points can also be written even under the heading donation. What are the previous other 2 points? When the donor has given a check, counter files issued by bank and credit entries in the bank passbook or bank statement are said to be other documentary evidences when donation is received not in cash but through check. So what are the documentary evidences available to the auditor in respect of receipt of donation? The first one is donation letter. The second one is counter files of receipts. The third one is counter files issued by the banker when you deposit check into bank. And the fourth one is credit entries in the bank passbook or bank statement. Credit entries in the bank. When check is collected, your bank account gets credited. That is another supporting documentary evidence. Credit entries in the bank passbook or bank statement. With all these documentary evidences, you are expected to watch the receipt of donation into cash book to ascertain whether the entry recorded is genuine or is fraudulent. is real or is fictitious. This is point number A under the heading donations. The auditor should watch receipt of donation into cash book with the help of supporting documentary evidences. Point number B is like this. The auditor should also verify whether the amount of donations so received have been properly accounted for. Now you may have identified that the points that are appearing under government grants and appearing under donations are almost similar to one another. Under the heading government grant, we check 2 points. The first one is watching. The second one is verifying whether the same is properly accounted for or not. Similar to that, under the heading donations also you find 2 points. Point number 1, watch, and point number 2, whether the donation amount is properly accounted for or not. And for the purpose of donations, donations received by the entity can be classified broadly into 3 categories. In case of grants, I divided grants into only 2 categories. The first one is general grant, the second one is specific grant. Whereas in respect of donations, donations may be categorized into 3. The first one is general donations, the second one is specific donations, and the third one is donations directed towards corpus. They are called in our CA Institute material as endowments. They are called in our CA Institute's material as endowments. Generally, they will be called as donations directed towards corpus. So, types of donations are 3 in number. The first one is general donation. The second one is specific donation. And the third one is donation directed towards corpus, which is being called by CA Institute as endowments. They both mean one and the same. I will try to provide you an example to have an understanding of the term donations directed towards corpus, including its accounting treatment. General donations are exactly comparable with general grants for the sake of accounting. Specific donations are exactly comparable with specific grants for the sake of accounting. In other words, whether it be a general donation or it be a general grant, it will be recognized as income. Whether it be a specific donation or a specific grant, it should be recognized as a liability. So the accounting treatment of general grants and general donations, specific grants and specific donations is one and the same. Then what about corpus, which is being called in our material as endowments? There are some organizations which accept donations, and the donations so accepted by them will be treated by them as corpus. The best example is free meals scheme offered by Tirumala Tirupati Devasthanam. Free meals scheme organized by TTD, Tirumala Tirupati Devasthanam. Every day they serve almost 60,000 to 80,000 pilgrims. Free meals in the morning session breakfast, in the afternoon session lunch, and in the evening session dinner. Everything will be provided to the devotees at free of cost. For that purpose, they need funds. Usually, they use hundi collections for the purpose of maintaining this scheme called as free meals scheme. Apart from this, TTD will accept donations from general public. If you want to make some donation in respect of free meals scheme, you can donate the amount to TTD. Let us assume that you have donated an amount of 1 lakh rupees for the specific purpose of organizing a specific scheme called as free meals scheme. You are not giving this donation for any other purpose, but only for the purpose of organizing a scheme called as free meals scheme. You donated an amount of 1 lakh. Now what TTD will do with this amount of 1 lakh? The amounts so received by the organization from the pilgrims will not be used for the purpose of administering the scheme. Instead, this entire amount of 1 lakh will be deposited in a bank in the form of fixed deposit. They will never withdraw that fixed deposit with the bank. That entire amount of 1 lakh will be deposited into bank in the form of a fixed deposit, because this amount of 1 lakh is being treated by them not as income but as a corpus, but as a capital. But as a capital. Hence, they will deposit the same in the fixed deposit of a bank. Because you invested this amount in the fixed deposits of the bank, you will get some income in the form of interest every year. Let us assume that an interest of 8,000 is being paid by the banker to TTD on yearly basis. Once the interest is accrued, it will be withdrawn. It will be withdrawn by TTD on yearly basis. So every year TTD is able to generate an income to the tune of 8,000 rupees on the deposit of 1 lakh rupees. This 1 lakh rupees shall not be used for the purpose of administering the scheme, but this 8,000 rupees shall be used for the purpose of administering the scheme. That means this entire amount of 8,000 rupees shall be treated as income, and that will be used by TTD for the purpose of administering the free meal scheme. This amount of 1 lakh will remain with the bank forever. That amount of 1 lakh rupees will remain with the bank forever in the form of a fixed deposit. That won't be touched because that will be treated as capital, otherwise called as corpus. Only income generated out of it will be used for the purpose of meeting the scheme. Now the scheme's objective. Now the question is how to account for this type of donations. The amount of donation received will be treated as liability. Income generated thereon will be treated as income. So donation amount will be treated as liability. Income generated or interest generated on such a fixed deposit will be treated as income, and that will be used for the purpose of administering the free meals scheme. This is all about dash donations directed towards corpus which is being called by the CA Institute as dash endowment. This interest income is being called by the CA Institute as income on endowment. Endowment means corpus. Corpus in our example means donations directed towards corpus. Interest on donations is being called in the CA Institute material as income on endowments. So if anybody is interested in going through the CA Institute material for this, and if you go through the Institute material, you should be able to understand that I explained you not only the points that were appearing in the CA Institute material, but several additional points were also explained to you to have a better understanding of the subject. Okay, right. This is about how to account for donations. So again, there are 2 points that you need to write under the heading donations. What are they? Point number 1, the auditor should watch the receipt of donations into cash book with the help of supporting documentary evidences such as donation letter, counter files of receipts, bank counter files, credit entries in the bank passbook or bank statement. Point number 2, the auditor should also verify whether the amount of donations so received has been properly accounted for. Accounting of donations is dependent upon the type of the donation received. For this, donations can be classified broadly into 3. The first one is general, the second one is specific, and the third one is donations directed towards corpus. In business organizations, we do call it as capital. In non-business organizations, we call it as corpus. And in our institute material, it is called as endowment. That is the only difference. By this, it is said that we completed a discussion on how to conduct audit of grants and how to conduct audit of donations.
Hello everyone, greetings of the day. Now you can purchase CA Inter Auditing regular batch videos from our Masterminds online classes app. These videos are taught in 100% English by Professor Sharma sir, having 23 years of rich experience in teaching the subject. Here you will find 175 hours of detailed videos covering all the chapters applicable for November 23 attempt recorded as per 2017 scheme. These are all latest recordings which are recorded in the classrooms but not in the recording theaters. You will find crystal clear detailed explanation for every concept in the subject. And you will definitely have a very good experience which you have never experienced earlier with regard to auditing subject. You can get these HD quality audio video lectures from our Masterminds online classes app. If you are an Android user, please install Masterminds online classes app, and in the search, you please search for CA Inter Auditing in the store section. If you are an iOS user, please install Class Plus app and enter our organization code MJETGUN and search for CA Inter Auditing in the store section. You can find the links to directly purchase these videos in our comment section. And you have 3 exciting, convenient options to buy this course. Option 1, you will have 175 hours of videos for 6 months at 2 views. And the material will be couriered to you, and at the same time, you can have PDF material on the screen, and option 1 is available for 5,000 rupees. And option 2, the same duration, 1 month, 1 view for 1,000 rupees, but PDF material only can be read on the screen. And you have option 3, for 175 hours, 3 months, 2 views, material will be couriered, and you can also have PDF material on the screen available for 3,000 rupees. We hope this course will be of great help to you. All the best. Happy learning.
Is sale of old assets. Sale of old assets. I will tell you almost 3 to 4 points. All these points are general in nature. You can make use of these points anywhere, particularly when you are writing about how to conduct watching of sale of old assets. The first aspect to be verified by the auditor under the heading sale of old assets is to check whether the sale of asset has been properly authorized by a responsible official. You need to check whether sale of the asset has been properly authorized by a responsible official. I remember that I have explained you the term authorization, and I proved that authorization is a part of internal control. With an example, I proved that authorization is a part of internal control. To ensure that you have an understanding of the term authorization, I have given you an example. The example is relatable to calculators. I am an accounts assistant in an entity. She is the cashier in the same entity. I approached the cashier. Do you know what is authorization? What is authorization? What is authorization? Authorization can be defined as examination of a transaction by another responsible official. Examination of a transaction by another responsible official and approval of the same, or acceptance of the same, is technically called as authorization. I repeat, authorization can be defined as examination of a transaction by another responsible official and acceptance or approval of the same. In order to have a better understanding of what is authorization, I will try to provide you with an example. Please listen to the example carefully. I am an accountant or accounts assistant in an organization. She is the cashier in the same organization. One day I approached the cashier. I have given a voucher to the cashier, and I asked the cashier to pay me an amount of 50,000 rupees. Cashier has been asked to give me an amount of 50,000 rupees. I said that I want to purchase 500 calculators for the accounts, 100 calculators for my accounts department, each calculator costing 500 rupees. Therefore, I need an amount of 50,000 rupees. Immediately, cashier paid me an amount of 50,000. With that 50,000 rupees, I purchased 100 calculators. At the time of purchase of calculators itself, I entered into an unauthorized oral agreement. An unauthorized oral agreement with the shop owner. As per that agreement, at the end of the day, I need to return. As per that agreement, at the end of the day on which the calculators are purchased, I need to return 99 calculators to the shop owner. After return of 99 calculators, shop owner is supposed to pay me an amount of 450 rupees. So I purchased 100 calculators, I paid 50,000 to the shop owner, and then in the evening I returned 99 calculators out of 100 to the same shop owner. Shop owner paid me an amount of 450 rupees per calculator. This entire amount of 450 into 99 has been misappropriated or defalcated by me. What is the benefit to the shop owner in this case? In the morning, I paid an amount of 500 to the shop owner. In the evening, I returned 99 calculators without opening the seal of the calculators. Shop owner is supposed to pay back only 450. That means what is the benefit to the shop owner in this transaction? He is getting 50 rupees in a day without having any risk. Without having any risk, he is getting 50 rupees per calculator. That is the advantage to the owner of the shop. Then what is the advantage derived by the employee? Employee is able to defalcate cash to the tune of 450 into 99. On the very next day, again, I asked the cashier to pay me an amount of 50,000 rupees. Then the cashier asked, why you are asking for another amount, another 50,000 rupees? I said that I need to purchase 100 calculators for the accounts department, each calculator costing 500 rupees. Now the cashier started suspecting the accounts assistant. Why the accounts assistant has purchased 100 calculators yesterday, and why he is saying that he need to purchase another 100 calculators today. Immediately cashier has given a reply to the accounts assistant saying that, sorry sir, I cannot give you an amount of 50,000 rupees. If you really want this 50,000 rupees, do one thing. Please go to the accounts officer. Please take the signature of the accounts officer on this voucher. If the accounts officer approves this transaction, there would not be any problem for me. Then I have gone to the accounts officer. I provided the voucher to the accounts officer, requesting the accounts officer to approve the transaction. When somebody asked you to approve a particular transaction and to put your signature on a paper, what will you do? Will you sign on the paper immediately, or will you try to check the transaction and its details in entirety? Obviously, any prudent person while making a signature on any paper will try to ascertain the nature of the transaction and several other things. Only if he is satisfied with the transaction, then he will sign on the paper. So accounts officer asked me a question. How many employees are there in the accounts department? She is the accounts officer. I am the accounts assistant. Accounts officer is asking the accounts assistant about how many persons are there in the accounts department. I have given a reply to her saying that there are 2 employees in the accounts department. The immediate question raised by the accounts officer is, then why you want to purchase 100 calculators? When there are only 2 employees in the accounts department, why you are trying to purchase 100 calculators is the question raised by the accounts officer, for which I have not given any reasonable answer. Therefore, the accounts officer has not signed on the voucher. Hence, I am unable to take that 50,000 rupees on the second day. Hence, I am unable to defalcate some amount out of 50,000. At least by now, you should be able to understand that authorization is nothing but examination of a transaction by another responsible official and approval of the same. Now, I want to ask you a question. What is the benefit of authorization? What is the benefit of authorization? If you are unable to provide an answer for this question, I will reframe my question in a different way. What happens if there is no system of authorization in an organization? What happens if there is no system of authorization in an organization? The possibility of occurrence of fraud will be very, very high. If you want to reduce the possibility of occurrence of frauds, what the organization should do? Organization had to establish a system called as authorization, which will help the organization in reducing, either in preventing or in detecting frauds. Any system which will be capable of either preventing or detecting frauds may be said to be an internal control system. That is the reason why I can always say that dash is a part of dash. Authorization is a part of internal control system. So authorization is a part of internal control system, because of which only the entity may be able either to prevent frauds or to detect frauds. Such I am having a pity on you. Why? Because I expected an answer from your side for this simple and very easy question about what is authorization and its importance, and unfortunately nobody is able to provide an answer for this. And this authorization is of 2 types. The first one is general authorization. The second one is special or specific authorization. What is a general authorization and what is a specific or special authorization. These two are contrary to one another. When authorization is given for entering into a single transaction, it is called as a specific authorization. When an authorization is given to enter into many number of transactions, it is called as a general authorization. For example, I have given this pen to you for your usage only for this day. If you want this pen tomorrow, you need to ask me again, and I may provide this to you or may not provide this to you. That means I have given an authorization for you to use this pen only for a single day. It is technically called as a specific authorization. Then what is general authorization? General authorization is an authorization that will be given for entering into many number of transactions. I have given you a liberty to use this pen any number of times without asking me. Then it is called as general authorization. Generally, either for purchase of fixed assets or for sale of fixed assets or for purchase of investments or for sale of investments, a specific authorization is required to be taken. I repeat, either for purchase of a fixed asset or for sale of a fixed asset or for purchase of investment or for sale of investment, a specific authorization is required to be taken. What is meant by specific authorization? Authorization given for purchase is not applicable for authorization, is not applicable for sale. Authorization given for sale is not applicable for purchase. For purchase, you need to take one authorization. For sale of the same fixed asset, you need to take another authorization. That is called a specific or special authorization. Similarly, for purchase of investment, you need to take authorization, and for the sale of same investment, again authorization is to be taken. This is called as a specific authorization. So, in this process, I explained you about what is authorization, about types of authorization, and most importantly, the concept that authorization is a part of internal control. By introducing the system of authorization, organizations are in a position either to prevent frauds or to detect frauds. Have you understood the concept of general authorization and specific authorization? If an approval is given for entering into a single transaction, it is called as specific. If it is given for entering into many number of transactions, it is called as a general authorization. Usually, specific authorization is required either for the purpose of purchase of fixed assets or for the purpose of sale of fixed assets or for the purpose of investment, purchase of investment or for the purpose of sale of investment. In case of companies, that authorization is given in the form of a resolution passed by the board of directors. In case of societies, etc., societies, trusts, etc., such an authorization is given by a committee called as managing committee. A committee called as managing committee. So a resolution may be passed either by the board of directors authorizing this type of transactions, or resolution may have been passed by a managing committee, specific authorization for this type of transactions. Now, coming back to the original discussion, the fourth general one is sale of old assets. Under this heading, the auditor is expected to check the following points. Point number 1, the auditor should verify whether sale of assets has been properly authorized by a responsible official. For this purpose, if it is a company form of organization, you need to go through board of directors approval. If it is other than company, usually this authorization will be given by the managing committee, and hence you need to go through the minutes of the meetings of the managing committee, because there you find resolutions passed by managing committee. Therefore, you need to go through the minutes book, you need to go through all the resolutions passed by the managing committee to ascertain whether sale of the assets has been properly authorized by a responsible official. This is about authorization. Point number 2, when an asset is sold, the entry relating to the sale will be recorded in the cash book. Therefore, it is the responsibility of the auditor to verify or to watch receipts of sale proceeds into cash book with the help of supporting documentary evidences. What documentary evidence or evidences are available to the auditor in respect of sale of assets? The first one is when you make a sale, the other party may have made payment. In that case, counter files of receipts. What is that? Counter files of cash receipts issued by you is said to be the first documentary evidence. If the other party paid the amount through check, then counter files received from bank is a supporting documentary evidence. The third one is credit entries. By this time you should be able to visualize all these documentary evidences, otherwise all my efforts got in vain. So counter files of cash receipts, counter files of bank, credit entries in the bank passbook or bank statement. These are all supporting documentary evidences that are available to the auditor in respect of sale of old assets. That asset may be either furniture, whatever it may be, whatever be the type of the asset. If old asset has been sold, these are all the documentary evidences. Generally, old assets may not have ready-made demand in the market. Therefore, usually for selling these old assets will be sold by the organization as a scrap. In that case, to sell these old assets, the organization might have called for quotations. The organization might have called for quotations or tenders. Such quotation or tender, if any received by the organization from the prospective buyers, is said to be another supporting documentary evidence. Sometimes these assets may be sold by the organization with the help of some agents. Otherwise called as very good auction houses. In that case, statement given by the auction house on sale, you will never hear all these documentary evidences in your lifetime. This is the first time and the last time. Auction house will provide you a statement on sale of your asset. In that statement, they will specify that this is the amount for which your asset is sold, out of which they will deduct their commission. Net amount will be paid to you. Then that statement received from the auction house may be said to be another supporting documentary evidences. With all these documentary evidences, you need to watch an entry into cash book to ascertain whether the entry is a genuine entry or is a fraudulent entry or is a real entry, a fictitious entry. After all, the objective of watching is to ascertain the correctness of a transaction. That is the reason why it is essential for you as an auditor to verify a transaction with all these supporting documentary evidences. So what is the first point to be checked by you? Point number 1, the auditor should verify whether sale of assets has been properly authorized by a responsible official. That for that purpose, you need to go through minutes of the meetings of the managing committee and you need to search for the resolution giving authorization for sale of assets. 2, the auditor should watch receipts through sale of old assets into cash book with the help of all these supporting documentary evidences. When you make a sale, you may either get a profit or you may suffer with a loss. The entity may have earned a profit on sale of assets or may have suffered with a loss. Therefore, it is our responsibility as an auditor to verify and to satisfy that the profit or loss on such sale has been properly accounted for. If you get profit, you will debit the same to the respective asset account and credit the same to the profit and loss account. If you suffer with a loss, you will debit it to the profit and loss account and credit it to the respective asset account. That is called as proper accounting. I have explained this point earlier, therefore I don't want to explain this. For example, opening balance of furniture is 10,000. It has been sold for 8,000. Furniture has been sold in entirety. In that case, it is said that the organization suffered with a loss of 2,000. How do you adjust this 2,000 rupees? It will be credited to furniture account and debited to profit and loss account. In such case, the credit side of the furniture account will appear like on the debit side, to balance brought down 10,000. On the credit side, by cash or bank 8,000. The remaining 2,000 is nothing but loss by profit and loss account 2,000. So that is the way in which you need to account for the loss or profit. as an auditor, you need to check whether if it is not properly accounted for, financial statements will never reflect a true and fair view. I can also prove it. For example, in the same example, 10,000 is the opening balance. The entire furniture has been sold and it has been sold for 8,000. Remaining 2,000 rupees has not been considered as loss by the entity. Instead, the 2,000 rupees amount has been carried forwarded by the entity. The 2,000 is appearing in the balance sheet of the entity. Is furniture really in existence? No, but you have given a value for the furniture worth rupees 2,000. Therefore, balance sheet cannot be said to be correctly prepared. Therefore, if the entity fails in properly accounting for dash or dash, if the entity fails in properly accounting for profit or loss on sale of assets, it will have an impact on the entity's financial statements. The financial statements of such an entity may not reflect a true and fair view. That is the reason why it is essential for us as an auditor to check and to ensure that profit or loss on sale is properly accounted for. Understood? Right. And if the entity is maintaining a register like PPE register, which is maintained generally by companies, the details of the assets purchased as well as the assets sold are also required to be recorded in the PPE register. You can also cross-check details with PPE register. That means you need to keep cash book. You need to keep PPE register before you. Then you need to keep all supporting documentary evidences. Then you should start checking the entries in the cash book or PPE with all these supporting documentary evidences. That is the practical way of carrying out the technique called as watching. Understood? Say yes or no. Are you able to follow me? Is it necessary for me to dilute further? No. Already I took 2 hours or 2 hours 15 minutes time to explain just 5 points. Why I am taking this much time to explain just 5 points is the fact that these points will be repeated everywhere. Whenever this point appears further, I don't want to even touch that point. I don't explain even a single word about that point. For example, grants will appear in a hospital, in an educational institution, in a charitable organization. Everywhere the term grant may appear. I don't want to explain it again till completion of audit of different types of entities. This is the first time and this is the last time you are listening to the discussion on government grants, donations. The third one is income from investment, and the fourth one is sale of old assets. If there is something which is not discussed, then I will try to discuss it while having a further discussion on each and every point. And finally, the last one is canteen. This canteen will also appear in a hospital. Canteen will appear in a hospital. Canteen will appear in an educational institution. It may appear in a club, in a recreation club. It may appear even in a cinema theater, cinema hall. So if you are able to learn about how to check canteen receipts, obviously the same point can be used anywhere in these 4 types of audits. Therefore, how to check canteen? Canteen may be run by the entity on its own. Entity may run the canteen on its own, or sometimes the entity may have given some space for establishment of a canteen to others. In that case, the entity will receive only rental income for that space and not any income from canteen. So where the entity under your audit has provided some space for a canteen, then the receipt will be in the form of rent. How to conduct audit of rent is very well known to you. I don't want to repeat even a single point. Now coming to this point, the entity under your audit may have maintained canteen on its own. In that case, all the receipts of canteen, shall be watched. All the receipts of canteen shall be watched into cash book with the help of supporting documentary evidence. It is sufficient if you write like this under the heading, when canteen is run by the entity on its own. All the receipts of canteen shall be watched into cash book with the help of supporting documentary evidence. You need not elaborate this point further. This is sufficient because the evaluator will satisfy that, okay, student knows that revenues may be generated by the entity either through maintaining the canteen on its own or through rental income. So if you are able to write these two things, that is sufficient for the evaluator. But because we are conducting audit of the organization, you need to provide some more points like how do you watch the same, what documentary evidences are available in respect of that, and everything. This is all about a general discussion in respect of audit of different types of entities. Till now, we focused only on the receipt part or income part. I haven't explained you anything about expenditure part. So I will try to explain two major heads of expenditure in this discussion. Later on, we can focus on expenditure part relating to audit of an educational institution. The discussion that I am going to have now is a general discussion on expenditure. Always you can write capital expenditure under the heading expenditure, because in the sources I said to you that the entity may have sold some old assets. When the entity sell some of its old assets, obviously it need to replace the old assets with new assets. Therefore, the entity under your audit may have purchased new assets. Purchase of new assets is nothing but investing some capital expenditure. Therefore, sale of old assets is a source of revenue or income or receipt for an organization, whereas purchase of asset is said to be a major head of expenditure for any organization. Therefore, the first general head of expenditure that you can write under the heading audit of different types of entities is capital expenditure. I will tell you 6 points under the heading capital expenditure. Try to remember all these 6 points. They are very much useful to you in future. When the entity under your audit had incurred some capital expenditure, being an auditor, you need to focus on the following 5 or 6 areas. In other words, as an auditor, you need to check the following 6 areas under the heading capital expenditure. Point number 1, the auditor should verify whether purchase of assets has been properly authorized by a responsible official. I don't want to explain you what is about authorization and how it should be verified. This point has already been explained to you. Generally, in case of non-profit oriented organizations, this authorization will be given by the managing committee through resolutions, and hence if the auditor goes through minutes of the meetings of the managing committee, there the auditor can find a resolution. Through that resolution, the managing committee may have authorized capital expenditure. Therefore, the very first point to be checked by you as an auditor under the heading capital expenditure is whether such expenditure has been properly authorized by a responsible official. Point number B, the management is saying that they incurred some capital expenditure. Auditor will always have a doubt about whether such expenditure is really spent or not. Therefore, it is our duty as an auditor to watch the capital expenditure with the help of supporting documentary evidences. For example, if the item purchased is immovable property, then supporting documentary evidence may be available in the form of title deeds of the property. If the item purchased is a movable property, then supporting documentary evidence may be available to the auditor in the form of invoice, delivery challan, and so and so. What you need to understand here is where the entity under your audit spend some amount on capital expenditure. As an auditor, you need to focus on the following areas under the heading capital expenditure. The first one is checking whether such capital expenditure has been properly authorized by a responsible official. The second one is the auditor should watch such capital expenditure with the help of supporting documentary evidences. Point number C is also well known to you. It need not be explained at all. The auditor should also verify and satisfy that all incidental expenditure. What is that? All incidental expenditure incurred by the organization with respect to purchase of asset have been properly capitalized. This point has been learnt by you under AS 10 PPE. What AS 10 says, where any entity purchase any asset, not only the purchase price of the asset, but all other incidental expenditure incurred by the organization in bringing that asset to its existing position and condition shall have to be capitalized. Therefore, since the entity under your audit purchased some assets, it is your responsibility as an auditor to verify and to ensure that all incidental expenditure incurred by the organization in bringing the asset to its existing position and condition have been capitalized. So, what are the duties of the auditor in respect of capital expenditure incurred by the entity under your audit? You need to verify whether that expenditure is properly authorized by a responsible official. You need to watch that expenditure with the help of supporting documentary evidences. Auditor should check and satisfy that all incidental expenditure incurred by the organization in bringing that asset to its existing position and condition have been capitalized. These are all general points. So whenever you say capital expenditure, you can write down all these general points under the heading capital expenditure. Point number D, if the entity is maintaining a register like PPE register, it is the responsibility of the entity to record the details of such purchase even in the PPE register. Therefore, it is your responsibility as an auditor to go through PPE register and to satisfy that details of the assets so purchased or details of capital expenditure have been recorded in the PPE register also. At the end of the year, it is the responsibility of the management to provide for depreciation because it is nothing but capital expenditure. Therefore, it is your responsibility as an auditor to verify whether the entity has provided proper amount of depreciation in respect of such purchase of assets or capital expenditure. And finally, the auditor can also verify whether management has made physical verification of their assets and whether any material discrepancies arising on such physical verification have been properly dealt with by the management. That's it. These 6 are said to be general points that you must have to write under the heading capital expenditure. What are the points? Please go through the points and try to understand them. If you are unable to understand, feel free to ask me. I will try to explain that in a different way. I will try to dilute it as well. The following 6 are the aspects that the auditor should verify under the heading capital expenditure. What are they? 1. Authorization. 2. Watch with supporting documentary evidences. C. Capitalization of incidental expenditure. 4. Entry into PPE register if there be any. 5. Verifying whether proper depreciation is provided for in respect of such capital expenditure. And 6. Ensuring that those assets have been physically verified by the management at reasonable intervals. I don't want to explain anything about all these points because everything is known to you. The concept of physical verification has been dealt with in detail under CARO. So you need to check whether management has made physical verification of these assets at reasonable intervals and any material discrepancy arising on such physical verification has been properly dealt with or adjusted by the management. These are all the aspects that you need to check when the entity under your audit had made some investment in capital expenditure. That's it. And head number 2. These are all the heads of expenditure, not sources of income. Till now we had a discussion about sources of income. What are the sources of income for a college? The things that we have discussed till now are nothing but sources of income for a college. Then we need to focus not only on the sources but also on the heads of expenditure. That is the reason why I started explaining you the general heads of expenditure. These are applicable to any type of audit. The second head is auditor should watch establishment expenditure. The auditor should watch establishment expenditure. Actually, you are supposed to watch each and every expenditure in detail. If you go through the profit and loss account of a company, of an entity, you may find several heads debited to the profit and loss account. And it is highly impracticable for the student to write about how to conduct watching of each and every head. Is it practically possible for you to write down how to conduct watching of each and every head that is appearing on the expenditure side? Certainly not. That is the reason why all expenditure has been clubbed and being called as dash. Establishment expenditure. As an auditor, you need to watch establishment expenditure, different types of expenditure which are revenue in nature, incurred by the organization with the help of supporting documentary evidences. There is nothing more to explain under this heading. I repeat, the auditor should watch all the establishment expenditure with the help of supporting documentary evidences to satisfy that expenditure is really incurred and is correctly recorded into books of account. And another important aspect is establishment expenses includes dash salaries and wages. Generally, salaries and wages are considered as a major head of expenditure for any organization. Sometimes the auditor may have found that there may be some increase. There may be some increase in salaries to the staff during the current year. In that case, what is your responsibility as an auditor? Where the auditor finds that there is some increase in the salaries paid to the employees during the year under audit, it is the responsibility of the auditor to go through dash, passed by dash, to go through the resolutions passed by the managing committee to ascertain whether such increase in salaries has been properly, very good, has been properly authorized by the managing committee. This is a particular point. It is a part of establishment expenditure, but it has been specifically mentioned in the CA Institute material. That is the reason why I am telling you this point separately. So, as an auditor, you should focus on capital expenditure. You should also focus on establishment expenditure. All establishment expenditure incurred by the entity under your audit should be watched with the help of supporting documentary evidences. Salaries and wages is said to be a major head of expenditure under establishment expenses. In respect of salaries and wages, there are two particular duties to the auditor. Duty number one, when the auditor finds that there is some increase in the salaries paid to the employees, it is the responsibility of the auditor to go through the resolution passed by the managing committee to ensure that such increase in salaries has been properly authorized by the managing committee. And another important aspect is sometimes PF dues would have been deducted. I don't want to explain much about PF because we had a discussion about the term statutory dues under CARO. Particularly under the heading undisputed statutory dues, I said to you that there are two duties to you as an auditor. What are the duties of the auditor in respect of undisputed statutory dues? Gone. Duty number one, the auditor should verify whether the company is regular in depositing such undisputed statutory dues with respective authorities within the due dates. Duty number two, where any undisputed statutory dues outstanding on the date of balance sheet and it is outstanding for a period of more than 6 months from the date from which it became payable, the same shall be reported by the auditor. Here also, salaries and wages have been paid. Some PF dues may have been deducted by the organization from the salaries of the employees. In such case, what is your duty as an auditor? You need to check whether such PF deductions made by the organization from the salaries of the employees has been deposited with dash, within dash, has been deposited with respective authorities within the due dates. Within the due dates. This is a specific point to be checked by you as an auditor again under the heading salaries and wages. Remember, salaries and wages is a part of dash. Salaries and wages is a part of establishment expenditure only. So two heads of expenditure can be considered by you as general heads of expenditure. You can write these two heads under any type of audit. Whether it is given in your material or has not been given in your material, you can write these two general expenditure points in any of the audits under audit of different types of entities. The first one is capital expenditure. The second one is establishment expenditure, including salaries and wages. There are two specific points which are to be borne in mind by you under the heading salaries and wages. What other heads of expenditure that you can write? Other heads of expenditure can be visualized by you based on sources. Based on sources. For example, if the educational institution runs canteen, if the educational institution runs canteen on its own, then obviously it had to spend some expenditure relating to canteen. Yes or no? You have recognized receipt from canteen as revenue, and now you are checking the expenditure relating to canteen. So this head of expenditure has been derived from the source. Source is canteen receipt. Because there are some receipts from canteen, and because the canteen is run by the organization on its own, obviously organization should have to incur some expenditure on running the canteen, like purchase of provisions, purchase of vegetables, etc. Foodstuffs, other foodstuffs, etc. In that case, that is a major head of expenditure for the organization. Therefore, where the entity under your audit is running canteen on its own, as an auditor, you can watch expenditure relating to canteen. Expenditure relating to canteen will be in the form of purchase of provisions, vegetables, and so on. You need to verify such expenditure with the help of supporting documentary evidences. Another important point relating to canteen is always there is a possibility of involvement of employees in fraud under canteen. Therefore, proper internal control systems should have to be established by the organization even in respect of canteen. I will try to explain you the actual internal controls that are required to be established in respect of canteen under the heading audit of a hotel. Audit of a hotel. Hotel is a major form of organization when compared with canteen. So there will be some purchase of provisions and vegetables even in a hotel. While explaining you that the audit of hotel, I will try to explain you internal controls that are supposed to be established by a hotel. Then you can understand the concept of internal controls in a better way, which are applicable even for canteen. So you have derived a head of expenditure called as expenditure relating to canteen from the source, because in source there is a receipt from canteen. Likewise, an educational institution may have sold some books. When you sell some good books and generate some revenue from sale of books, obviously some books would have to be printed or purchased by the entity. So there may be some expenditure relating to purchase of books or printing of books. Such expenditure is required to be checked by you. So I am visualizing the heads of expenditure purely based on dash. Purely based on sources of income. If you are able to visualize sources, you would also be able to visualize heads of expenditure. There is no rule that you need to write your answers only which are appearing in the material or in the CA Institute's material. You can write answers for any given question under the heading audit of different types of entities in general, because there is no particular language to be used or a particular terminology to be used in respect of audit of other entities. Therefore, you can write all these points in general in your own language. There is no rule that you need to follow the language given in the CA Institute's material or in any other material. That is the reason why I am explaining you different sources which were not included in our material also. So canteen is not included, or sale of books is not included, and we are having a discussion about expenditure relating to canteen, expenditure relating to books, etc. Another major head of expenditure for an educational institution may be in the form of prizes given to the students. What is that? Prizes given to the students. In that case, such prizes given to the students should also be verified by the auditor with the help of supporting documentary evidences. After all, this question will be given for a maximum of 4 marks. And it is sufficient if you are able to write down 3 to 4 sources of receipt and 1 to 2 sources of heads of expenditure. That is more than sufficient for a 4 marks question. Then why we are exploring several receipts and expenditure? If you are able to explore different sources and heads of expenditure, you will be able to write down at least 3 to 4 sources and 2 to 3 heads of expenditure. That is the reason why I am trying to explore all the sources and all the heads of expenditure to have a generalized view about how to conduct audit of this type of organization. That's it. This is about the heads of expenditure. Now let us focus particularly on heads of expenditure relating to an educational institution. The first one is, as already explained to you, it may be a capital expenditure. I said to you that educational institution may have sold some old assets in the form of furniture. Sale of old assets by an educational institution is nothing but a source of income for an educational institution. In that case, obviously there would be some purchase of assets. Therefore, you need to verify purchase of assets, otherwise called as capital expenditure, with the help of supporting documentary evidences. What aspects should you verify as an auditor under the heading capital expenditure? All these things have already been explained to you. I don't want to explain it again. I will just read it. Authorization, which with supporting documentary evidences, ensuring that all incidental expenditure have been capitalized, checking whether proper depreciation is provided or not. You can also verify whether management has made physical verification of assets and any material discrepancies arising on such physical verification have been properly dealt with or adjusted by the management. These 5 are said to be general points that the auditor should check under the heading dash. The next one is establishment expenditure. As I said earlier, capital expenditure and establishment expenditure are 2 major heads of expenditure that the auditor should verify. The auditor should watch all the establishment expenses with the help of available supporting documentary evidences. This is nothing but an analytical procedure or analytical review procedure. When the auditor identifies heavy expenditure, then it is the duty of the auditor to inquire into the reasons for such unduly heavy expenditure. In the previous year, salaries paid is 1 lakh. In the current year, it is 10 lakhs. Obviously, as an auditor, you will get a doubt about the correctness of that amount. In that case, you need to make an inquiry about such unduly heavy expenditure, which is well known to you. It is a general point, not required to be specifically explained. This is a good point. A budget may be prepared by the entity for the sake of expenditure. If any expenditure exceeds the budget, that excess amount should have to be sanctioned by the managing committee. Point number D is already explained to you. If you observe any increase in salaries, check whether increase in salaries has been properly sanctioned or authorized by managing committee. Point number E is also explained to you. If PF is deducted from the salaries of the employees, verify and ensure that such a PF deducted from the salaries of the employee has been deposited by the entity with respective authorities within the due dates. And if PF is not a provident fund maintained by the entity on its own, ensure that the amounts have been invested in appropriate securities. You are not expected to write all these points. It is sufficient even if you are able to write 2 out of these 5. This is all about establishment expenditure. The next one is expenditure relating to canteen, expenditure relating to bookshop, expenditure relating to canteen and bookshop. Like this, expenditure relating to prizes distributed to the students. Like this, you can write anything under the heading expenditure, but only 3 points were given in our material. expenditure relating to canteen. This was not given in our material. The auditor should watch expenditure relating to canteen, like purchase of provisions, purchase of vegetables, edible oils, and so on. And more importantly, for a canteen, a separate register is maintained called as the stock register or inventory register. You can also check whether canteen is maintaining a stock register. Usually, canteen also maintain a movement register. Stock register, you won't find all these things in my material also. This is general in nature. Canteen do maintain stock register as well as movement register. Stock register is well known to you. Then what is movement register? At the starting of the day, some provisions will be issued. Some provisions will be issued to the persons in the kitchen. At the end of the day, any provisions which were issued at the beginning of the day, which were not used in the kitchen, will be returned back to the stores. So in the morning, goods will be issued to the kitchen. In the evening, unutilized goods will be returned to stores. This is applicable for canteen, also applicable to hotels. This point assume importance in hotel audit. I am trying to explain this point in detail, keeping in view the height of hotel. You will find this point not here, but in height of hotel. At that time, I am not going to explain the point in this detail. So try to understand the terms stock register and movement register now itself, so that it is useful both for canteen as well as for a hotel. So canteen or hotel may maintain two separate registers. The first one is stock register. The second one is movement register. You need to verify and ensure that these registers are maintained by the hotel and entries are recorded therein. Next, expenditure relating to canteen should be properly authorized by a responsible official. More importantly, pilferage is the biggest problem in hotels and canteen. Pilferage is said to be the biggest problem either in a hotel or in a canteen. Pilferage is the biggest problem in a hotel or canteen. What is meant by pilferage? Employees of the organization will tend to steal some items in small quantities. For example, the chief chef may have taken 1 kg of say badam to his house without any authorization. Like that, there may be some pilferage in hotels and canteens. That is the reason why every hotel and every canteen, in fact, is made responsible, is under obligation to have some internal controls to reduce the possibility of pilferage. And as a part of internal control systems, hotels do maintain their inventories, items of inventories, under the lock and key of a responsible official. Usually, these costly items of inventory in a hotel or in a canteen are expected to be maintained under the lock and key of a responsible official. When the inventories are maintained under the lock and key of a responsible official, you can certainly reduce the possibility of pilferage. Apart from that, hotels do maintain a system of preparing a weekly trading account. You haven't heard this point earlier. Weekly trading account. Hotels do prepare, usually trading accounts are prepared once in a year, but hotels do prepare weekly trading accounts to have a control over their activities as a part of internal control systems. I repeat, pilferage is the biggest problem in any hotel or in any canteen. Therefore, usually hotels are expected, even canteens are expected to have some internal control systems as a part of internal control systems, and to reduce the possibility of pilferage, hotels do follow a system of maintaining their inventories under lock and key of a responsible official. Apart from that, hotels prepare and maintain some trading accounts on a weekly basis. When the hotel prepares a weekly trading account, it will try to compare the trading account for this week with the trading account prepared for the previous week. And if there are some material variations or deviations in the trading account, the hotel will start investigating into it. Why this should be done by a hotel? Pilferage cannot be detected by the hotel unless the hotel prepares a trading account. Do you agree with this statement? If you say yes, you need to provide a logic for that also. Pilferages may not be identified by the hotel except when the hotel prepares a dash weekly trading account. Or else I could revise my question like this. If the hotel prepares weekly trading account and if the hotel starts preparing a weekly trading account with previous weekly trading account, the hotel would be able to identify pilferages. Now my question is, how the hotel may be able to identify pilferages when the hotel prepares weekly trading account and compare the same with the previous week? In the previous week, the gross profit percentage is say 35%. For the current week, the gross profit percentage is say only 25%. Why there may be a fall in the gross profit ratio? If the sale prices of the products are reduced, then there will be a reduction in the gross profit. The hotel knows very well that there is no reduction in the sale price. If the purchase price of provisions or other items increases, then also there would be a reduction in the gross profit. And the hotel identified that there is no reduction, there is no increase in the purchase price also. There is no reduction in the sale price, there is no increase in the purchase price, no casual labor have been inducted into the hotel in that particular year, no increase in other trading expenses, there is no change in any item in the trading account, but unfortunately dash falls from dash to dash. Probably some of the employees of the organization, hotel employees, would have involved in pilferage, which resulted in more purchases, because of which gross profit may have fallen. In that way, hotel may be able to identify pilferages. That is the reason why I said to you that as a part of internal control systems, hotels or canteens do maintain their stock items or inventories under the lock and key of a responsible official, and as a part of internal control systems, they do prepare weekly trading accounts. If they are available to you as an auditor, you can also go through such weekly trading accounts. Are you able to follow the logic behind discussion of this point? The logic is to ensure that you have an idea that hotel is required to establish these as internal controls. That is why I am trying to explain these points to you. Now you can just go through what is given in the running notes. Expenditure relating to canteen. All the expenditure relating to canteen can be watched by the auditor with the help of supporting documentary evidences. This point is already explained to you. This is the point that I explained just now. The auditor should focus on internal control systems that were established either by educational institutions, canteen, or even in respect of a hotel. Internal controls are required to be established with respect to receipt of inventory, issue of inventory, and to verify whether such internal control systems established by the entity are effective. I repeat, auditor should check internal control systems with respect to receipt of inventory, issue of inventory, and several other things to verify whether it is effective or not. If it is effective, possibility of pilferage will be less, extent of checking can be reduced. If it is ineffective, then the auditor cannot reduce the extent of checking. And the fourth one is very well known to you. Management is made responsible to make physical verification of inventories of furniture, stationery, clothing, and all other equipment with reference to inventory register. That is the reason why I said to you that every hotel or every canteen may maintain a separate register called as stock register or inventory register. Apart from that, another register may also be maintained called as movement register. And last one is inventories should be properly valued. Previous point deals with physical verification. Last point deals with proper valuation of inventories. These are all the things that you can verify as an auditor under the heading expenditure relating to canteen. What are they? Watch the expenditure with supporting documentary evidences, check internal control systems in operation to ascertain whether they are effective or not, check whether management has made physical verification of inventories, check whether valuation of inventories done by the management is correct or not. That's it. These four are the aspects that you must verify under the heading expenditure relating to canteen. By this, I can say that I completed a discussion on audit of educational institutions, whether it be a school or a college or a university. You can now just go through your material given, and if you are having any doubts in your free time, not now, and if you are having any doubts, you can ask me. I will try to explain everything in detail again by taking some more time. There is no problem for me to take time, but you need to read it. If you are having any issues, ask me. I will try to clear them. Now, the second one is audit of a hospital. This won't take this much time. Every effort has been made to ensure that everything under this chapter is understandable in the first point itself. That is the reason why I have taken much time to explain only one point. It took almost 2 hours or 2.5 hours for me to explain only one point, that is audit of educational institution. But I am confident that the terms or things that you have learnt under this heading will be useful to understand the other topics, and it may not take more than 15 minutes or so to explain other topics, that too in detail. Now, how do you conduct audit of a hospital? What are the sources from which a hospital can generate revenue or receipts? What sources we have discussed about a hospital? The first one is government grants. The second one is donations. The third one is receipts from outpatients. The fourth one is lab or X-ray theater facilities, that is not there in our material. Even in our CA Institute material, both have been clubbed. Outpatients and inpatients have been clubbed. Receipts from outpatients, receipts from inpatients, lab or X-ray theater facilities have not been given anywhere. Receipts through canteen, operation, receipts through pharmacy, and income from investment, receives through sale of old surgical equipment. This is what we discussed about sources of receipt or income for a hospital, out of which several things are very well known to you, like how to conduct audit of grants, how to conduct audit of donations. These things are well known to you. Sometimes, so there is no need either to discuss or to go through head number 1, grants, which is well known to you. Head number 2, donations, also known to you. Head number 5, rent from immovable property. Rent from immovable property. Sometimes some space in the hospital may be given on lease for establishment of a pharmacy. In that case, hospital will be in receipt of rent from the pharmacy. Pharmacy is not being run by the hospital on its own. It has been given on rent. In that case, rental proceeds. You know very well about how to watch rental proceeds. I explained you how to imagine books, how to imagine supporting documentary evidences, what other aspects shall have to be considered by the auditor while conducting watching of rent. I don't want to explain it again. Refund of taxes. This is nothing but refund of income tax. This was also explained to you. Okay. Income from investment. There is no need to explain anything about income from investment. Out of 7 sources, now I can say that I completed 4 sources or 5 sources. Only 2 sources are pending for discussion. How much time will it take for me to explain 5 sources? It is not more than 5 minutes. And I will try to explain the remaining things in another 10 minutes so that we can complete a discussion on audit of the hospital as well. 2 more points are there which are difficult to understand. So I will try to explain it by diluting it. Hospital may receive amounts from their patients. As said earlier, for the sake of better understanding, I am dividing the patients of the hospital into 2 broad categories. The first one is an outpatient. The second one is an inpatient. Hospitals do maintain hospital do have outpatients or inpatients. That is point number 1. What aspects should you check as an auditor in respect of outpatients? Usually, every hospital is expected to maintain a separate register in respect of outpatients called as OP register. What is that? OP register. Similarly, in respect of inpatients also, hospital is required to maintain a separate register called as inpatient register. You won't find these things in your material, but practically it is necessary for every hospital to maintain registers like outpatient register and inpatient register. When you visit a hospital, you would have identified that there may be a receptionist sitting in the hospital. She will ask your details like your name, your address, your age, etc. and everything will be written in a book. That book maintained by the receptionist in every hospital is technically called as an outpatient register. In fact, a hospital is under obligation to maintain a separate register called as outpatient register. If you are able to recollect what you have discussed about the books of account under section 44A of the Income Tax Act, in case of specified professions like legal, engineering, architectural, medicine, etc., they need to maintain some basic books of account. A doctor is always required under 44AA to maintain a separate register called as outpatient register and inpatient register. So keeping in view the provisions of the Income Tax Act, you can say that every hospital is required to maintain two types of registers. One is an outpatient discussion. An outpatient register and an inpatient register. That is point number 1. When you visit a hospital as an outpatient, you will pay some fees. You will pay some fees to the receptionist. Immediately on receipt of your details will be recorded in a register called as outpatient register. Once your details are recorded in outpatient register, you need to pay some fees to the receptionist. That fees payable by the outpatient to the receptionist is called as outpatient fees. Usually that fees is collected by the receptionist based on management approved rates. Based on management approved rates. What do you mean by management approved rates? The doctor may say to the receptionist that charge 500 rupees as fees from the outpatient for 15 days. Charge 500 as fees from each and every outpatient as fees for 15 days. In the given example, what is the management approved fees? 500 is the management approved fees. So as an auditor, you need to check and ensure that fees being collected from the outpatients is not less than dash. Is not less than 500. That 500 in our example is nothing but management approved fees. Understood? So point number 1, the auditor should verify whether the hospital is maintaining a separate register called as outpatient register. Point number 2, the auditor should also check whether fees is being collected from the outpatients as per management approved rates. When fees is collected from the outpatient, hospital is required to provide a counterfile of cash receipt to the outpatient. That counterfile of cash receipt is the supporting documentary evidence. Point number 4, you won't find all these things in our material, but these are practical things that we watch or we verify as auditors while verifying the receipts from inpatients or receipts from outpatients. The fourth one is, if some concession is given or discount is given to any outpatient, then it is your responsibility as an auditor to check and ensure that that concession given to the outpatient has been properly, has been very good, has been properly. So whenever you find the term concession, you should be able to write that this concession should have to be properly authorized by a responsible official. It is the responsibility of the auditor to check that. This is all about outpatient. Then what about inpatient? Inpatient, for inpatients, hospital do maintain a register called as inpatient register. apart from these two registers, hospital may also maintain some more registers. For example, hospital is giving dialysis machine on rent to their patients, and amounts will be collected from the patient by the hospital at the end of every month. Dialysis may be carried out by the hospital on the patients, or sometimes a senior patient may ask the hospital to provide the machine so that he can carry out dialysis on his own. In that case, hospital will lend their dialysis machine to the patients, and the machine rent will be collected on that machine on a daily basis. In that case, hospitals do maintain a record of their patients called as attendance register, which is also technically called as patient attendance register. What is that? Patient attendance register. Why do hospital need to maintain a patient attendance register? To calculate rent to be collected from the patients who are utilizing the equipment of the hospital. So sometimes in our material you may find the term attendance register also, apart from the terms outpatient register and inpatient register. Before explaining you about inpatients, I will try to explain you another point which is not available in our material. Some hospitals may provide services to their patients in the form of providing X-ray facilities and laboratory facilities, like carrying out different types of blood tests is called as laboratory facility. There is no need to explain anything about X-ray. I want to ask you one simple question. Who will make use of these services provided by a hospital? Who will make use of these services provided by a hospital, like X-ray facilities, laboratory facilities, etc. These may be utilized either by outpatients, very good, or by inpatients, and sometimes even by outsiders. A hospital may have referred their patients for the purpose of conducting some X-ray or laboratory tests to this hospital. In that case, even some outsiders may make use of lab or X-ray theatre facilities that are being run by the hospital under your audit. In that case, how do you verify those things? If an outpatient is required to make use of the services like laboratory or X-ray theatre facilities, outpatient had to make the payment immediately. The outpatient had to make the payment immediately to the receptionist. For example, if a blood test is required to be carried out, receptionist will tell you that an amount of 500 is required to be paid by you for carrying out the laboratory tests. Then the outpatient will pay an amount of 500 rupees to the receptionist. Receptionist will issue a counter file. You need to show that counter file at the laboratory by checking that you have actually paid the amount of 500 rupees through going through counter files. The laboratory will carry out some tests on you and a report is given to the patient. That is about usage of dash and dash facilities by dash. Laboratory and X-ray theatre facilities by outpatients. So when an outpatient made use of laboratory or X-ray theatre facilities, it is the responsibility of the auditor to watch the receipts through laboratory or X-ray theatre facilities from outpatients into cash book with the help of counter files issued to the patient. Sometimes these facilities may be availed by an inpatient. When an inpatient availed either X-ray theatre facilities or laboratory facilities, immediately amount will not be charged from the inpatients immediately, but the amount of charge will be included in the bill of inpatients. When the inpatient is being discharged, a bill will be prepared by the hospital called as bill of inpatient. In that bill, several charges will be included, like lab or charges in respect of laboratory or X-ray theater facilities used by the inpatients. Sometimes some operation would have been performed on inpatient. In that case, charges for operation would also be included in the bill of the inpatient. Like that, room rent may also be charged to the inpatient in the bill of inpatient. Similarly, consultancy fees of different types of doctors may be included in the fees of in the bill of the inpatient. These are all the charges that will be collected by the hospital from their inpatients, like charges for X-ray or the laboratory theater facilities, charges for operation theater facilities, room rent. The next one is consultancy fees to doctors. If the inpatient made use of canteen services, some charge will be made for that also. If the inpatient has made use of pharmacy services in the hospital, charges will be made to the inpatients in respect of pharmacy services. These are all the charges that are required to be included in the bill of the inpatient. These are all the amounts that are required to be collected by the hospital from their inpatients, which are required to be included in the bill of inpatients. And sometimes even an outsider may make use of laboratory or X-ray theater facilities. In such case, amounts will be immediately collected from the outsiders. A cash receipt will be issued to them. Then the services will be provided. So I am exploring the supporting documentary evidences in each and every case so that you can write even a single point under each and every head. Now coming back to our original discussion. Patients are of two types. The first one is outpatient and the second one is inpatient. How to conduct audit of receipts through outpatients has already been explained. Now how to conduct audit of inpatients. Point number 1, the auditor should go through inpatient register. Point number 2, the auditor should check bill prepared in respect of inpatients. While checking the bill prepared in respect of inpatients, the auditor should verify and ensure that all charges were included in the bill of dash. All charges were included in the bill of inpatient, like operation theater charges, laboratory or X-ray theater charges, room rent, consultancy fees of doctors, canteen, pharmacy, everything is required to be included. Remember, charges to the inpatients should be made at management approved rates. This point is appearing both under dash and dash, both under outpatient as well as under inpatient. So in all the cases, the bill is required to be prepared based on management approved rates. And if some concession is given, it is necessary for you to check whether a person who is authorized in that behalf had given an authorization for that concession. This is all about how to conduct audit of receipts from patients. I divided these patients into inpatients and outpatients. Several points have been explained to you which are not here. Some of the points that I explained to you are not here. So be careful while reading and understanding this point. Point number 3, receipts from patients, not from in and outpatients. The total has been combined into patients. The auditor should watch receipts from patients into cash book with the help of dash. Counter files of receipts issued to the patients. Point number 2. Counter file, excellent. Counter file to cash book. Counter file to register of patients. What is register of patients? Both the dash and dash is being called by the CA Institute as dash. Inpatient register and outpatient register is being called by the CA Institute as register of patients. So you need to check entry in the cash book as well as register of patients with the help of dash. Counter files of cash receipts issued. Read it again. Point number A. Watch receipts from patients into cash book with counter files of receipts. Cross check the receipts into register of patients. Cross check the receipts with the patients attendance records. I explained you that sometimes some type of hospitals may maintain patient attendance record, and why the hospitals are maintaining attendance records, the logic behind that was also explained to you. Ensure that fees collected from the patients is as per dash management approved rate. When some discount is given to the patients, verify whether it is properly authorized. And finally, in respect of inpatients, ensure that all charges in respect of inpatients are included in the bill of inpatient. Bill of inpatient includes all types of charges: laboratory, X-ray theatre, operation theatre, pharmacy, canteen, consultancy fees, room rent, everything is required to be included. That's it. This is the end of the discussion on receipts from patients. Actually, it is quite difficult for me to substantiate this point which is included in your material. Usually the term subscriptions is used only for charitable organizations, that to religious organizations. The term subscriptions is a term relatable to publications. Usually the term subscription is relatable to, generally speaking, the term subscription is relatable to publications. There is a mission in India called as Ramakrishna Mission. That mission publish some books on a monthly basis. The name of the book being published in Telugu is Ramakrishna Prabha. If you want to get such book from Ramakrishna Mission, you need to subscribe for that publication being given by Ramakrishna Mission. For that, you need to pay some amount to the mission. That amount paid by you to the mission, subscribing for receipt of their publication, is technically called as subscription. That is the reason why I said to you that generally the term subscription is associated with dash, associated with publications. But unfortunately, that term has been used even in a hospital. So I need to substantiate about why the term subscription has been used in a hospital. Let us assume that the hospital is publishing a medical journal. In that way only I can substantiate. The hospital is publishing a medical journal, and there may be several subscribers to the medical journal being published by the hospital. That subscription may be either an yearly subscription or a life subscription. What is that? Subscription may be dash or dash, yearly subscription or life subscription. Every organization receiving subscriptions are expected to maintain separate registers, one for life subscription and the other for dash, yearly subscriptions. Register for life subscriptions, register for yearly subscriptions is required to be maintained by the organization. If you make some subscription to the hospital, you will pay some amount to the hospital, like yearly subscription or life subscription. Usually subscriptions are made through checks. When the hospital receives your subscription, what the hospital will do? Will give you a counter file of cash receipt. If you have given a check to the hospital, that will be deposited by the hospital into bank. So bank counter file is also available. Credit entries in the bank passbook or bank statement is also available. Apart from checking entry relating to subscriptions into cash book, you need to verify whether the hospital is maintaining two separate registers like dash and dash. Life subscription register and annual subscription or yearly subscription register. You can cross check entries in cash book as well as entries in life subscription register and annual subscription register. Sometimes in the published accounts of the hospital, list of subscriptions may also be given. Total of the list of subscriptions should be tallied with the total of subscriptions that were reflected in the income and expenditure account. That's it. Read it. Subscriptions. The auditor should watch receipt of subscriptions into cash book with the counter files of receipts, bank counter files, bank passbook credits or credit entries in the bank passbook, etc. Then cross-check the receipt with the subscription registers. And finally, this is very easy to understand. Total amount of subscription receivable, total amount of subscription actually received. Receivable minus received is called as due. Reconcile the total subscriptions with the subscriptions received, Simple. Subscriptions received plus subscriptions outstanding should be tallied with total subscriptions receivable by the hospital. This is about how to check subscriptions. Just I have substantiated it by giving an example. Still, I don't agree with that heading. There will not be any subscriptions for a hospital. You can say it only as rent, not a subscription. But still, in order to substantiate it, I created an example wherein I said to you that hospital is publishing some medical journals every month, and for that purpose, general public may have subscribed in the form of live subscriptions or yearly or annual subscriptions. By this, it is said that we completed dash portion of a hospital, receives portion of a hospital. Other sources of income are laboratory or X-ray theatre facilities, which you won't find in our material, operation theatre facilities, pharmacy receipts. How do you check pharmacy receipts? For every sale, the hospital pharmacy will issue a cash bill, and every sale will be recorded in the cash book. Entry in the cash book should be checked by the auditor with the help of a cash bill. That's it.
Hello everyone, greetings of the day. Now you can purchase CA Inter Auditing regular batch videos from our Masterminds online classes app. These videos are taught in 100% English by Professor Sharma sir, having 23 years of rich experience in teaching the subject. Here you will find 175 hours of detailed videos covering all the chapters applicable for November 23 attempt recorded as per 2017 scheme. These are all latest recordings which are recorded in the classrooms but not in the recording theatres. You will find crystal clear detailed explanation for every concept in the subject, and you will definitely have a very good experience which you have never experienced earlier with regard to auditing subject. You can get these HD quality audio video lectures from our Masterminds online classes app. If you are an Android user, please install Masterminds online classes app, and in the search you please search for CA Inter Auditing in the store section. If you are an iOS user, please install Class Plus app and enter our organization code MJGUN and search for CA Inter Auditing in the store section. You can find the links to directly purchase these videos in our comment section. And you have three exciting, convenient options to buy this course. Option 1, you will have 175 hours of videos for 6 months at 2 views. And the material will be couriered to you, and at the same time, you can have PDF material on the screen, and option 1 is available for 5,000 rupees. And option 2, the same duration, 1 month, 1 view for 1,000 rupees, but PDF material only can be read on the screen. And you have option 3, for 175 hours, 3 months, 2 views, material will be couriered, and you can also have PDF material on the screen available for 3,000 rupees. We hope this course will be of great help to you. All the best. Happy learning.
Now expenditure part. The first one is capital expenditure. Completed. Is it necessary to explain anything under the heading capital expenditure? No. Very good. The second one is establishment expenses. Is it necessary to explain anything about establishment expenses? You can read it. Watch all establishment expenses with supporting documentary evidences. Inquire into unduly heavy expenditure. If expenditure exceeds the budget, verify sanction of the managing committee. If there is an increase in salary, verify whether managing committee sanctioned it. Deposit of PF with respective authorities within the due dates. Everything is already known to you. The same can be repeated anywhere. You may get a doubt. If I repeat the same thing everywhere, will I get marks? Everything is not asked in the same exam. So that is the reason why the same points can be written by you under the heading establishment expenses. That's it. So the first one is capital expenditure. The second one is establishment expenses. The third one is I derived this from dash, from the heads of expenditure, heads of income. Canteen. If the canteen is run by the hospital on its own, these points will be applicable. If medical shop is run by the hospital on its own, then purchase of medicines is also required to be checked by you. Okay? Done. The next one is physical, that is other expenditure, pharmacy. Physical verification. I can tell you a lot of things about pharmacy, the ordering process of the pharmacy, how medical distributors supply items to the pharmacy, how invoice is generated, everything. But because of time constraints, I cannot do that. And finally, physical verification. It is the responsibility of the management. If required, the auditor can also make physical verification of either stocks of medicines, or the auditor can make physical verification of assets, or else the auditor could make physical verification of stocks relating to canteen. Anything can be physically verified by the auditor or management. Items of financial statements. This chapter includes watching and verification. This was already explained to you. This chapter includes the terms watching and verification. You can trace the terms watching and verification to Standard and Auditing 500. The term watching and verification were also referred to in SA 500. You know very well about the audit procedures that are required to be followed by the auditor to obtain sufficient appropriate audit evidence. Two procedures were mentioned in SA 500. The first one is risk assessment procedures. The second one is further audit procedures. We are soon going to have a discussion on SA 315. The heading of SA 315 is identifying and assessing the risks of material misstatements in the financial statements through understanding the entity and the environment, including its internal controls. That process is generally called by us as risk assessment process. Depending upon the level of risk the auditor observed, the auditor can determine the nature, timing, and extent of audit procedures. Therefore, auditor is required to carry out risk assessment procedures. You are also required to carry out further audit procedures. Such further audit procedures that can be followed by the auditor to obtain sufficient appropriate audit evidence can be divided broadly into two categories. The first one is compliance procedures, otherwise called as tests of controls, and the second one is substantive procedures. What are the procedures that the auditor can follow to obtain sufficient appropriate audit evidence under the heading further audit procedures? The first one is compliance procedures, otherwise called as tests of controls. The second one is substantive procedures. Such substantive procedures that can be followed by the auditor can be classified broadly again into two categories. The first one is tests of details of transactions. What is the first one? Tests of details of transactions. And the second one is, a part of the first point is tests of balances. This is generally called as like this: tests of details of transactions and balances. But for the sake of better understanding, I have divided the sentence into two groups. The first one is tests of details of the transactions. The second one is tests of balances. And the next one is substantive analytical procedures. Very soon I am going to start and complete SA 520, which deals exclusively with substantive analytical procedures. First of all, I will try to complete SA 315, wherein you can understand that there is a lot of difference between the terms substantive procedures, between the terms analytical procedures and substantive analytical procedures. They both are not one and the same. Analytical procedures are different. Substantive analytical procedures are different. Do you know the difference between the terms analytical procedures and substantive analytical procedures? Is it completed? SA 500 completed? What is meant by substantive procedures? Why should the auditor follow substantive procedures? To substantiate means to prove the correctness of. To substantiate means to prove the correctness of. Do you know what are assertions relating to balance sheet? What are the assertions relating to balance sheet? There are 4 assertions relating to balance sheet. What are they? Probably in the previous session only I have explained you about the assertions relating to balance sheet. The first one is existence. The second one is ownership, otherwise called as rights and obligations. The third one is valuation, and the fourth one is completeness. These are said to be assertions relating to balance sheet. These are said to be assertions relating to balance sheet. Unless you understand what is an assertion, there is no point in conducting an audit at all. So, what is an assertion? Assertion is nothing but a declaration. Assertion is nothing but a declaration made by the management, or a claim made by the management, or a representation made by the management. Whatever you call, it mean one and the same. I repeat, assertion can also be called as a declaration or a claim or a representation made by management to the auditor. And in most of the cases, these assertions made by the management to the auditor are implied in nature, and they are not explicit in nature. They are not explicit in nature. Most of the cases they are implied in nature. Sometimes implied may also be termed as embodied in the financial statements. Embodied means made part of it. Embodied means made part of it. So, it seems nobody is having an idea about what is an assertion, right? So, these are all nothing but declarations. Let us assume that you have been appointed as the auditor of an entity. When you go for an audit, you have been provided with the balance sheet of the entity. While you are going through the asset side of the balance sheet, you have identified that the organization has written like this on the asset side of the balance sheet, 5 lakhs. Nothing has been specifically mentioned by the management to the auditor. Just management handed over a draft set of financial statements to the auditor. Auditor had gone through the balance sheet and finds an entry appearing therein, which is building having a value of 5 lakhs. What does it mean? When you go through the balance sheet, and if you observe that balance sheet contains an asset called as building having a value of 5 lakh rupees, what does it mean? It means that management is declaring. It means that the management is making some declarations to the auditor about 4 things. The first one is that the asset, that is building, is in existence. Since building is in existence, we have reflected or disclosed building in our balance sheet. So the very first declaration being made by the management to the auditor is that the asset that has been shown in the balance sheet is in existence, or the liability that has been shown in the balance sheet is really in existence. That means the assets which are not in existence, or the assets which are the liabilities which are not in existence, have not been shown in the financial statements. That means management is declaring to the auditor that there are no fictitious assets and there are no fictitious liabilities. The assets which are actually in existence, the liabilities which are actually in existence have been disclosed in the balance sheet. That is the meaning of the term existence. Are you able to follow this point or not? What the management is declaring to the auditor? All the assets that were shown in the balance sheet are in existence. All the liabilities that were shown in the balance sheet are in existence. Only existed assets and liabilities have been shown in the balance sheet. That means we have not included any fictitious assets or fictitious liabilities in our balance sheet. That is said to be the first assertion made by the management to the auditor. The second one is the ownership, otherwise called as rights and obligations. It is said that management is declaring to the auditor that management is the owner of all the assets. In other words, management is declaring to the auditor that they are having rights over the assets and they are having obligations over liabilities. We are having rights over assets. We are having obligations over liabilities. That is the reason why ownership is also called as rights and obligations. All the assets shown in the balance sheet are our rights all the liabilities that were shown in the balance sheet are our obligations. This is another declaration being made by the management to the auditor. And the third one is about valuation. The value that is being reflected in my balance sheet about the building is correct. So the value is correct. That is another assertion or a declaration made by the management to the auditor. So what are the assertions or declarations made by the management to the auditor with reference to balance sheet? That all the assets that were reflected in the balance sheet are really in existence, that all the liabilities that were reflected in the balance sheet are really in existence, that all the assets that were reflected in the balance sheet are rights of the entity, that all the assets, all the liabilities that were reflected in the balance sheet are the obligations of the entity, that the value of all the assets shown in the balance sheet are accurate, that the value of all the liabilities shown in the balance sheet are accurate, and the fourth one is completeness. What is that? Completeness. All the assets have been completely recorded and completely reflected in the balance sheet without omitting any asset. Without omitting any asset. All the liabilities have been completely reflected in the balance sheet without omitting any liability. So all the assets are disclosed completely without omitting anything, and all the liabilities have been completely disclosed without omitting any liability. So first one is different and the last one is different. Under the heading existence, management is reporting to the auditor that all the assets which are really in existence and all the liabilities which are really in existence have been reflected. That means no fictitious asset, there are no fictitious assets or there are no fictitious liabilities. In the last point, the management is declaring to the auditor that only all the assets have been shown, all the liabilities have been shown, no asset or no liability has been omitted to be disclosed in the financial statements. This is all about assertions made by the management with regard to balance sheet. I hope you have an understanding of the assertions, meaning of the term assertions and assertions relating to balance sheet. Existence, rights and obligations, valuation and completeness. Can you please repeat what is the meaning of this? The assets are in existence. The liabilities shown in the balance sheet are in existence. That is point number one. Point number two, all the assets shown in the balance sheet are our rights. All the liabilities shown in the balance sheet are our obligations. The value of the assets shown in the balance sheet is accurate. The value of the liabilities shown in the balance sheet is also accurate. All the assets have been completely reflected in the balance sheet without omitting any of it. All the liabilities have been completely shown in the balance sheet without omitting any of it. These are all said to be declarations made by the management to the auditor. Now, if you were the auditor, what should you do? You need to check whether such declarations or assertions made by the management are accurate or not, valid or not, and reliable or not. You need to verify whether such declarations made by the management with regard to the balance sheet are accurate or not, valid or not, and reliable or not. Why should the auditor do like that? Because if all these declarations made by the management were found to be accurate, valid, and reliable, as an auditor, you can say that balance sheet is reflecting a true and fair view. So in order to check whether a balance sheet is really reflecting a true and fair view, what the auditor should do? Auditor should try to check the correctness of dash made by dash to dash. The auditor had to check the correctness of assertions made by the management to the auditor. In other words, the auditor should satisfy that all the assets shown in the balance sheet are really in existence. All the liabilities are really in existence. All the assets belongs to the entity under audit. All the liabilities belongs to the entity under audit. The auditor should also satisfy about the correctness of values of all the assets reflected in the balance sheet. The correctness of liabilities, value of all the liabilities that were reflected in the balance sheet. The auditor should also satisfy that no material asset has been omitted to be included in the balance sheet. No material liability has been omitted to be included in the balance sheet. Then only you can say that balance sheet is reflecting a true and fair view. So as an auditor, what is our duty? You need to check whether all these assertions made by the management are correct or not. The term correct has been divided by me into three categories. That is, first one, whether such assertions made by the management are accurate or not, valid or not, reliable or not. How do you do that? If you were the auditor, how do you do that point? Or how do you ascertain whether assertions made by the management are accurate, valid and reliable? What is the first assertion? Existence. So you need to check whether that assertion made by the management is accurate or not, valid or not, or reliable or not. For which, if you were the auditor, what will you do? That's it. You need to make physical verification, otherwise called as physical inspection of the asset. You need to verify, you need to make physical verification, otherwise called as physical inspection of the asset. When I say inspection, every one of you must be able to recollect that inspection is one of the audit procedures that are available for the auditor to obtain sufficient appropriate audit evidence as per SA 500. Inspection, observation, inquiry, confirmation, recalculation, reperformance are said to be substantive analytical procedures, are said to be other audit procedures that are available for the auditor to obtain sufficient appropriate audit evidence. You want to ascertain obtain sufficient appropriate audit evidence about the accuracy, validity and reliability of the existence assertion. I repeat, as an auditor, you need to obtain sufficient appropriate audit evidence about the accuracy, validity and reliability of the existence assertion made by the management in their balance sheet. How do you do that? By making a physical inspection. So inspection is said to be a dash. Inspection is said to be a dash. Inspection is said to be an audit procedure that is required to be followed by the auditor to obtain sufficient appropriate audit evidence about the accuracy, validity and reliability of the existence assertion made by the management. Do you follow it or not? Now, what is your second duty? Rights and obligations. You need to verify whether the organization is the owner of the assets and is having rights over the assets. How do you check the ownership of the assets? How do you check the ownership of the assets? By inspecting title deeds. So if you make physical inspection, you can identify the existence. If you make inspection of title deeds, I repeat, if you make physical inspection, you can obtain sufficient appropriate audit evidence about the existence assertion. If you make inspection of title deeds, you will come to know about the ownership of the asset. I repeat, through inspecting title deeds of immovable properties, in case of movable properties, through inspection of other documentary evidences like invoice, etc., the auditor would be able to obtain through following a procedure called as inspection, that is through inspection of title deeds and through inspection of invoices, the auditor can obtain sufficient appropriate audit evidence with regard to accuracy, validity and reliability of ownership assertion, otherwise called as rights and obligations. Then how do you know whether value of assets reflected in the balance sheet are correct or not, whether value of the liabilities shown in the balance sheet are correct or not? In order to check the value of the assets and value of the liabilities, the auditor need to inspect books and other related records. By inspecting the books only, you will come to know whether value of the asset or value of the liability shown in the balance sheet are correct or not. So inspection includes three things. You can just refer to SA 500. All the points that I have explained to you till now will be there in our material under the heading SA 500, under the heading inspection. What are they? The first one is physical inspection or physical verification. The second one is inspection of title deeds in case of immovable properties and invoice or other supporting documentary evidences in respect of movable properties. And the third one is inspection of books of account. So inspection involves three things. 1. Physical inspection. 2. Inspection of title deeds or invoices. 3. Inspection of books and other related records. Just by following a procedure, a single procedure called as inspection, the auditor would be able to obtain sufficient appropriate audit evidence about the accuracy, validity and reliability of existence, rights and obligations as well as valuation. So by this you need to understand that in order to verify these things, in order to verify the accuracy, validity and reliability of the assertions made by the management relating to balance sheet, the auditor should follow audit procedures like inspection, observation, inquiry and so on. For example, if the management reflected some value to its inventory, you need to verify the correctness of the value of inventory. Value of inventory can be arrived at by multiplying quantities of inventory with the rate of inventory. So value of inventory is dependent upon quantity and rate. Value of inventory is reflected in the balance sheet. You need to verify whether the value reflected in the balance sheet is correct or not. In order to check the value of the inventory, first of all, the auditor should focus on the correctness of dash and dash. The correctness of quantities of inventory as well as the rate adopted for valuation of inventory. How do you ascertain the quantities of inventory? You can just go through stock register, but the results of stock register or the data available in the stock register is not reliable to the auditor. Why? Because some of the employees of the organization would have involved in fraud. When a person was involved in fraud, particularly through stealing physical stock, he won't record the details of the stock so stolen by him in the stock register. Therefore, the data or the information that is available in the stock register is not reliable. It is not authentic. Then how do you know about the correct quantities of stock? There are two options available to the auditor. The first one is the auditor himself can make physical inspection of inventory. You may either physically inspect immovable properties for their existence, or else you could inspect the inventories to ascertain their existence. Therefore, the auditor himself can make physical inspection of quantities of inventory. Or else, when the management is making a physical inspection of inventories, the auditor may present, may attend. This may have been explained to you under SA 501. Okay, so auditor had to present at the location of inventory, and the auditor should observe. The auditor should observe the process of physical counting being done by the management. If I want to ascertain how many people are sitting in this class, I am having two options. Option number 1, I can count the number of students sitting in the class. I can physically inspect and count them. Otherwise, I may call for the coordinator, ask them to count the number of students. When the coordinator is counting the number of students, I will simply observe whether coordinator is correctly counting them or not. So either by following the process of inspection or by following the process of observation, I will be able to obtain sufficient appropriate audit evidence about the existence of an asset, where observation can be defined as looking at a process or operation when somebody is performing that process or operation. Some other person is performing some operation or procedure. You are just looking into it. It is called as observation. In the given example, physical inspection of inventories is not being done by the auditor. It has been done by whom? By the management. The auditor is just observing the process of physical count being made by the management. Through the process of observation also, you will be able to obtain sufficient appropriate audit evidence about the existence of a particular item of asset that may be either movable property or immovable property. So quantities can be either inspected by the auditor or observed by the auditor when the management is making physical inspection. Okay, that is called as observation. So sometimes inspection and observation are the procedures that are required to be followed. For example, if there is a figure of 1 crore against a particular debtor, there is only one debtor in the organization. There is only one debtor in the organization. The value of the debtor being reflected in the balance sheet is 1 crore. Obviously, as an auditor, you will get a doubt because the value is very, very high and there is only one debtor to the organization. Obviously, the auditor may get a doubt about the correctness of the figure of debtor. In that case, what the auditor should do? First of all, the auditor should try to verify each and every debit and each and every credit in the debtor account with the help of supporting documentary evidences. Even after checking all the debits and all the credits in the debtor account, if still there is a doubt or suspicion to the auditor, the only alternative available for the auditor is to follow external confirmations. External confirmations. The auditor will try to write a letter to the debtor. The auditor will try to communicate with the debtor directly and get the required information directly from the debtor. When the debtor responds to the request made by the auditor, it is called as confirmation. Auditor is making an inquiry with the debtor about whether a particular balance as appearing in the books of account of the entity is correct or not. Debtor is responding to the inquiry. Debtor is responding to the inquiry made by the auditor, saying that the balance in his books of account is also correct. So dash follows dash. Confirmation follows inquiry. Inquiry is first, confirmation is next. First of all, the auditor made an inquiry with dash. Debtor, asking the debtor to confirm the balance. Later on, the debtor responded to the request made by the auditor. Therefore, first of all, it is inquiry. Later on, it is confirmation. That is the reason why in our audit procedures to be followed by the auditor to obtain sufficient appropriate audit evidence, terms like inspection, observation, inquiry, confirmation, recalculation. What is I'm again explaining all these things to you. I don't know how much is known to you, how much is not known to you, who knows it or who do not know it. And these things help me a lot in explaining the chapter audit of items of financial statements. That is the reason, that is the intention behind again explaining all these things to you to some extent, because it helps me a lot as well as it helps you a lot to have a better understanding of this chapter, without which you cannot understand the soul of the chapter. So, what is meant by recalculation? Recalculation simply implies checking the arithmetical accuracy. Sometimes management may involve in fraud through making arithmetical inaccuracies. I will tell you an example that will be used later on. You know very well about the concept of provision. What is provision? There is a liability, there is an expenditure, or there is a loss which is certain or which may be certain, but the amount of which cannot be ascertained with substantial accuracy. What do you call as provision in accounts is technically called as accounting estimates in auditing. Do you know it? What do you call as provision is technically called as accounting estimates in auditing. Both have the same meaning. Management use the term provision. We auditors use a term called as accounting estimates, where accounting estimates can be defined as approximation of a monetary amount. What is that? Approximation of a monetary amount in the absence of precise means of measurement. Approximation of a monetary value or monetary amount in the absence of precise means of measurement. There are no precise means of measurement. So you cannot ascertain an amount accurately. In that case, if you provide that amount with approximately, then it is technically called as accounting estimate. I asked you about my height. Is it possible for you to tell me about the exact height of me? No, because there is no measurement yardstick. If there is a measurement yardstick, certainly you will be able to provide the correct height of me. Because there is no measurement yardstick, you may provide information approximately, like you may be 5'11" or 6. So that is called as approximation. Why you are giving the height approximately? Because there is no precise means of measurement. So what is accounting estimate? Accounting estimates can be defined as approximation of a monetary value in the absence of precise means of measurement. The following are said to be the best examples of accounting estimates. The first one is provision for depreciation. I am using the term provision. That is the reason why I said to you that what do you call as provision in accounts is technically called as accounting estimate in auditing. Provision for depreciation. The second one is provision for taxation. Why you are calling it as provision for depreciation? Because nobody can ascertain what would be the exact amount of depreciation. You are just approximating that this may be the reduction in the value of the asset because of usage of the asset. The actual reduction in the value of the asset may be more than that or may be less than that. Nobody in this world can specify what exactly is the amount of reduction in the value of the asset due to its usage, otherwise called as depreciation. So don't use the term depreciation. You must have to use the term provision for depreciation. Similar to that is provision for taxation. Why? You are the person who has written Income Tax Act. Let us assume you are the person who written the Income Tax Act. Let us assume I came to you. I asked you to calculate my tax liability. Is it possible for you to calculate my tax liability correctly? Your answer should be no. Why? Because even if you calculate my tax liability, then at some point of time or other, if I submit an income tax return with income tax authorities, a particular person in the income tax department may assess my return of income to ascertain whether it has been properly prepared or not. And that assessing officer may generate an order called as assessment order. In the assessment order, he may disallow some of the expenditure that I have claimed. If the assessing officer disallowed some of the expenditure claimed by the assessee, what may happen? There will be an increase in the profit. There will be an increase in the total income. There will be an increase in your tax liability. Your anticipated tax liability may not be correct in that case. That is the reason why nobody can calculate the tax liability correctly except when the assessment is completed. That is the reason why don't use the term taxation, use the term provision for taxation. So provision for depreciation, provision for taxation. The third one is all these things will be used by me to explain you a point under the heading verification of assets and liabilities called as how to verify contingencies and provisions. How to verify it? There is a logic behind explaining all these things to you. You can have a better understanding of the term. How do you verify contingencies and provisions if you listen this explanation carefully? Otherwise, you cannot understand that. So what are the examples of what is accounting estimate? What do you call as provision in accounts is to be technically called as accounting estimate in auditing. What are the examples of accounting estimates? Provision for depreciation, provision for taxation, provision. The third one is provision to meet warranty claims. Provision to meet warranty claims or guarantee claims. Warranty or guarantee claims. What is meant by warranty or guarantee? This is very important to you. So I appeal all of you to be very careful while listening this point. Let us assume that I am a dealer in TVs. I sell TVs. I am a dealer in electronic items, particularly TVs. So I am saying that I am a dealer in TVs. Whenever I sell a TV, I use it to provide a warranty of 2 years. A warranty of 2 years. What do you mean by a warranty. There is a lot of difference between the terms guarantee and warranty. In olden days, organizations used to provide a guarantee. If there is something wrong with the item that you have purchased, it will be replaced with a new one. That is called as a guarantee. Then what is warranty? If you encounter any problem with the item you purchase, you need to return it to the dealer. Dealer will repair it. Dealer will place that item in working condition and it will be given to you. It will not be replaced at all. It is called as a warranty. That is the difference between guarantee and warranty. I am giving only 2 years warranty on each and every TV set sold. What does it mean? If the customer faces any problem with regard to that TV set sold by me within 2 years of the date of sale, then the customer can simply return it to me. I will incur some expenditure for repair of TV set. I will deliver the item to the customer in working condition. That is the assurance that I am giving to the customer. And in a particular financial year, say 22-23, in a particular financial year, that is 22-23, I sold 1000 units of TVs. And based on my past experience, I am anticipating that 10% of the TV sets may be returned back within the warranty period of 2 years. That means I am anticipating 100 units of TV sets that may be returned back to me within the warranty period of 2 years. In that case, what should I do? When TV sets are returned to the dealer, what the dealer is required to do? The dealer is required to incur some expenditure to repair the TV set and to put it in good and working condition. So based on my past experience, I am predicting that I may have to incur an average of 500 rupees amount for repair of each and every TV set. On an average, I may have to incur 500 rupees. On an average, I may have to incur 500 rupees for repair of each and every TV set. So, I am anticipating that 100 TV units may be returned back within the guarantee period. I am also anticipating based on my past experience that I may have to incur an amount of 500 rupees per TV set for repair. That means how much is the amount that should I spend to meet my obligations? 50,000. Remember, the TV units are sold by me in the financial year 2022-23. You know very well about the concept of matching. Matching concept. What matching concept says? If you have shown revenue in a particular year, the associated expenditure is also required to be shown in the same year. So you have shown the revenue through sale of 1000 TV units in the year 22-23. Therefore, you need to debit the related expenditure to the same profit and loss account. Now what I should do? I need to create a provision in respect of warranty claims to the tune of 50,000 rupees, and this 50,000 rupees is required to be debited to the profit and loss account of the financial year in which I realized or recognized revenue through selling of TVs. That is the importance of provision to meet warranty claims or guarantee claims. Usually, as an auditor, we are made responsible. You will come across all these points in your CA final when you are going through a standard called as SA 540. The name of the standard is Auditing of Accounting Estimates, including fair value accounting estimates and related disclosures. Auditing of accounting estimates, including fair value accounting estimates and related disclosures. So, what the auditor is expected to do? The auditor should focus on the reasonableness. The auditor should focus on the reasonableness of assumptions made by the management. In the given example, I was the management. I made 2 assumptions in arriving at this amount of 50,000 rupees. What were those assumptions? Assumption number 1, I made an assumption that 10% of the TV sets may be returned back within the warranty period of 2 years. That is assumption number 1. Assumption number 2, I also made an assumption based on my past experience that I may have to spend an average amount of 500 rupees per TV set for repair. So as an auditor, you are required to focus on the reasonableness of these assumptions. Why? Because sometimes management may have made unreasonable assumptions intentionally. For example, the reasonable assumption is 10%, but the management may have taken it as 40%. If you take it as 40%, what will happen? There will be an increase in the provision to be created. When there is an increase in the provision to be created, obviously there will be a reduction in the profit and there will be a reduction in the tax liability. In that way, management could involve in fraud through fraudulent financial reporting by creating excessive amount of expenditure or provisions by taking unreasonable assumptions. By taking reasonable assumption is say 10%. If the management has taken it as 80%, then can you say that provision created by the management is reasonable? Yes or no? No. Similarly, reasonable amount that the management may spend on repair of each and every TV set is 500. If it has been taken as 5,000 by the management, then also it is not reasonable. That is the reason why I said to you that being an auditor, you need to focus on the reasonableness of the assumptions made by the management in arriving at this provision. Apart from this, the auditor should also check the arithmetical accuracy. The auditor should also check the arithmetical accuracy. Why checking arithmetical accuracy is so important for the auditor? I am the management, you are the auditor. You focused on the correct reasonableness of 10%. You find it reasonable. You also focused on the reasonableness of 500. You found it reasonable. Hence, you concluded that the amount is correct. But what I did is like this. Number of TV sets sold by me, 1000. Number of TV sets expected to be returned within the warranty period or guarantee period of 2 years is 10%. 1000 into 10%, 200. Into 500, this is 3 lakhs. I created a provision of 3 lakh rupees. Remember, you focused on 10%. You also focused on 500. You find them reasonable. Unfortunately, the auditor hadn't checked the arithmetical accuracy. Now, can you say that provision created by the management and debited to its profit and loss account as reliable or not? No. It is not accurate, it is not valid, it is not reliable. So even by doing arithmetical inaccuracies, management will try to involve in fraud. That is the reason why as an auditor, you are required to follow a procedure called as recalculation. What is that? Recalculation. What is meant by recalculation? Checking the arithmetical accuracy. Recalculating amount of depreciation, recalculating amount of managerial remuneration, etc. will fall under the category recalculation so that the auditor can ascertain, okay, what is being reflected in the balance sheet. Provision is an item of liability, yes or no? So in order to ascertain the accuracy, validity and reliability of that liability, what should you do? You need to follow procedures like recalculation, etc. That is the reason why it is said in SA 500 that these are all the procedures that are available for the auditor to obtain sufficient appropriate audit evidence to verify the accuracy, validity and reliability of assertions not only relating to balance sheet but also relating to profit and loss account. Okay. Now I will try to focus on one point. The point is, as I said earlier, to ascertain the existence, you may make physical inspection. To ascertain ownership, you may make inspection of title deeds or invoice. To ascertain the correctness of the values, of all the assets and all the liabilities, you need to inspect books and other related records. Now let us focus on the term value. I want to ask you a question. What is the skeleton of an asset account in the ledger? What is the skeleton of an accountant, an asset account in the ledger of an entity. There will be some items on the debit side. There will be some items on the credit side of the ledger. So this is the way in which furniture account is appearing in the ledger account of the entity under your audit. 2. Balance brought down. Opening balance. This much. 2. Cash or bank. These are nothing but additions made. What is that? Additions made to the asset will be debited to the asset account, and cash account or bank account gets credited. When the asset is sold, the entity may be in receipt of either cash or check. Then buy cash or bank. This is nothing but sale of asset. On sale of an asset, the entity may get either a profit or may suffer with a loss. If it gets a profit, profit is required to be credited to profit and loss account. To be credited to profit and loss account. By profit and loss account. This is nothing but dash. Profit on sale of asset. Profit and loss account are to furniture. Oh, sorry, very sorry. Okay, it is loss. Then 2, profit and loss account. Profit on sale. Profit on sale. By profit and loss account. It is nothing but depreciation. Next, by profit and loss account. This is nothing but difference on physical verification. Difference, if any, on physical verification is required to be credited. It is a loss. It is required to be credited to the furniture account, debited to the profit and loss account. And finally, by balance carry down. This is nothing but closing balance. So this is closing balance. In balance sheet, which balance appears? Is it opening balance or is it a closing balance? Closing balances will appear in the balance sheet. So the balances that appear in the balance sheet are closing balances. In the balance sheet, closing balances of assets will appear. In the balance sheet, closing balances of liabilities will appear. If you want to ascertain whether balance sheet is reflecting a true and fair view, and if you want to ascertain whether values of all the assets and values of all the liabilities are correct, what should you do? You need to check the correctness of dash balances. You need to check the correctness of closing balances. Remember, closing balance is not an isolated figure. Yes or no? Closing balance in the given example has been derived from different transactions. Simply speaking, correctness of the closing balance that appear in dash, correctness of closing balance that appear in the balance sheet is dependent upon the correctness of opening balance. It depends on the correctness of additions. It also depends upon the correctness of sales or deletions. It also depends upon whether loss or profit on sale is properly accounted for. It also dependent upon whether proper amount of depreciation is provided or not. And it also depends on whether difference on physical verification has been properly dealt with or adjusted in the books of account. If everything is correct, you can say that dash is also correct. Closing balance is also correct. When you say that closing balance is correct, you can say that balance appearing in the balance sheet is also correct. If all the balances in the balance sheet were found to be correct, you can say that valuation assertion is correct, existence assertion is also correct, rights and liabilities assertion is also correct, and hence the dash is reflecting a true and fair view. Balance sheet is reflecting a true and fair view. So to ascertain the truthness and fairness of the balance sheet, the auditor should try to verify all the assets and should also try to verify all the liabilities. That process of verification of all the assets and liabilities is technically known as verification of, that procedure is technically known as verification of assets and liabilities. Previously, there are two chapters in cainter. The first one is watching, the second one is verification. Both those chapters have been clubbed, and now the name of the chapter is given as Audit of items of financial statements. Now we are focusing on the term verification of assets and liabilities. Why should the auditor verify all assets and liabilities? Please tell me. By verifying all the assets, by following a procedure called as verification of all the assets and verification of all the liabilities, the auditor would be in a position to ascertain the correctness of the closing balance. If closing balance is correct, then in order to check the correctness of the closing balance, the auditor should focus on correctness of opening balance, additions, sales, treatment of profit or loss, depreciation, physical verification and adjustment of material differences. By checking all these things, the auditor can conclude that values that are reflected in the balance sheet are correct. Therefore, the auditor may conclude that balance sheet is reflecting a true and fair view. Now coming back to our original discussion. What is our original discussion? Now, balances appears in dash. Balances appear in dash. Balance sheet. So, what is meant by tests of balances? Checking the items appearing in the balance sheet. Checking the items appearing in the balance sheet is called as testing of balances. Testing of balances will be done by the auditor through following a procedure called as verification of assets and liabilities. So, dash can also be called as dash. Tests of balances can be done by the auditor through checking or through verifying each and every asset as well as each and every liability. That process is technically called as verification of assets and liabilities. So, balances appearing in the balance sheet can be tested by the auditor by following a procedure called as verification of assets and liabilities. So, from now onwards, you can say that tests of balances is nothing but following a procedure called as verification of assets and liabilities. Why do you follow that procedure? To substantiate. What is that? To substantiate the amounts that are being reflected in the balance sheet. The values that are, what is meant by substantiation? Checking the accuracy. Substantiate means to prove the correctness of. Checking the accuracy. For checking the accuracy of the items appearing in the balance sheet, you are following some procedures called as verification of assets and liabilities, which is a part of dash procedure. Substantive procedure. What is meant by substantiation? If you know all these things well, I would have started the chapter of verification of assets and liabilities. I would have already completed at least half of the chapter by now. So, verification of assets and liabilities is a technique or procedure that the auditor should follow to substantiate the correctness of values of assets and to substantiate the correctness of the value of the liabilities. Value is nothing but an assertion made by the management. To check the assertion of valuation, to substantiate assertion of valuation, the auditor should follow a procedure called as verification of assets and liabilities. Then what about the first one? Now you may be able to understand the first one easily. Tests of details of transactions. If you want to test, if the auditor want to test a transaction in detail, if the auditor wants to test a transaction in detail to ascertain whether the transaction has really taken place or not, whether the transaction is correctly recorded or not, with the help of supporting documentary evidences, then it is technically called as dash watching. So dash can be called as dash and dash can be called as dash. Tests of details of if you check a transaction in detail with the help of supporting documentary evidences, it is called as dash. If you do not know this, there is no point in reading essay 500 at all. If you do not understand this point, there is no point in understanding essay 500 at all, reading essay 500 at all. If you do not know this, I can say that you do not know anything about essay 500. So, tests of details means carrying out a technique called as watching. Tests of balances means carrying out a procedure called as verification of assets and liabilities. These two things have been incorporated in a chapter called as Audit of Items of Financial Statements. Financial statements include P&L account and balance sheet. For balance sheet, you will perform verification of assets and liabilities. That is test of balances. For items of transactions appearing in the profit and loss account, you will carry out watching. This is all about the importance of the term watching and verification, otherwise called as tests of details of transactions and tests of balances as appearing in essay 500. Are you able to follow me? Do you understand the importance of the checking of opening balances, additions, sales, etc.? Why we are focusing not on closing balance? Why we are focusing on the correctness of opening balance, correctness of additions, correctness of sales, correctness of treatment of profit or loss, correctness of depreciation, correctness of adjustment of differences, material differences in physical verification? If all those things are found to be correct, obviously dash would also be said to be correct. Closing balance would also be said to be correct. If closing balances are found to be correct, you can say that the balance sheet is reflecting a true and fair view. That is the reason why as an auditor, you need to follow a procedure called as verification of assets and liabilities. I'll try to provide you with 9 or 10 general points. If you are able to understand those 10 general points, I believe that no student in my class should prepare for verification of assets and liabilities separately. You should be able to write something about any given question in the examination without any preparation. That is my objective. So I will try to explain you 9 to 10 general points, and you can see any material. All the points that I explained to you under the heading general points will appear in that material in a different order. The order may be different, but the point is one and the same. I will also prove that. Okay. So first of all, let's have a discussion on general points. Whenever the auditor wants to carry out a procedure called as verification of assets and liabilities, I want to conclude watching is a procedure that is generally required to be followed by the auditor in respect of dash, in respect of items of profit and loss account. And verification is a procedure that is generally required to be carried out by the auditor in respect of dash, in respect of balances as appearing in the balance sheet. Now I am going to explain you general points relating to verification of assets and liabilities. Point number 1, obtain a list or schedule duly certified by management. Obtain, I will try to explain all these things in detail. Just I am listing down the general points that are required to be followed by you as an auditor under the heading verification of assets and liabilities. Obtain a list or schedule duly certified by management. Point number 2, verify opening balance. Verify opening balance either from previous year audited financial statements, or from previous year ledger, or from PPE register, if any, maintained by the entity. What is that? Verifying opening balances either from previous year audited financial statements or from previous year ledger or from PPE register. Point number 3, verify additions. It is a side heading. Verify additions. Under the heading verify additions, the auditor should focus on things like A. Authorization, B. Watch with supporting documentary evidences, C. Capitalization of incidental expenditure, incidental expenditure, and point number 4, entry into relevant registers. Entry into relevant registers. Point number 1, obtain a list or schedule duly certified by management. Point number 2, verify opening balance. What is that? Verify opening balance. The first point is obtaining a list or schedule duly certified by management. The second point is verifying opening balance. The third point is focusing on additions. Under the heading, you are checking points like authorization, watch with supporting documentary evidences, capitalization of incidental expenditure, entry into relevant registers, etc. This is under the heading point 3. Now, point 4, verify deletions or sales. Verify deletions or sales. Under the heading verification of sales or deletions, points like authorization, watching with supporting documentary evidences, correct treatment of profit or loss on sale, and entry into relevant register. Entry into relevant register. So under this heading, what is important is you are focusing on what? You are focusing on what? Sales or deletions. The first one is obtaining a list or schedule. The second one is verifying opening balance. The third one is verifying additions. The fourth one is verifying sales or deletions. The fifth one is verify depreciation. The sixth one is physical verification and adjustment of material differences. Physical verification and adjustment of material differences. The seventh one is verify closing balance. The eighth one is valuation. The ninth one is disclosure. That's it. If you are able to remember these points, you can write down something about any given question under the heading verification of assets and liabilities without any further preparation. So, fifth one is depreciation. We are focusing on depreciation under the heading point number 5, depreciation. Point number 6 is physical verification. Point number 7 is closing balance. Point number 8 is valuation. And point number 9 is disclosure. First of all, I will try to explain each and every point, general point in general, so that you will have a view about these points. Once you get a view on these points, I will try to focus on specific points that were covered in our material. By that time, you should be able to get some confidence that you are able to write answer for any given question under the heading verification of assets and liabilities. If you go through these general points, keenly go through these general points, you would have already identified that what I explained in the ledger, we focused on what in the ledger. Generally, we need to focus on the correctness of the closing balance. Correctness of closing balance is dependent upon what? It is dependent upon opening balance. That is the reason why there is a separate point appearing in general points called as opening balance. The second one is additions. The third one is sales. The fourth one is treatment of loss or profit on sale. The fifth one is whether proper depreciation is provided for or not. The seventh one is physical verification and adjustment of material differences. If all these points were found to be correct, then you can say that the closing balance is also correct. When the closing balance is correct, you can say that balance sheet is reflecting a true and fair view. That is the reason why you need to follow verification of assets and liabilities. Under that heading, you need to follow all these general points. Now let's have a discussion on general points. Point number 1 is very easy to understand. Obtaining a list or a schedule. Duly certified by management. In what way getting a list or schedule is helpful for the auditor to carry out the procedure called as verification of assets and liabilities. Supposing that you are the entity under audit, further supposing that I am the auditor of your entity, I asked you to provide with a list of buildings owned by you. Then the management will provide a list of all the buildings owned by them by authenticating the same. Then as an auditor, I will go through the list and I will try to identify whether there is any material value in that list or not. Supposing that the organization is having 4 immovable properties. The value of property number 1 is 1 crore. The value of property number 2 is 10,000. The value of property number 3 is 1 lakh. Value of the property number 4 is 2 crores. Now, if you were the auditor, by going through the list, what could you identify? Although there are 4 properties, out of those 4 properties, values of 2 properties are material in nature. That is property number 1 and property number 4. When item is material, obviously as an auditor you may decide to make physical verification of such properties on your own. You know very well that physical verification is not the primary responsibility of the auditor. It is the primary responsibility of the management. I made it clear to you when I am having a discussion on CARO, particularly under the heading PPE and inventory, that management is made primarily responsible for making physical verification of either PPE or inventory at reasonable intervals. As an auditor, we are made responsible just to inquire whether management made physical verification of their PPE or inventory at reasonable intervals and whether any material discrepancies arising on such physical verification have been properly dealt with or adjusted by the management. However, auditor has not been denied a right of making physical inspection or physical verification. If the value of the item was found to be material by the auditor can decide to make physical verification of assets on his own. So, some assets having high values may be selected by the auditor for making physical verification. To select such items, first of all, the auditor needs some details about the number of assets the organization held. That is the reason why, first of all, as an auditor, you need to take dash from dash, a list of assets or list of liabilities from the management duly verified by management. So, tomorrow, a question is asked in the examination like this. How do you verify buildings? Then point number 1 that you need to write down is the auditor should obtain a list of buildings duly certified by management. The question is, how do you verify plant and machinery? The auditor should obtain a list of plant and machinery duly certified by management. If it is furniture, the auditor should obtain a list of furniture duly certified by management. It is not a procedure, in fact. That is a point to be considered by you as an auditor. By going through the list, you would be able to identify which item is material, which item is immaterial, and thereby you can plan your audit accordingly. So going through list is also very much helpful for the auditor to plan his audit. Therefore, it is necessary for you, before starting the process of physical verification, before starting the process of verification of assets and liabilities, it is essential for the auditor to get a list duly certified by management. Followed or not? The second one, the auditor should focus on opening balances. I don't want to explain anything about opening balances because everything is well known to you. Yes or no? SA 510 is very well known to you. What is SA 510? Initial audit engagements and opening balances. There are two duties to you as an auditor in respect of opening balances, particularly when you are carrying out an initial audit engagement. What are they? 1, you need to check whether opening balances contains any misstatements. And 2, you need to verify whether accounting policies that were reflected in the opening balances have consistently been applied during the current period. And there is one general duty to the auditor. The auditor should verify whether closing balances of the previous year have been correctly brought forwarded as the opening balance of the current period. That is the general duty of the auditor. That general duty is applicable to auditor whenever the auditor carries out audit. This is the general duty. Current year opening balances are nothing but last year closing balances. Current year closing balance is correct or not is dependent upon current year opening balance. Whether current year opening balance are correct or not is to be checked by you from either from previous year audited financial statements or by taking a previous year ledger, or sometimes if the entity maintains a register like PPE register. I said to you that there are 11 columns in PPE register under CARO. One such column is closing balance. Closing balances of assets will appear in the PPE register. You can check the correctness of the opening balance either from, you need not write all these things in the examination. Even if you are able to write one thing out of these 3, it is sufficient. So the auditor should verify opening balances either from previous year audited financial statements or from previous year ledger or from PPE register. Then the auditor should focus on additions. Under the heading additions, the very first aspect to be checked by you is authorization. I don't want to explain anything about authorization. I said to you about what is authorization, what is general authorization, what is specific authorization, and most importantly, I also explained you what may happen if there is no system of authorization with the help of an example also. Yes or no. That's it. So, and I said to you that for purchase of asset or for sale of asset, for purchase of investment or for sale of investment, a specific authorization is required to be taken. In case of companies, that authorization is available in the form of a resolution passed by the board of directors. So to ascertain when you are carrying out the audit of a company and when you find that the company made some additions to their assets, the very first duty of the auditor is to check whether the same has been properly authorized by the board of directors, for which you need to go through minutes of the meetings of the board of directors. You need to go through the resolutions passed by the board of directors. If you find that a resolution has been passed by the board of directors authorizing the organization to purchase assets, then you can satisfy that, okay, this addition has been properly authorized. I know that the time is 9:20. Just give me 5 minutes, okay, so that I will complete all these general points. Once these general points are completed, I'll give you a break. After that, we will focus on what is given in our material. Okay, done. So authorization. The second one is watch with supporting documentary evidence. You know very well the importance of watching. Why? Because sometimes although asset may not have actually been purchased, a fictitious entry would be recorded in the books of account. Therefore, to verify whether the addition is a real addition or is a fictitious one, it is necessary for you as an auditor to watch the additions with the help of supporting documentary evidences. Point number C is not required to be explained to you at all, because every one of you know very well about AS 10, which says that all incidental, if this is not done, value appearing in the balance sheet will become wrong. If this is not, if any one of these things is not done, value appearing in the balance sheet will become wrong. For example, the purchase of asset is unauthorized. For example, the asset is not in existence, but a fictitious asset may have been included in the financial statements. You haven't carried out the watching of that addition. Or if the incidental expenditure has not been capitalized, cost of the asset is 1 lakh, incidental expenditure incurred is 30,000. How much is the value to be reflected in the balance sheet? 130. But the value reflected in the balance sheet is say only 1 lakh. Now can you say that balance sheet is correctly prepared? No. Why? Why? Because of the only one fault, one error done by the management. The error is management failed to capitalize incidental expenditure. So every point appearing here is very important and will have an impact on the truthness and fairness of the balance sheet. That is the reason why you need to check all these aspects under the heading dash, additions. And the fourth one is also well known to you. If the entity is maintaining a separate register, as and when transaction relating to fixed asset took place, that is required to be recorded not only in the journal, but also the details of which are also required to be recorded in the relevant register. This is all about verification of additions. The next one is how do you verify sales or deletions? For purchase, there should be authorization. For sale, there should be authorization. Why? Because authorization given for purchase is not applicable for sale. Authorization given for sale is not applicable for purchase, because for purchase or sale, a specific authorization is required to be taken. Specific means authorization given only for a single transaction. Similar to purchase, you need to check whether that sale is real or not by watching the same with supporting documentary evidence. Check and ensure that profit or loss on sale of the asset is properly accounted for. When purchase is being recorded in the PPE register, why can't the sale? Sale is also required to be recorded in the PPE register. That's it. Verified depreciation is well known to you. Schedule 2 to the Companies Act is known to you, and the way in which depreciation is required to be calculated is also well known to you. I know that you do not know how to calculate depreciation under Schedule 2, but because of lack of time, I cannot explain it. That is the reason why I am saying that you know very well about how to provide for depreciation as per Schedule 2. What is the formula to be used for calculation of depreciation as per Schedule 2 to the Companies Act? It's a challenge to you. What is the formula to be used by the organization by the company for the purpose of calculation of depreciation as per Schedule 2 to the Companies Act? Depreciation is equal to, I know that you don't know it. Depreciation, don't bluff me. Depreciation is equal to depreciable amount divided by useful life of the asset. What is that? Depreciable amount divided by useful life of the asset. Depreciable amount can be defined as original cost of the asset minus 5% residual value. At one level, it is called as scrap value. At one level, it is called as residual value. At one level, it is called as something else. What you get after sale of asset is called as residual value. And useful lives of different types of assets were given in Schedule 2. For calculation of depreciation, you need to make use of the useful lives that were given in Schedule 2. Don't try to apply any percentage for calculation of depreciation under Companies Act. That percentage is to be followed only for calculation of depreciation allowable under Income Tax Act, not for purpose of calculation of depreciation under Companies Act. You need to take only useful lives. And concepts like single shift depreciation, double shift depreciation, triple shift depreciation, concepts like depreciation on continuous process plant, pro rata basis, and other things were given in Schedule 2 to the Companies Act. And because of lack of time, I may not be able to explain all those things to you. If time permits, I will certainly try to explain at least a few of these concepts so that you will learn how to calculate depreciation under Companies Act. So, if you were the auditor of a company, you need to check whether company calculated depreciation by following the requirements of Schedule 2 to the Companies Act. In case of sole proprietary concerns or partnership firms, there is no such requirement, and hence they usually calculate depreciation at the rates that are allowable under the Income Tax Act. They are not required to follow the provisions of the Companies Act, and hence they do follow the rates allowed under Income Tax Act for the purpose of calculation of depreciation. And the next one is well known to you. Physical verification is not the responsibility of the auditor. It is the primary responsibility of the management. It is the responsibility of the auditor to check whether management made physical verification of its assets at reasonable intervals. To ascertain whether management really made physical verification of its assets, the auditor can go through supporting documentary evidence maintained by the management while making physical verification. If the results of the physical verification are not reliable, then the auditor can also make physical verification on his own. This point has already been explained to you. In case of material items, the auditor had to make physical verification on his own. And if all these items are found to be correct, closing balance would also be found to be correct. But it is a must to you to compare balance appearing in the balance sheet with the balance appearing in ledger. It is a must to the auditor to compare balance appearing in the balance sheet with balance appearing in the ledger. Why? Because under section 143 subsection 3 of the Companies Act, the auditor is declaring to the readers of the financial statements that what is disclosed in the P&L account and balance sheet are in agreement with the books of account. Do you remember that? Are you able to recollect it? 143 subsection 3. The auditor made a declaration to the users of the financial statements that what is appearing in the balance sheet and what is appearing in the books of account are in agreement with one another. When you want to make such a declaration, first of all, you need to make a verification. That is the reason why I said to you that you need to compare what is there in the ledger with what is there in the balance sheet. That is about verification of closing balance. And the next one is valuation. You know it very well. Relevant accounting standards are to be followed for the purpose of valuation. If the entity fails to follow relevant accounting standards, it is said that value is incorrect. And finally, disclosure. I said to you about what is a misstatement. Two definitions of misstatements have been given to you. One is a simple definition wherein I said to you that misstatement may arise either because of omission or because of a wrong statement. The other definition given to you under the heading misstatement is if there is a difference between amount, presentation, classification or disclosure of a reported financial statement item and amount, presentation, classification or disclosure to be made in accordance with applicable financial reporting framework. If there is a difference between amount to be shown and amount actually shown, classification to be made, classification actually made, disclosures to be made, disclosures actually made, presentation to be made, presentation actually made. That difference is technically called as misstatement. If the misstatement is material, then it will be treated as material misstatements, which will have an impact on the truthness and fairness of the financial statements. In that case, you are expected to give a modified opinion. Write about question number 18. Write about audit of fixed assets. Previously, several points were included in our material under the heading fixed assets, like how do you conduct audit of or verification of land, how do you conduct verification of building, verification of plant and machinery, verification of furniture, verification of motor vehicles, verification of railway sidings. These are all were included under the heading fixed assets. And I use it to explain the points for each and every asset in detail. But fortunately, now all the assets have been clubbed into only one group, and hence the general points that I discussed with you are now more important for you. Although it is given in the CA Institute material as well as in this material about how to conduct audit of fixed assets, there is every chance that sometimes you may be asked to mention the audit procedures that are required to be followed for verification of land or building or plant and machinery or furniture or motor vehicles or other things like railway sidings, etc. However, I want to make you clear about one thing. The thing is, all the general points that we discussed are not applicable for everything. For example, if you are made responsible to check goodwill, you cannot write the auditor should obtain a list of goodwill duly authorized by management. There is no list for goodwill. Similarly, the auditor should make physical verification of goodwill, and any material discrepancies arising on such a physical verification have to be properly dealt with or adjusted. That is not at all applicable, because after all, you are checking an intangible asset, physical, which cannot be seen and checked, touched, and hence the point relating to physical verification of goodwill or list of assets is not applicable. So you need to make use of your wisdom while applying such general points relating to verification of assets and liabilities. As said earlier, you can go through any material available in the market. You will find only those points that I explained to you under the heading general points relating to verification of assets and liabilities, but the order may be different. The headings given in the material may be different, but points are the same. I will try to show you all those points under the heading write about audit of fixed assets. Point number 1. First of all, the auditor should take a list of assets duly certified by management. After that, the point number 2 is additions to fixed assets. What is that? Additions to fixed assets. That is given under the heading completeness. Point number D under the heading completeness. The auditor should first of all obtain a list of all additions from management. For additions during the period under audit, obtain a list of additions from management. That is point number D. Point number E. For all material additions, the auditor should verify whether such expenditure is to be treated as capital expenditure or revenue expenditure. What does it mean? Whether the accounting treatment of that addition made is correctly done or not, bifurcating it between capital expenditure and revenue expenditure. See point number G. The auditor should verify whether PPE additions have been approved by appropriate entity personnel. What is meant by approval? Approval can also be called as authorization. So under the heading additions, you find the point called as list. Under the heading additions, you also find a point called as authorization. What were the points that I said to you under the heading additions? Auditor should check whether additions are properly authorized or not. 2. The auditor should also watch the additions with the help of supporting documentary evidences. Thereby you can ensure about two things. One, whether the addition is real or not. Second one, whether the expenditure incurred is a capital expenditure or a revenue expenditure. Next, while this is a general point which was not explained, but you can verify that point, you can read and understand that point, which is very easy to understand. The auditor should verify whether proper internal controls have been established by the management in respect of such additions, like inviting competitive quotations or tenders. You know very well about invitation of competitive quotations or tenders. I said to you under the heading propriety audit, under government audit, that usually an organization is required to call for quotations or tenders. They need to identify the lowest quotation or tender. Then they need to purchase the items from that party, so that the purchase made by you are said to be economical. In fact, in reality, when we are conducting audit of a private organization, it is not necessary for us to verify whether the purchases are made at economical prices. Economy audit is required to be followed by you only when you are a comptroller and auditor general, and sometimes when you are carrying out audit of a cooperative society, then also you need to follow the rules of propriety. Here it is not required for the auditor to follow the rules of propriety. But in order to ascertain whether the additions are real or are fictitious, if the additions are real, the organization would have called for dash or dash. Quotations or tenders are nothing but supporting documentary evidences. Do you agree with this point or not? So, what is point number 1 under the heading additions in our discussion? First one, authorization, that is appearing here. Second one, watch the additions with supporting documentary evidences like quotations, tenders, invoices, and the like. That is also there. The third one is ensuring that all incidental expenditure have been properly capitalized. The fourth one is recording into the PPE register. That will also be specifically mentioned somewhere in this point. This is all about additions. So point number D, point number E, G and H are additions. And another important point that I missed is when the fixed assets are constructed, self-construction is done in respect of fixed assets. Installation expense, installation certificate is a must. Why? Because up to the date of installation, any expenditure incurred is required to be capitalized. After the date of installation, once the asset is put to use, any expenditure incurred in relation to that asset is generally considered as revenue expenditure, unless the expenditure is capable of creating some cash inflow to the entity, additional cash inflow to the entity. So up to which point of time expenditure is required to be capitalized, and up to which point of time the expenditure shall be considered as revenue is purely dependent upon the date of installation. Therefore, if the assets were found to be self-constructed, it is our responsibility as an auditor to take installation certificates, particularly the date on which installation is completed. Once the auditor knows about the date of installation, then the auditor can check and ensure that all the expenditure incurred up to the date of installation certificate have been treated as dash, have been treated as capital expenditure, and any expenditure incurred after that has been treated as revenue expenditure. General maintenance expenditure is nothing but a revenue expenditure. General repairs is nothing but a revenue expenditure. Done. So these are all the points relating to dash. Are you able to follow me? These are all the points. Are you able to correlate what is discussed under the heading general points with what is there in the material? So these are all general points. These are all relating to additions. The next point is relatable to dash. deletions. You need to focus on additions. You need to focus on deletions. What aspects do you check as an auditor under the heading deletions? Authorization, very good. Understand from the management, it's a general point. Understand from the management the reason and rationale for deletion and the manner of disposal. Usually, a note will be prepared by the management at the time of authorizing the deletion. At the time of authorizing the deletion, a note will be prepared by the management called as discard note. I said it to you as authorization by management. They are saying it as authorization is given by the management in the form of preparation of a note called as dash, a discard note. So where the auditor observes that the entity under the audit has sold some items of assets, it is necessary for you as an auditor to verify whether such sale has been properly approved or authorized by a responsible official. In order to check whether sale is properly approved or authorized, you can go through either the minutes of the meetings of the board of directors, or else you could go through a separate documentary evidence available to the auditor, particularly with reference to deletions, called as dash. Discard note. Now read that point again. Point number 1 is general in nature. First of all, the auditor should try to understand the reasons why or rational behind deletion of the asset or disposal of the asset. And the second one is obtain management approval and discard note. Auditor should obtain management approval and discard note authorizing discard of the asset from its active use. You need to, the same point is appearing both under the heading additions and deletions. Auditor should verify internal controls for sale of discarded PPE, like calling for tenders, and finally verify that management has accurately recorded the deletion of PPE. Where should the auditor verify deletion of PPE? In the books as well as in the PPE register. An entry is required to be recorded with regard to deletion. You need to check whether deletion has actually taken place or not with other supporting documentary evidences. This is about dash and dash. Additions and deletions. And what I said to you, like watch, has been covered under this heading, under the heading rights and obligations. The auditor shall verify that all PPE purchase invoices are in the name of the entity that entitles legal title of ownership to the respective entity. So what does it mean? You need to watch addition of PPE into cash book with the help of supporting documentary evidences. What documentary evidences are available to the auditor in respect of additions to assets? If it is immovable property, documentary evidence is available in the form of title deeds. If it is a movable property, documentary evidence is available in the form of invoice. So the auditor should, are you able to correlate the things that we discussed with what is appearing here? If you are unable to correlate, I will do one thing. Please try to focus only on what is given in the material. I will be able to explain you everything what is given in your material, but it may take another half an hour more time. That's it. Right. So for the auditor shall verify that all PPE purchase invoices are in the name of the entity. When you find that invoices are in the name of the entity, you can conclude that the entity is the owner of the asset, and that entities that entitles legal title of ownership to the respective entity. This is with regard to movable properties. If movable properties are purchased, you need to go through invoices. The best example is, if plant and machinery is purchased, you need to check the ownership through going through invoices. For all additions to land, building in particular, the auditor should obtain copies of conveyance deed or sale deed. We call it as dash. Title deeds to establish whether the entity name is mentioned therein. So what you need to understand from reading these 2 points is, these 2 points are nothing but point number B in our side heading additions. What is point number 1? Authorization. What is point number 2? Watch the additions with the help of these supporting documentary evidences. Are you able to find those points here? Right. Point number C is incidental expenditure are required to be capitalized. For to ascertain up to which point of time the expenditure are required to be capitalized, you need to insist the management to provide some installation certificates with regard to the date of installation. Next, this point is also relevant to this. The auditor should insist and verify original title deeds for all immovable properties held. Sometimes management may say that the title deeds of the immovable property are not available with them because they have taken some loan and such immovable properties have been offered as security. If your client says that title deeds, you want to make inspection of title deeds, your client is saying that title deeds are not available with him. You ask for the reason why the client is not holding title deeds. The client has given a reply saying that we take some loan from a bank and offered this property as security, and all the title deeds of the property have been deposited with the bank. In that case, if you were the auditor, in order to ascertain whether really the title deeds have been deposited with the bank, what will you do as an auditor? Your client is saying that title deeds are not available with him. You want to make physical inspection of title deeds. Your client also says that title deeds have been deposited by them with the bank because they have taken a loan from the bank and offered such a immovable property as security to the banker. In that case, what will you do as an auditor? If I were the auditor, I would try to follow external confirmation procedures with the banker, asking the banker to confirm me about whether they are holding title deeds of so and so property relating to so and so party. When the banker has given a confirmation, I can rely on that. You know very well that external confirmation is a procedure that can be followed by the auditor not only for confirmation of debtor balances, it can be equally applicable for the following: for confirmation of debtor balances, creditor balances, bills receivable balances, bills payable balances, bank balances, loan balances, inventories held by third parties, investments held by third parties, title deeds held by third parties. What is that? Title deeds held by third parties, to confirm about the provisions of any contract or agreement and to confirm that there is no side agreement. For all these things, you can follow external confirmation procedures. Out of that, what is relevant here is title deeds held by third parties. So in the given case, title deeds of the property of the organization were held by banker. Banker is the third party. In order to ascertain whether title deeds are really deposited by the organization with the banker, what the auditor should do? Auditor need to follow SCMPE 5 external confirmations. Read it. Point number 4. In case the entity has given such immovable property as security for any borrowings and the original title deeds are not available with the entity, the auditor should request the entity's management for obtaining a confirmation from the respective lenders that they are holding the original title deeds or immovable property as security. In fact, if the entity under your audit is a company, you can also check it with the help of registration of charges made by the company. You know very well about the provisions of the Companies Act relating to charges. Whenever any company offers any of its property as security to any lender, it is said that the company has created a charge. When company created a charge, the company is required to get itself registered with the Register of Companies by filing an application form with the registrar in prescribed format and by paying some prescribed fees. When the registrar records the same in the books of account, then registrar will give you a certificate to that effect. And after getting such a certificate, it is the responsibility of the entity to record the details of such charge created in a separate register maintained by them called as Register of Charges. So, when the entity is saying that they have offered some property as security and the title deeds are available with the banker, first of all, you will try to check whether Banker is really holding such title deeds by communicating with the banker. If the banker is not responding, then what the auditor could do? The auditor can simply go through register of charges. The auditor may even insist the management to provide certificate given by the registrar of companies confirming that a charge has been created on so and so lender. When you go through the certificate and find that a charge has actually been created in the certificate of charge, then you can satisfy that okay, what is said by the entity is right. Although you haven't received any confirmation directly from the banker, you can satisfy that this transaction has really taken place. That is the way in which you can try to confirm it. This is the point that has been discussed under SA 505 also. Under SA 505, auditor should make a request to the management to allow him to follow external confirmations. If the management allows, then only the auditor can follow external confirmations. Otherwise, the auditor cannot do that. Sometimes management may not allow the auditor to follow external confirmations. That is scenario number 1. In scenario number 2, the management may have allowed the auditor to follow external confirmations. The auditor may have followed positive form of confirmation, but unfortunately the other party may not have responded to the auditor. When you follow positive confirmation request and when the other party has not responded to you, what the auditor should do? The auditor had to follow up the matter with the respective party again and again. Even after writing 2 or 3 letters to the other party, if the other party has not responded, what does it mean? It seems nobody is able to recollect what has been discussed or what is known to you under SA 505. Auditor got a doubt about the correctness of a particular balance of the debtor. Auditor wants to follow external confirmation procedure. For that, auditor need to take prior permission from the client. Without taking permission from the client, you cannot follow external confirmation procedures. So you requested the client to allow you to follow external confirmations. Client has not allowed you to follow external confirmations. What is the impact or effect of non-allowance or not rejection made by the client to allow the auditor to follow external confirmations? The auditor may not be able to follow them, and hence the auditor may not be able to obtain relevant information and explanations. Then it is said that the auditor failed to obtain sufficient appropriate audit evidence. Sometimes the client would have allowed the auditor to follow external confirmations. The auditor have followed external confirmations through positive confirmation request. The other party has not responded. The auditor followed up the matter with the other party. Again, the other party has not responded. What is the impact of that? Again, it is said that the auditor failed to obtain sufficient appropriate audit evidence. That means in both the cases, that is when the management rejected the auditor to follow external confirmations, or not allowed the auditor to follow external confirmations, or where the auditor has not received any response. That non-receipt of response by the auditor from the third party has been called as non-response in case of SA 505. Yes or no? What is non-response? Failure on the party, on the confirming party, either to respond or to fully respond to a positive confirmation request, or the confirmation request returned undelivered to the auditor. What is that? Confirmation request returned undelivered to the auditor. You have followed positive form of confirmation. The other party has not responded. It is called as non-response. The other party responded, but the other party has not fully responded. You asked the other party about whether the balance existing in your books of account is also 1 lakh or not. The other party has simply given a reply saying that no. When the other party is in disagreement with the balance specified by the auditor, what the other party is expected to do? He needs to specify what is the balance appearing in his books of account. Instead of specifying the balance in his books of account, he simply said no to the auditor. In that case, it is said that the other party has responded to the auditor, but has not fully responded to the auditor. If the other party fails to respond, it is called as non-response. If the other party has not fully responded, then also it is called as dash, non-response. Sometimes, for a positive confirmation request, if you send a negative confirmation request, there is no obligation on the other party to respond. The other party is required to respond only when he is in disagreement with the balance specified in the letter. That is the reason why the term positive form of confirmation has been used. Sometimes the letter written by you may have been written back to you saying that the whereabouts of the addressee were not known. When the letter written by the auditor gets returned undelivered to the auditor, it is not a response. It is a letter written by you which has been reverted back to you because the other party is not there at that location. In those cases, what the auditor should do? The auditor should try to get required information by following alternative audit procedures. What is that? This is the best example of an alternative audit procedure. You try to confirm the existence of the title deeds from the banker. Banker has not responded. In that case, what the auditor can do? The auditor can simply go through registration of charges and the certificate given by the register of companies saying that so and so charge has been created on the assets of so and so company in favor of so and so lender. It is an evidence that the company has taken loan and the same have been offered as security to so and so lender. That is called as alternative audit procedures. Read it, the last one. In addition, the auditor should also verify the register of charges available with the entity to assess the PPE that has been given as security to any third parties. So these are all nothing but points relating to watching of the purchase or additions with the help of supporting documentary evidences. And if the documentary evidence is not available, what other procedure should the auditor follow? They have been explained under the heading dash and dash. Rights and obligations. Are you able to correlate? Yes or no? What are the points that we discussed under general points are being appeared here also, but the nomenclature, the wording may be somewhat different, but the point is one and the same. Now, I completed discussion on additions. This is a point relating to additions, deletions. This is the point relating to deletions. These are all nothing but watching of both additions and deletions. Next, valuation is very well known to you. There is nothing to explain to you under the heading valuation because everything is known to you. Valuation is dependent upon two things. First one, valuation is dependent upon whether the entity followed relevant accounting standard or not. The second one is if the entity provides for proper amount of depreciation, then only valuation is said to be correct. Correctness of valuation is dependent upon whether proper amount of depreciation is provided or not. It also depends upon whether the entity followed relevant accounting standard. I will try to read, just read. I don't want to explain it. I will try to read it, and I am sure every one of you are able to understand this. If you are having any problem or issue in understanding even one of these points, feel free to ask me. I will try to explain it for 1 hour. No problem in it, right?
Hello everyone, greetings of the day. Now you can purchase CA Inter Auditing regular batch videos from our Masterminds online classes app. These videos are taught in 100% English by Professor Sharma sir, having 23 years of rich experience in teaching the subject. Here you will find 175 hours of detailed videos covering all the chapters applicable for November 23 attempt recorded as per 2017 scheme. These are all latest recordings which are recorded in the classrooms but not in the recording theaters. You will find crystal clear detailed explanation for every concept in the subject, and you will definitely have a very good experience which you have never experienced earlier with regard to auditing subject. You can get these HD quality audio video lectures from our Masterminds online classes app. If you are an Android user, please install Masterminds online classes app, and in the search you please search for CA Inter Auditing in the store section. If you are an iOS user, please install Class Plus app and enter our organization code MJGUN and search for CA Inter Auditing in the store section. You can find the links to directly purchase these videos in our comment section. And you have 3 exciting convenient options to buy this course. Option 1, you will have 175 hours of videos for 6 months at 2 views, and the material will be couriered to you, and at the same time you can have PDF material on the screen, and option 1 is available for 5,000 rupees. And option 2, the same duration, 1 month, 1 view for 1,000 rupees, but PDF material only can be read on the screen. And you have option 3 For 175 hours, 3 months, 2 views, material will be couriered, and you can also have PDF material on the screen available for 3000 rupees. We hope this course will be of great help to you. All the best. Happy learning.
Valuation part. And if you keenly observe, you would have identified the terms like existence, completeness, rights and obligations, and valuation. All these things are nothing but dash. Assertions made by the management to the auditor in relation to their items of balance sheet. So you need to check whether all those assertions are correct or not. How do you check the correctness of assertions? By following all these audit procedures. By following all these audit procedures. Are you able to follow the flow of the point? Right. And the last but one is valuation. The auditor should ensure that PPE has been valued by following generally accepted accounting principles. What are generally accepted accounting principles in India? AS or NDAS. That is the reason why I said to you that you need to check whether the entity followed the governing accounting standard for the purpose of valuation of the assets. If it is a PPE, they need to follow AS 10. If it is investment, they need to follow AS 13. If it is an inventory, they need to follow AS 2. Like that, whether gap has been followed or not is to be checked by you as an auditor to ensure about the correctness of the values that are being reflected in the balance sheet. The auditor should verify that the entity has charged depreciation. Is the point depreciation covered in our general points? Yes, depreciation on all items of PPE. And these points are nothing but a further explanation to the term depreciation. Point is completed. You need to check whether proper amount of depreciation has been provided. That is the point to be checked by you as an auditor. All other points that are appearing in your material are nothing but an explanation about what is depreciation, how it is to be provided for, etc. You can just go through it and you can accept my explanation. A variety of depreciation methods can be used to allocate depreciable amount of an asset on a systematic basis over its useful life. These methods are straight line method, diminishing balance method, units of production method, etc. The entity select such method that most closely reflect the expected pattern of consumption. Method should have been applied consistently from period to period. The auditor should also verify if the management has undertaken impairment of assets is also known to you, whether the same have been properly recorded in the books of account. So the only point that is covered, it is not only point, there are 2 points, most important points that were covered under the heading valuation are whether entity followed gap in valuing the asset, and the second one is whether entity provided for proper amount of depreciation. By this, you can understand that points like valuation is covered, yes or no. Next, depreciation is covered, yes or no. Sales or deletions are covered, additions are covered. Obtaining a list is a common point that was also covered. Opening balance is also covered. You can check the opening balance, without which you cannot ascertain the correctness of the closing balance. That will also be mentioned somewhere in the material. Right. Now, this is about all about valuation. So valuation is completed, rights and obligations is completed, additions, completeness. This is a general point. This is nothing but reconciliation. What is that? Opening asset, value of the asset plus additions made during the year less deductions is equal to closing balance. Additions to PPE during the period under audit have been properly recorded. Verify movement in the PPE schedule asset wise like building, plant and machinery, etc. compiled by the management, that is opening plus additions minus deletions is equal to closing. Next, check the arithmetical accuracy of the movement in PPE schedule. Tally the tally the opening balances to the previous year audited financial statements. Opening balance is covered. How to verify opening balance? Either from previous year audited financial statements or from previous year ledger or from PPE register. What he is saying, you need to verify opening. In fact, all other points are dependent upon this point. What is that point? Movement. Movement of PPE means you need to check the correctness of opening, you need to check the correctness of additions, you need to check the correctness of deletions, thereby you can ascertain the correctness of closing balance. For that, you need to verify opening balance with previous year audited financial statements. Point relating to additions is completed. Point relating to deletions is completed. Point relating to closing balance is also completed. Closing balance appearing in balance sheet should be checked with the balances appearing in the ledger to ensure that they are in agreement with one another. That's it. Now, completeness point is also completed, and ensure that assets belongs to third parties. This point is understandable to you only when you are having knowledge of SA501. Sometimes the asset belonging to some other person may be held by the organization. In that case, such assets cannot be treated as assets of you. I have given you an amount of 10,000 rupees and I asked you to keep with you till I ask it further. And can you treat that amount as yours? Certainly not. You need to keep it aside and you need to maintain separate record for that. Similar to that, sometimes some of the fixed assets of the other entities may have been held by the entity under audit. Such assets cannot be considered as their own assets and a separate record is required to be maintained for that purpose. Ensure that the assets belong to third parties are not included in the fixed asset register and separate record is maintained for that. With this, 3 points are completed. Completeness, rights and obligations, and valuation. There is no rule that you must write only in the way that is appearing in the material. You can write in a general way like the one that I discussed earlier. And the first one, existence. How do you check the existence of a fixed asset? That's it. Over. Physical verification point is also completed. To establish the existence of fixed assets at the year end, obtain PPE physical verification report. Who made physical verification? Who is made responsible for making a physical verification of assets? By the management. So you need to obtain physical verification report done by the management backed by working sheets. Then you need to verify whether each and every asset is properly tagged and carry identification marks or numbers. This is a point which is easy to understand. Auditor should reconcile items of PPE that are physically verified with fixed asset register maintained by the entity as at date. After all, the basic objective of physical verification is the basic objective of physical verification done by the management is, I said you, 2 objectives behind making physical verification of any asset by management. The first one is a reconciliation between book quantities and actual quantities. The second one is to safeguard or to protect the assets of the organization by creating a moral check on the employees. How do you do reconciliation? Physical quantities of assets checked by the management should have to be compared by the management with the quantities as appearing in the PPE register or fixed asset register. The same may be repeated by us as an auditor. You can go through physical verification sheets prepared by the management. Then you can start comparing the quantities appearing in the physical verification sheets prepared by the management with the quantities that are appearing in PPE register. Are you able to follow the actual process? Who is made responsible for making a physical verification? Management would have already made physical verification. What is your responsibility as an auditor? Take the related papers from the management. Then try to reconcile the quantities appearing in such papers with the quantities appearing in PPE register. If they don't tally and if those differences were found to be material by the auditor, what the auditor should do? Auditor should check whether such material differences or discrepancies have been properly dealt with or adjusted by the management. If I try to explain these points and if you try to listen these points, either you are unfit or I am unfit. Why? Because all these things have been discussed with you under CARO. What is the duty of the auditor under CARO relating to PPE? You need to verify whether the entity is maintaining proper records relating to PPE. That is duty number 1. Duty number 2, the auditor should also verify whether management has made physical verification of its PPE at reasonable intervals, and any material discrepancies arising on such physical verification have been properly dealt with or adjusted by the management. That point is not new to you. This is known to you, right? So, what is meant by tagging? I cannot actually explain you what is tagging here. If you know SCA 501, you know what is tagging. Usually the term tagging is associated to physical verification of inventory. Authorization, usually a responsible official in the organization shall have to authorize any addition of any type of asset. In case of the companies, such an authorization is available in the form of a resolution passed by the board of directors. In case of a partnership firm, it may be available in the form of a resolution passed by the partners. For that purpose, you need to go through the minutes book of the meetings of either the directors or the minutes book of the partners of the partnership firm to ascertain and to satisfy that such additions made are authorized properly or approved properly by a responsible official. You know very well about what is authorization, what are the types of authorization, and most importantly, what may happen if a particular transaction is not properly authorized. The point has been explained to you with the help of an example also, wherein I proved that if there is no system of authorization, the possibility of occurrence of frauds would be very, very high. That means if you are able to establish a system called as authorization, you can reduce the possibility of occurrence of frauds. Hence, I said to you that authorization is nothing but a part of internal control systems. So that is point number 1. Point number 2, some items of assets may be directly purchased, whereas some other items of assets may be self-constructed. Some items of assets may be directly purchased, whereas some other items of assets may be self-constructed. The best example for both the things is building. A building which is already constructed may have been purchased by the entity under your audit directly. Yes or no? In that case, you need to verify not only the purchase price of the building, but also all other incidental expenditure incurred by the organization in bringing that building to the existing position and condition have been capitalized or not. That means purchase price of the building, registration charges, stamp duty, etc. If you pay some commission or brokerage to a middleman, then such commission or brokerage paid to the middleman, everything is required to be added to the cost of the asset. That addition of incidental expenditure to the cost of the asset is technically called as the capitalization. This is with respect to assets which have been directly purchased. The assets so purchased may be either a movable property or an immovable property. If it is a movable property, you need to watch the purchase of asset with the help of supporting documentary evidences available in the form of invoice and other documentary evidences. In case it is a movable property, you need to check the same with the help of title deeds of the property. There are 2 to 3 things which are relatable to title deeds. The most important one is when you insist the management to provide title deeds of the property, and when the management is able to provide it, there would not be any problem to the auditor. But sometimes management may give a reply to the auditor saying that title deeds of the property have been offered as security to the property may have been offered as security to the banker, and hence title deeds of the property have been deposited with respective banker. In such case, it may not be possible for you to verify the title deeds. In such case, it is necessary for you to communicate with the banker and try to ascertain whether title deeds are whether property is really offered as security or not, and whether title deeds are really held by the banker or not. When the auditor tries to communicate with the banker, in most of the cases, auditors do get some response from the bank. However, sometimes the auditor may not be in a position to get any response from the bank. When you fail to get any response from the bank, that means you fail to obtain relevant information and explanations or audit evidence. When the auditor fails to obtain sufficient appropriate audit evidence, the auditor should not leave that matter. The auditor is required to follow alternative audit procedures to confirm that matter. I said to you that the alternative audit procedure available to the auditor in the given case is that the auditor can go through the certificate issued by Registrar of Companies on registering charge on the assets that have been offered as security. So you need to go through the certificate given by Registrar of Companies, or else you could go through this register of charges that is being maintained by the entity, so that you will get some information about whether that property is really offered as security or not. And another way through which the auditor can verify this is through verifying online records. In AP, there is a website called as igrs.ap.gov.in, and if you provide some details of your removable property, the name of the owner and other details will appear in the website. That website is being maintained by Andhra Pradesh state government. So where the entity under audit is claiming that they are the owners of some immovable properties, but the entity is unable to provide supporting documentary evidences for the same for reasons beyond their control, it is necessary for you as an auditor to go through and to check whether the entity is really the owner or not by checking online records. This is the way through which the auditor can try to get additional information or try to get information by following alternative audit procedures. This is about point number 2. The first one is authorization. The second one is watch with supporting documentary evidences. The third one is already known to you. And another important thing which I missed from my discussion in the previous class is sometimes the asset may be self-constructed. There is a few differences between direct purchase of asset and self-construction of asset. The first difference is in documentary evidences. If you purchase an asset directly, if you purchase a building directly, then documentary evidence is available in the form of title deeds. If you have made self-construction of the building, then documentary evidences are available in a variety of ways. Like if you make some payment towards purchase of cement, iron, etc., documentary evidence may be available in the form of invoice. If you make some payment for purchase of sand from the government, documentary evidence may be available in the form of cash receipt issued by eSeva or MeSeva Center. If you make some payment to the laborers, then documentary evidence is available in the form of a voucher signed by the laborer. Like this, for every type of expenditure, there would be some supporting documentary evidence. It is your responsibility as an auditor to watch that construction cost with the help of supporting documentary evidences. And the auditor had to ensure that not only direct expenditure, but all indirect expenditure. The wording is different. If it is a direct purchase, you need to verify and satisfy that all incidental expenditure incurred by the organization in bringing that asset to its existing position and condition have been capitalized. If it is a self-construction, you need to check whether all direct and indirect expenditure have been properly capitalized. You know very well about AS 16 borrowing costs, wherein any amount of interest paid by you before completion of construction of an asset had to be capitalized. It is not a direct expenditure, it is an indirect expenditure. So both the direct expenditure as well as indirect expenditure are required to be capitalized. Whether that has been done by the entity or not should also be verified by you. And the most important thing is, any expenditure incurred up to the date of installation is required to be capitalized. Expenditure incurred after the date of installation is generally considered as general repairs and maintenance, that has to be treated as revenue expenditure. Therefore, you need to verify whether proper distinction has been made with reference to capital expenditure and revenue expenditure. For that purpose, you need to obtain a certificate from the management with regard to the date of completion of construction or date of completion of installation. If it is building, you can call it as date of completion of construction. If it is a plant and machinery, you can say that it is nothing but date of installation. You need to take a certificate from the management, and by going through the certificate, you can identify the date of installation or date of completion of construction. Up to the date, any expenditure incurred shall have to be capitalized, and after that date, if any expenditure is incurred, it shall have to be treated as a revenue expenditure. And the most important thing is, as and when you purchase an asset, as and when you sell an asset, not only you are expected to record an entry into journal, you are also required to record the details of, not an entry, the details of such assets sold or such assets purchased in a separate register to be maintained called as PPE register. You know very well that for companies, maintaining a PPE register is a must. Because if for a company, CARA is made applicable, what the auditor is required to do? The auditor should verify whether the company is maintaining proper records relating to its fixed assets, including therein quantitative details and location or situation of the fixed assets. So for some types of companies, maintaining a PPE register is mandatory. Therefore, if the entity under your audit is required to maintain a fixed asset register mandatorily, it is your responsibility as an auditor to check such a register and to satisfy that the details of the assets so purchased or self-constructed have been properly recorded in that register. These are all the things that I explained to you under the heading dash. Additions. What is point number 1? Watch. Point number 2, capitalization of incidental expenditure in case of direct purchase, treating both direct and indirect expenditure as capital expenditure in case of self-construction. The fourth one is entry into relevant register. The second one is watch the additions with the help of supporting documentary evidences. You know very well that documentary evidences available to the auditor may vary from situation to situation. This is about additions. The same points are made applicable even in case of deletions. I said to you that in case of deletions also, you need to verify whether a deletion has been properly approved or authorized by a responsible official. Then you need to watch the deletion with the help of supporting documentary evidence. Generally, a note will be prepared by the management of the entity and it will be approved, called as discard note. That discard note is said to be a supporting documentary evidence, because nobody can say that this asset is useless and we need to sell it off. The same should be approved by a responsible official, then only the asset can be sold. That is the reason why you need to verify whether a discard note has been prepared. Instead of writing the term discard note, you can also write that the auditor should check whether a resolution has been passed by the board of directors or other persons approving the sale of the asset. And once the asset is sold, you need to watch the sale of asset with the help of supporting documentary evidences. It also includes focusing on impairment of assets. Then if you sell an asset, you may either get a profit or suffer with a loss. It is the responsibility of the auditor to check whether such profit or loss has been properly accounted for or not. Similar to the additions or purchase, you need to verify and ensure that details of the assets so sold has been recorded in the PPE register. Apart from that, you need to verify whether depreciation has been properly provided for or not, whether asset has been valued in accordance with applicable accounting standards in India, whether disclosure of asset is properly made or not. These are all the things that the auditor need to focus on. I know very well that these points have been explained in the yesterday's class, but I want to repeat those points so that you may have some more idea about the general points that are required to be written by you in the examination under the heading verification of assets and liabilities. At the end of the day, you will recognize that what is discussed under the heading general points is more useful to you in writing an answer in the examination than what is given in your material. Therefore, this discussion is of utmost importance, and try to understand this discussion, try to understand the soul of the discussion. Now you can read this question. It will be easier for you to understand the question. So what is point number 1? Take a list. The list is called here as verify the movement in the PPE schedule compiled by management. That is opening balances plus additions minus deletions is equal to closing balance. Then opening balances should be checked by the auditor with previous year audited financial statements. The next one is list of additions is required to be taken. Ensure that there is a distinction made between capital expenditure and revenue expenditure. Check installation certificate or report. Ensure that additions have been properly approved by the management, and most importantly, while making purchases, ensure that quotations or tenders have been called for. These are all nothing but the points that you need to focus in respect of additions. So primarily you focused on opening balance, later on additions, later on deletions. The next one is relating to deletions. This is relating to deletions, and some points under the heading additions were given here under the heading rights and obligations. You need to verify and ensure that the invoice is in the name of the entity. That is nothing but you are carrying out watching of the addition. Then if it is a immovable property, go through the sale deed or conveyance deed. Next, original title deeds should be verified. If they are not available with the entity, follow external confirmation procedure. Otherwise, go through register of charges. I told you another point wherein you can check the online records as well. This is about rights and obligations. And the next one is the auditor should verify whether proper amount of depreciation has been charged. The remaining thing is not at all relevant for our discussion. And the another important point is you can check whether the asset is physically verified by the management, and any material discrepancies arising on such physical verification have been properly dealt with or adjusted by the management. That's it. You can also verify closing balance. Compare the closing balance as appearing in the books of account with as appearing in the financial statements. So same procedure, same pattern is required to be followed by you for writing any answer given under the heading how do you verify an asset. Particularly these points are more relevant for conducting audit of fixed assets, whether it be movable property or it be immovable property. Then we had a discussion. By this, I completed a repetition of right about audit of fixed assets. Then we had a discussion about how to verify the how to verify contingencies and provisions. I cannot repeat what I said in the previous session because we had lot of discussion about what is contingency, what is provision, and what is the relationship between contingency and provision. I have given you several examples for provisions like provision for depreciation, provision in respect of warranty claims or guarantee claims, provision in respect of taxation, provision in respect of pending lawsuits, etc. And whenever there is a lawsuit pending against you, it is your responsibility as a management to have a communication with the entity's lawyer to ascertain the probable future outcome of that appeal or litigation pending against you. The lawyer may sometimes say that there is a high probability of losing the case. In that case, the lawyer may also provide some guidance to the management with regard to the amount of penalty that may have to be paid by the organization when they lose the case. That amount is nothing but a loss which is being predicted. When you are predicting a loss by following the policy of prudence, you need to provide not only for actual losses but also for anticipated losses. So as suggested by your entity's lawyer, you need to create a provision in respect of pending lawsuits. Organization is required to create a provision in respect of pending lawsuits, particularly where the lawyer says that there is a high possibility or high probability of losing the case. When the lawyer says that the probability of losing the case is remote, in that case, there is no need on the part of the entity to create any provision, but such a liability has to be shown or disclosed as a contingent liability in the balance sheet as a footnote. I also said to you that it is the responsibility of the management to identify contingent liabilities properly and to disclose such contingent liabilities as a footnote to the balance sheet. And it is the responsibility of the auditor to verify whether management is able to identify all contingent liabilities properly and whether they were properly disclosed in the financial statements. So provision is required to be created in respect of contingencies. Yes or no? A provision is required to be created in respect of contingencies, particularly when you are of the opinion that there is a high chance of losing the cases in respect of pending lawsuits, warranty claims or guarantee claims, etc. Everything is explained to you, but I even read the point given in the material. But I am having some doubts about your ability to understand the terms management expert and auditor's expert. No doubt I have explained some points about the term management expert and auditor's expert in the previous session. And when I am explaining that, I have seen your reactions, and by going through your reactions, I find that most probably most of the students are unaware of the audit procedures that are required to be followed by the auditor when the auditor wants to rely on the work performed by management expert, and no one knows about auditor's expert. Therefore, I want to spend some few minutes to provide you with some knowledge about what procedures should you follow as an auditor when you want to rely on the work carried out by an expert. You know very well that experts are of two types. The first one is management expert. The other one is auditor's expert. Who is a management expert? While preparing financial statements, sometimes management may feel difficult in identifying values that are required to be reflected in the financial statements. For example, management wants to create provision for gratuity, or management wants to create provision for pensions, etc. In that case, it is highly impracticable for the management to create such provisions because management lacks competence to create such provisions. Therefore, in order to create such provisions, usually management do hire an expert called as actuary. That actuary will specify. This point may be known to you because there are a chapter in our accounts related to insurance, and you may come across the term actuary in insurance accounts. So in order to identify what is the amount to be reflected in the financial statements, since management is not capable of identifying that amount, management would appoint an expert, and what is suggested by the expert will be incorporated. What is suggested by the expert will be incorporated by the management in the financial statements, where expert can be defined as a person having specialized skill, knowledge and experience in the fields other than accounting and auditing. We are having an expert knowledge in the fields of accounting and auditing. We cannot call ourselves as experts. Somebody should call us as an expert. We cannot call ourselves as experts. So if any person is having some specialized skill, knowledge and experience in the fields other than accounting and auditing, we call him as an expert. In the given example, actuary whose services have been utilized. Actuary whose services have been utilized by the management for the purpose of ascertaining the amount of provision to be reflected in the financial statements. So it is the responsibility of the management to prepare financial statements. Unfortunately, management is unable to identify the amounts that are required to be reflected in the financial statements. In such case, management may take the help of a person called as expert. What is suggested by the expert will be reflected in the financial statements. In that case, it is said that management made use of. In that case, it is said that management made use of the work carried out by an expert. Who appointed that expert? management, and hence he shall be technically called as dash, management expert. So some of the amounts that were reflected in the financial statements have been derived from the books of account, whereas some other amounts have been suggested by an expert and they were included in the financial statements. You were appointed as an auditor. When you are carrying out your audit, you need to verify the correctness of each and every amount that is being reflected in the financial statements. Just now explained to you that some of the items that are appearing in the financial statements have been derived from books of account. It is easy for the auditor to check the accuracy of such amounts by going through the books of account. Some other amounts that were reflected in the financial statements were not the amounts derived out of books of account, but have been suggested by a person appointed by the management called as dash, management expert. In such case, as an auditor, you are not expected to rely blindly. As an auditor, you are not expected to rely blindly on the work performed by a management expert. Although he is an expert, although he may be having a specialized skill, knowledge and experience in the fields other than accounting and auditing, you cannot blindly rely on the work performed by the management expert. Why? Because if expert has done anything wrong, the auditor may be held responsible or liable for the wrongs done by the expert at a later point of time. So as an auditor, we cannot blindly rely on the work performed by others. Before deciding about whether to rely on the work performed by whether to rely on the amounts suggested by management expert or are not to rely on the amounts suggested by the management expert, the auditor had to follow some audit procedures. After following such audit procedures, auditor had to decide whether to rely on the work performed by dash or are not to rely on the work performed by dash. Whether to rely on the work performed by management or are not to rely. So you cannot blindly rely on the work performed by the management expert. You need to evaluate the work carried out by the management expert. When I say that, it is the responsibility of the auditor to evaluate. When I say that, it is the responsibility of the auditor to evaluate the work carried out by the management expert. At least some of you people should get it out. An auditor is not an expert. The person who carried out the work is an expert. How it is possible for a person who is not an expert to evaluate the work carried out by an expert? Do you got that doubt? Auditor is not an expert in that particular field. The work has been carried out by an expert. Now what I am saying is, as an auditor, you need to evaluate the work carried out by the expert. How it is possible for the auditor to evaluate the work done by an expert where auditor is not an expert in that field? Although you are not an expert, because of your training, because of your experience, etc., sometimes it may be possible for you as an auditor to identify whether the work of expert is reliable or not. I'll give you a simple example for this. Let us assume that you are suffering with fever, cold and fever, and you consulted a doctor. Before starting saying anything to the doctor has given 2 pages of prescription. You tried to explain something to the doctor hasn't listened to you, had given 2 pages of prescription. Now you have purchased all such medicines which are given in the prescription from the nearby medical stores. While you are purchasing the same, will you verify whether those medicines written by the doctor or prescribed by the doctor contains paracetamol or not? Yes or no? Are you a doctor? No. Although we are not doctors, we suffered with fever many number of times than doctor. Therefore, although we are not doctors, we know very well that we need to make use of a medicine called as paracetamol if you are suffering with fever. That is the reason why you are evaluating the work carried out by the doctor with the help of your own knowledge. Similar to that, although you are not an expert in that particular field, since some work has been carried out by the expert, it is your responsibility as an auditor to assess or evaluate the work carried out by the management expert to the extent possible. Then only you have to decide whether to rely on the work of the management expert or are not to rely on the work of the management expert. What aspect should the auditor check while checking the expert's work? The first one is you need to check the competence of the expert, the capability of the expert, the objectivity of the expert. Under the heading objectivity, you need to evaluate whether expert is independent or not. If there is some personal relationship between the management and the expert, can you place reliance on the work performed by the management expert? Yes or no? When the expert is employed, by the management, can you place reliance on the work of the expert? Yes or no? No. When the management expert has been employed by the entity, there will be an employer and employee relationship between the entity and the expert. In such case, entity would be able to influence the employee, the expert. In such case, the work carried out by the expert is not reliable. So if expert is independent, the work carried out by the expert is reliable. If the expert is not independent, the work carried out by the expert is not reliable. Being an auditor, therefore you need to check whether management expert is independent or not. To evaluate whether management expert is independent or not, you need to check points such as whether there is any personal relationship between the entity and the management expert, whether there is any business relationship between the entity and the management expert, whether entity employed the expert, or whether the entity engaged the expert. Whether the entity employed the expert or whether the entity engaged the expert. If the entity employed the expert, expert may not be independent. If the entity engaged the expert, there would not be any employer and employee relationship. In such case, expert may be more independent. When more the independence of the expert, more is the reliability of the auditor on the work carried out by the expert. These three things are required to be evaluated by you under the heading objectivity. Do you know what is objectivity? There is a close relationship between the terms independence and objectivity. If you are independent, it is said that you are objective. If you are not independent, it is said that you are not objective. The opposite term to the term objective is subjective. Say yes or no. The opposite term, the antonym to the is what? Objectivity. The antonym to the objectivity is subjective. What is meant by subjectivity? If you are working in accordance with the directions or instructions given by somebody, then it is said that you are subjected to the directions given by some other person. In that case, you are subjective. When you are subjective, it is said that you are not objective. So, if the auditor's work is to be objective or expert's work is to be objective, that expert should be independent. That is the reason why as an auditor we are evaluating whether the expert is objective or is subjective. If the expert is found to be objective, you can place reliance on the work performed by the expert. If the expert is said to be subjective, then you cannot place reliance on the work performed by the expert. And you should also focus on things like what is the qualification of the expert, what is the experience of the expert, whether the expert is having expertise in the specific field in which the auditor is gathering audit evidence. For example, let us assume that this is the first class and I started introducing myself to you. My name is CV Sharma. I failed 10th class 100 times. I came here to explain you a subject called as auditing and assurance. Will you rely on me or not? No. Because of my qualification, you cannot rely on my words. Because I am not having qualification. Only a chartered accountant is able to deal with a subject called as auditing and assurance. No other person can deal with this particular subject, auditing and assurance, and another subject called as subject is income tax. Regular persons who are postgraduates cannot deal with subjects like auditing and income tax because they keep on changing. Auditing is more difficult to understand because institute keep on making changes to standards on auditing, and most of the postgraduates do not know that there are some standards called as standards on auditing issued by the CA Institute. I know them very well. They don't know them. Why? Because of my qualification. I know all these things only because of my qualification. I am having competence to deal with this subject only because I am qualified. If I am not a chartered accountant, I would not have dealt with this subject. That means competence will come from dash. Competent will emanate from dash, from qualification. That is the reason why you need to focus on the qualification of the expert, the experience of the expert in the relevant field. I said that I am a chartered accountant. This is my first batch. This is the first time I'm dealing with a subject called as auditing and assurance. Can you place reliance on my work? Definitely not. Although I am a qualified person, you cannot place reliance on my work for the simple reason that I am not having experience. If I say that I am having an experience of 25 years, you heard it right. I passed CA in the year 1998. In this year only, I completed 25 years of my practice. So in that case, you can say that, okay, this person is having enough experience to deal with the subject. And I should have experience in the subject that I am going to deal with. I'm a chartered accountant. I'm having a teaching experience of 25 years. But now I came here to teach you accountancy, which was not dealt with by me in the past. In that case, am I a qualified person? Am I competent? Yes. Am I having experience? Yes. But I am not having experience in the relevant subject. So you need to evaluate whether expert is competent or not, or having qualifications or not, whether expert is having experience or not, whether expert is having experience in the relevant field in which the auditor is gathering audit evidence. You can check whether the information used by the expert is accurate or not. Sometimes the information used by the expert may have been provided by the management to the expert. Expert is not having competence to check the accuracy of information. The information that has been supplied by the management to the expert may have been utilized or used by the expert as it is without checking its authenticity. Are you able to follow me? You are the management. I am an expert. You have provided some information to me, and I made use of that information without checking the accuracy. Unfortunately, the information that you have provided to me is a wrong information. Based on such wrong information, I expressed some opinion. Can, as an auditor, you rely on the work performed by expert in this case? No. Why? Because the opinion given by the expert itself is wrong. Why the opinion given by the expert is wrong? Because the expert made use of a dash data, wrong or inaccurate data. So in order to ascertain whether opinion of the expert is reliable or not, what should you do? You need to check whether the information used by the expert is accurate, valid and reliable or not. Similar to that, you can also check whether the assumptions, some assumptions would have been made by the expert. The auditor should focus on whether assumptions made by the expert are reasonable or not. After doing all these things, if the auditor is confident that the work carried out by the expert can be relied upon, then place reliance on the work carried out by the management expert. Even after performing all these procedures, which were mentioned in Essay 500, these procedures were mentioned as a part of Essay 500. Even after performing all these procedures, if the auditor is not having confidence about the work carried out by the management expert, it is suggested to the auditor to appoint another expert called as auditor's expert. If the expert is appointed by management, he is called as dash management expert. If the expert is appointed by the auditor, it is called as dash auditor's expert. Even though auditor's expert has given an opinion, as an auditor, we cannot rely on the work performed even by the expert appointed by us. We need to follow some procedures that were mentioned in Essay 620, which is not there in our IPC syllabus, which will be there in our CA final syllabus. The name of Essay 620 is using the work of auditor's expert. The procedures that have been discussed by me till now under Essay 500 while using the work of management expert are equally applicable for the auditor when the auditor wants to rely on the work performed by auditor's expert under Essay 620. So these procedures are going to be repeated in our CA final while you are going through Essay 620. This is the meaning of management expert, auditor's expert, and why as an auditor we are related to the work carried out by those experts, and what precautions should the auditor take before placing reliance on the work of the management expert or auditor's expert, and what may happen if the auditor fails to follow these procedures. Without following these procedures, if you blindly rely on the work performed by the management expert, and if something went wrong, then you will be held responsible or liable even for the faults done by the management expert. That is the reason why as an auditor you are always made responsible to follow the procedures that were mentioned in different standards on auditing. So SA 500 deals with relying on the work of management expert. SA 620 deals with relying on the work of the auditor's expert. They contain some audit procedures. You are expected, you are under obligation to follow such procedures. After following such procedures only, as an auditor, you need to decide whether to rely on the work of the expert or not to rely on the work of the expert. You need to follow such procedures. You need to prove. You need to follow such procedures and you need to prove that you have in fact followed such procedures. As a proof that you followed such procedures, every auditor is required to maintain audit documentation while carrying out his work. Audit documentation, otherwise called as working papers, otherwise called as work papers. If you are capable of maintaining audit documentation in detail, it creates an evidence that audit has been performed in accordance with generally accepted principles of auditing in India. What are generally accepted principles of auditing in India? Standards on auditing are said to be generally accepted principles of auditing in India. In fact, while having a discussion on SS 700, probably it may not have been yet started to you. Is it started? Right. Under the heading, basis for opinion paragraph. Under the heading, basis for opinion paragraph, that paragraph will be started by the auditor like this. We have followed all the generally accepted principles of auditing in India for conducting this audit. That means the auditor is declaring to the readers of the financial statements that he has followed generally accepted principles of auditing in India. What does it mean? If you are declaring that you have followed generally accepted principles of auditing in India, it is said that you are declaring to the users of the financial statements that you followed standards on auditing, that you followed audit procedures that were mentioned in different standards on auditing. Sometimes you may be made responsible to prove yourself that you have really followed such auditing standards. In that case, dash maintained by the auditor will be useful to the auditor to prove that he in fact carried out the audit in accordance with generally accepted principles of auditing in India. Audit documentation. That is the link between this standard and SA 230. That is the reason why under the heading SA 230, management's experts report or auditor's experts report may also be treated as audit part of audit documentation. That's it. This is what actually I want to explain to you in the previous session for the last point. For the last point under the heading, write about audit of contingencies and provisions. As per SA 500, audit evidence issued by ICAI when using the work of a management expert, audit evidence that the auditor should obtain include, and fourth point is also a relevant point, wherever required, the auditor may take either the help of management expert or the help of auditor's expert depending on circumstances. The auditor should evaluate the competence, capability and objectivity. Objectivity means independence. Competence means having requisite knowledge. Knowledge will come from qualification. Capability will come from experience. So you can equate the terms competence with qualification. You can equate the term capability with experience, and you can equate the term objectivity with independence. Then under this heading, the auditor should consider aspects such as whether the expert is employed by the entity or engaged by the entity. And you can also verify whether management is able to exercise influence or control over the expert. When there is a personal relationship between the management and expert, or when there is a business relationship between the management and expert, obviously management would be able to influence or control the expert. In such case, expert cannot be said to be independent. In such case, it is said that the work carried out by the expert is not objective. It is subjective to the directions given by the management. In that case, it is not reliable. You should also verify whether you have made use of the work of that expert previously. If you have already used the work of that expert in the previous years, you will have some confidence on the work carried out by the expert. then expert's qualifications is required to be considered. Understand what was the work carried out by the expert. I have explained you some more points. Check whether the information used by the expert is accurate, valid and reliable or not. Check whether assumptions made by the expert are reasonable or not. Then you need to decide whether to rely on the work of the management expert or not to rely on the work of the management expert. Why we are having a discussion about management expert here? Because sometimes for creation of provisions, management may not have competence to do that. In that case, management would have used the services of an expert called as management expert. As an auditor, we cannot rely on the work performed by them blindly. Because of that only, I am saying that you need to follow what is mentioned in SA 500. Are you able to follow this point? How to verify contingencies and provisions, or else you could read the first 3 points also, so that you may be able to recapitulate what we discussed in the previous session. Obtain a list of all the provisions and compare them with the balances in the ledger. This is nothing but checking whether list and books of account are in agreement with one another. Inspect underlying arrangements like appointment agreement with employees and most importantly agreement with customers to assess warranty commitments, legal and other claims on the entity that is litigations. Obtain underlying working. Even I have explained you the meaning of the term working also. I have explained you the meaning of the term working also in the previous class. This is the working made by dash. This is the working made by management in respect of creating a provision to meet warranty claims or guarantee claims. On a paper like this, the management has written it. You need to go through that paper. That paper which is used by the management for the purpose of calculating provision to meet warranty claims or guarantee claims is being called as workings or working sheets prepared by the management. So wherever required, obtain underlying working and the basis for each of the provisions made from the management and verify whether the same is complete and accurate. Simply speaking, as an auditor, you need to focus on whether the provisions created by the management are reasonable or not. I said to you earlier that sometimes management would like to involve in fraud. Generally, management will involve in fraud only through fraudulent financial reporting. In that case, excessive provision may be created. Sometimes a lower provision than required may be created. Sometimes all the provision is not required. It may have been created. Sometimes all the provision is required to be created. It may not have been created. All these things will be done by the management in order to achieve some desired objectives. In either case, the financial statements will get adversely affected. Therefore, as an auditor, it is our duty to focus more on the provisioning part, because there is always a possibility that management could involve in fraudulent financial reporting, particularly in an area called as provisions. Therefore, we need to focus more on the reasonableness of the provisions. What aspects could you verify as an auditor under the heading reasonableness? Whether the provision created by the management is reasonable or excessive. Whether provision is created in respect of all the items for which provision is required to be created. If some provisions are created, you need to verify whether it is really necessary for creating a provision or not. These 3 things are required to be checked by you as an auditor under the heading provisions, for which you are expected to follow all these procedures. By this, I completed the 2 things that we discussed in the previous session also. The first one is verifying the fixed assets, and the second one is verifying contingencies and provisions. Now, let us focus on how to verify intangible assets. How to verify intangible assets. Previously, we had a discussion about how to verify fixed assets or tangible assets. Now we are focusing on how to verify intangible assets. The procedure that you need to write for every asset is almost one and the same. The only additional point under the heading intangible asset is that it cannot be physically verified. It cannot be physically verified. And another important point is in the process of development of intangible assets, sometimes the intangible asset may have been developed by the organization on its own. For the purpose of development of an intangible asset, organization will incur expenditure, and all the expenditure incurred by the organization for the development of an intangible asset cannot be capitalized by it, because the relevant accounting standard specifies that any expenditure incurred by the organization in research phase, should not be capitalized to the asset account, because in research phase you haven't identified any asset, and hence the expenditure that you have incurred till now cannot be attributed to any asset. So all expenditure incurred by the organization in research phase cannot be considered as an expenditure incurred for the purpose of development of an intangible asset. Therefore, such expenditure shall not be capitalized. Any expenditure incurred by the organization in the research phase of an intangible asset shall have to be written off to profit and loss account. But once the expenditure is fruitful, once the organization is able to identify a particular asset, an underlying asset, and once the organization starts development of the asset, there are two phases involved. The first phase is the research phase. The second phase is development phase. Any expenditure incurred in research phase should not be considered as expenditure incurred for the purpose of development of the asset. Hence, all the amounts incurred in the research phase are required to be debited or written off to profit and loss account. Expenditure incurred in development phase is required to be capitalized. This is probably what is mentioned in AS 26 intangibles. If I am right, it is AS 26 which deals with intangible assets. In that accounting standard, it was clearly spelled out. That any expenditure incurred by the organization in the research phase shall not be capitalized. It is required to be written off to profit and loss account. Any expenditure incurred by the organization in the development phase of the asset must have to be capitalized. This is point number one. Like in the case of fixed assets, you can take a list of intangible assets from the management, asking the management to provide details like opening balance of intangible assets, additions made during the year. Addition is nothing but you may try to develop some intangible assets. You start incurring some development expenditure, not research expenditure. You start incurring some development expenditure. Such development expenditure is nothing but an addition to intangible asset. So there may be opening balance of intangible. Are you able to follow me? There is an opening balance of intangible asset. There may be some additions to intangible assets. There may be some deletions from intangible assets. What is meant by deletion of intangible asset? If that intangible asset is in active use, it will be continued to be used. However, if that intangible asset is not in active use, that is required to be deleted from the books of account. So, whether to continue an intangible asset in the books of account or to delete an intangible asset from the books of account is purely dependent upon whether that intangible asset is in active use or not. Therefore, as an auditor, you need to focus on whether the intangible assets that are being reflected in the balance sheet are in active use or not. If you find that they are in active use, there is nothing wrong in reflecting them in the balance sheet. If you find that an intangible asset which is shown in the balance sheet is not, are you able to follow? You find that some intangible assets are there in the balance sheet, and you also find that those intangible assets are in active use. When an intangible asset is in active use, that is required to be reflected in the balance sheet. Nothing wrong in it. Sometimes you may find that a particular intangible asset is not in active use, but still it may have been disclosed in the balance sheet as an intangible asset. In such case, if you were the auditor, what is your duty? You need to ask the management to write it off to the profit and loss account, because that asset shall no more be considered as an asset, because the organization stopped making use of that asset, and the asset is not in active use. For example, yours is a trading entity, and you are making use of an accounting software which is specifically designed for keeping in view your accounting requirements. You have incurred some cost, and you developed an accounting software by incurring some cost which is specifically suited for your requirements. The amount that you spend on development of that accounting software is nothing but an asset to you. There is no asset which you cannot see and touch, but it is an intangible asset. So software developed by the organization or software purchased by the organization is an intangible asset, and you are making use of that software for the purpose of accounting, from generating sale invoice to recording entries in the books of account. Now, auditor got a doubt whether this software is in active use or not. What the auditor could do in that case? You can check whether sales are made and whether invoices are being generated by the organization through the use of that software. And when the auditor finds that invoices are being generated through the use of software and accounting is also being done through the use of software, in the given example, accounting software is the best example of dash, intangible asset. The organization is making use of that intangible asset for the purpose of their business. When you are making use of an intangible asset for the purpose of your business, it is said that intangible asset is in dash, active use. When it is in active use, that should be reflected in the balance sheet. When it is not in active use, it should have to be written off to profit and loss account by taking permissions from the management. Similar to fixed assets, even in case of intangible assets, you need to obtain a list of intangible assets from the management. Under that list, management should provide details like opening balance of intangible assets, additions made to the intangible assets during the year, deletions from intangible assets, and closing balance of intangible assets. Immediately after getting that list from the management, first of all, you need to verify the arithmetical accuracy. Then you need to check the correctness of the opening balance. Then you need to check the correctness of closing balance and whether it is in agreement with the books of account. So what is appearing in the books and what is appearing in the financial statement should be one and the same. Therefore, you need to verify whether it is in agreement with what is mentioned in the books of account. In respect of additions, what the auditor should verify? In respect of additions to intangible assets, the auditor should check and ensure that only expenditure relating to dash phase are capitalized and not dash phase. Expenditure relating to development phase have been capitalized, and expenditure relating to they have not been capitalized and they are written off to profit and loss account. Research phase expenditure should not be recognized as capital expenditure. Only development phase expenditure should have to be recognized as capital expenditure. Are you able to follow me?
Hello everyone, greetings of the day. Now you can purchase CA Inter Auditing regular batch videos from our Masterminds online classes app. These videos are taught in 100% English by Professor Sharma sir, having 23 years of rich experience in teaching the subject. Here you will find 175 hours of detailed videos covering all the chapters applicable for November 23 attempt recorded as per 2017 scheme. These are all latest recordings which are recorded in the classrooms but not in the recording theaters. You will find crystal clear detailed explanation for every concept in the subject, and you will definitely have a very good experience which you have never experienced earlier with regard to auditing subject. You can get these HD quality audio video lectures from our Masterminds online classes app. If you are an Android user, please install Masterminds online classes app, and in the search you please search for CA Inter Auditing in the store section. If you are an iOS user, please install Class Plus app and enter our organization code MJGUN and search for CA Inter Auditing in the store section. You can find the links to directly purchase these videos in our comment section. And you have 3 exciting, convenient options to buy this course. Option 1, you will have 175 hours of videos for 6 months at 2 views. and the material will be couriered to you, and at the same time you can have PDF material on the screen. And option 1 is available for 5,000 rupees, and option 2, the same duration, 1 month, 1 view for 1,000 rupees, but PDF material only can be read on the screen. And you have option 3 for 175 hours, 3 months, 2 views, material will be couriered, and you can also have PDF material on the screen available for 3,000 rupees. We hope this course will be of great help to you. All the best. Happy learning.
So, first of all, do you know what is audit risk, inherent risk, control risk, detection risk, and the relationship between these types of risks? Is it discussed in any other standard on auditing? What is audit risk? Audit risk can be defined as the risk that auditor expresses an inappropriate opinion. Auditor expresses an inappropriate opinion when the financial statements are materially misstated. When the financial statements are materially misstated, and when those material misstatements are not pervasive, then the auditor had to give a qualified opinion. They are pervasive, then the auditor had to issue an adverse opinion, particularly when the auditor is able to obtain sufficient appropriate audit evidence. So, when the auditor finds that financial statements are materially misstated, the auditor had to provide either a qualified report or an adverse report. In other words, the auditor had to give a modified opinion. In a situation where the auditor is required to issue a modified opinion, but the auditor had given an unmodified opinion, then it is said that the opinion given by the auditor becomes inappropriate. And the risk arising to the auditor from such a situation is technically called as audit risk. In fact, probably I would have explained this concept of audit risk in the past to you. For example, I am the auditor. I have given an inappropriate or wrong audit opinion. Depending upon my report, somebody has taken some decisions. Those decisions proves to be wrong. Why the decisions taken by using auditor's report prove to be wrong? Because the auditor has given an inappropriate audit opinion, and that person who made use of my report for the purpose of taking decisions suffered with some financial loss, and hence that person has gone to court of law against the auditor, stating that the auditor is negligent in performing his duties, and hence the auditor has given an inappropriate audit opinion. Relying on that opinion, I made some decisions and I suffered with some financial loss. For all these things, auditor should be held responsible or liable. That is the case that has been filed by a person who made use of auditor's report or auditor's opinion for the purpose of taking some decisions. And court also observed that auditor is negligent in performing his duties. Hence, the auditor had given an inappropriate opinion. Therefore, court ordered the auditor to pay an amount of 1 crore as penalty to the other party who filed a petition against the auditor in a court of law. In that case, auditor paid a penalty of 1 crore. In that, auditor got a fees of just 10,000 rupees. So, inflow to the auditor is 10,000, outflow to the auditor is 1 crore. This situation should always be treated as a risky proposition. Why this risk arises to the auditor? Because the auditor had given an inappropriate audit opinion. That risk is technically called as dash audit risk. And this audit risk is having 3 components. The first one is called as inherent risk. The second one is called as control risk. And the third one is called as detection risk. And fortunately, we had some discussion about the term detection risk. We had some discussion about control risk. What is control risk? Although there are some internal controls, there is every chance that such controls are ineffective. Because controls are ineffective, they may not be able either to prevent or to detect and correct material misstatements in the financial statements, and hence such risk is technically called as control risk. Controls are in existence, but those controls are not effective. Because of that, the controls are unable either to prevent or to detect and correct material misstatements on a timely basis. That risk is technically called as control risk. And what is inherent risk? Inherent means within, that is a normal risk associated, and you cannot reduce that risk. For example, financial statements may contain material misstatements because of human errors. Yes or no? Financial statements may contain some material misstatements because of the existence of human errors. I am not calling it as fraud. I am calling it as an error. Even because of frauds also there may be some material misstatements. Now we are having only a discussion on human errors. For example, the entity under your audit is A Limited. You are the auditor of A Limited. There is an employee in A Limited called as X. A Limited entered into some purchase transactions. Numerous purchase transactions have been entered by A Limited with another entity called as B Limited. Almost 1,200 transactions have been entered in a year. While recording these transactions into books of account, some of those transactions are having the same value. A transaction is having a value of 1 crore. The employee is of the opinion that the transaction has been recorded into books of account, but unfortunately the transaction has not been recorded into books of account because of the volume of the transactions. Employee missed to record the transaction into books of account. What is the value of the transaction that was missed by the employee to be recorded in the books of account? 1 crore. Now this is technically called as dash. Human error. To that extent, will the financial statements are materially misstated or not? So, has anyone done this mistake intentionally? No. This error may always happen, may always take place. Because of such human errors, financial statements are inherently prone to mistakes or misstatements. Such type of risk that financial statements do contain some material misstatements. These misstatements may occur whether you establish internal controls or you fail to establish internal controls because of human errors. Sometimes the person who is entering the transaction into the books of account may not have knowledge of accounting principles to be applied. Instead of treating an expenditure as capital expenditure, he would have treated that expenditure as revenue expenditure or vice versa. This is also called as human error. Because of this error also, there is every chance that financial statements may contain some material misstatements. That chance of having material misstatements in the financial statements due to human error is technically called as inherent risk. That risk will always be there in the financial statements, whether you establish dash or dash, whether you establish dash or whether you fail to establish dash, whether you establish internal controls or even if you fail to establish internal controls. Such risk is technically called as dash, inherent risk. You know very well about control risk. Because of the existence of inherent risk or because of the existence of control risk, there is a risk of material misstatements in the financial statements. Do you agree with this or not? Please say yes or no. Auditor is actually not concerned with these two types of risks. Whether auditor is appointed or whether auditor is not appointed, there will always be a dash risk and dash risk. There will always be an inherent risk and control risk. Because of the existence of such inherent and control risks, there is a high risk of material misstatements in the financial statements. If you are the auditor, if you are able to detect all such material misstatements resulting from either dash or dash, if you are the auditor and if you are able to detect all the material misstatements that would result either from dash or from dash, either from arising either from inherent risk or from control risk, there would not be any problem to the auditor. Say yes or no. If the auditor is capable of detecting all this material mistake, if the auditor is capable of detecting all these material misstatements, then there would not be any problem to the auditor. How do you detect these material misstatements? By following appropriate audit procedures. Yes or no? If the auditor is capable of following appropriate audit procedures, the auditor would be capable of detecting most of these. Why I am calling it as most of these material misstatements? Even though the audit is properly planned and properly performed, there is always a risk that some of the material misstatements in the financial statements could not be detected by the auditor because of the existence of inherent limitations of audit and inherent limitations of internal controls. But auditors do certainly able to identify most of the material misstatements if the auditor is able to follow appropriate audit procedures. Now I want to ask you a question. If you were the auditor, if inherent risk is more, if control risk is more, when does control risk is said to be more? If internal controls are not, if the internal controls that are there in the organization are found to be ineffective, are found to be having weaknesses or deficiencies in them, dash will be more. Control risk will be more. What is meant by control risk is more? There are internal controls. There are weaknesses in internal controls. There are deficiencies in internal controls. Because of the existence of such deficiencies or weaknesses in internal controls would fail to prevent or detect and correct material misstatements. So although there are internal controls, there is a high risk of existence of material misstatements. That risk is technically called as inherent risk. Control risk. I repeat, if you establish very good systems of internal controls, still such internal controls can be defeated. Yes or no? How internal controls can be defeated? Because, are you able to follow me? If the organization had established very good systems of internal controls, still such internal controls can be defeated. By whom? By the employees, or sometimes even by management. How internal controls may be defeated by the employees? Through collusion. How internal controls may be defeated by the management? Through overriding of controls. So either because of collusion or through overriding of controls, sometimes internal controls that were established which are effective may become ineffective. Because either because of dash or because of dash. Either because of collusion or because of overriding of controls by the top management. In that case, there may occur some frauds, there may exist some material misstatements in the financial statements. That risk is called as control risk. Very good controls are there, but still there may be some material misstatements in the financial statements. In that case, you can say that control risk is there, but it is there at a low level. There are internal controls, but the auditor finds that internal controls are ineffective because the auditor finds several deficiencies in internal controls. In such case also, frauds and errors will take place. In such case also, material misstatements will take place. In that case, financial statements contains material misstatements. In that case, that risk is again called as control risk. Now you need to assess the control risk at dash level. It seems you are not able to understand my point. Sometimes control risk will always be there. What is control risk? Although internal controls are in existence, some frauds would have taken place, some errors would have taken place. Hence, financial statements could include some material misstatements. That risk is technically called as dash control risk. Control risk may be sometimes assessed at high level. Sometimes the auditor may have assessed the control risk at low level. What is meant by assessment of control risk at low level and what is meant by assessment of control risk at high level? When should the auditor assess the control risk at low level? internal controls were established. Internal controls were established. And the auditor finds internal controls to be very much effective. In that case, will there be an existence of fraud? Obviously, yes. Although very good although effective internal controls have been established in the organization, there is a possibility that some of the employees may collude. There is a possibility that management may override control. So, although there is an effective internal controls exist in the organization, certainly frauds may take place, and hence financial statements may contain material misstatements, but the possibility is less because of the existence of dash. Effective internal controls. In such case, as an auditor, you need to assess dash at low level, control risk at low level. Contrary to this, you have identified that management had established internal controls. The internal controls so established by the management are ineffective. Why the auditor considers internal controls as ineffective? Because there may be several weaknesses or deficiencies in the client's internal controls. If internal controls established by the client are deficient, what may happen? The possibility of occurrence of frauds is very, very high. The possibility of existence of errors may also be very high. So the possibility of risk of material misstatements in the financial statements is very high, although there are dash controls. So possibility of material misstatements, although there are controls, is technically called as control risk. And in the given case, that control risk should have to be assessed by the auditor at high level. So sometimes control risk may have to be assessed by the auditor at low level. Sometimes control risk may have to be assessed by the auditor at high level. Then what about inherent risk? I have already explained you what is about inherent risk. What is inherent risk? There is every chance that financial statements prepared by the entity may contain some material misstatements, whether internal controls are established or not, because of the existence of human errors. That risk is called as inherent risk. This inherent risk is also sometimes may have to be assessed at high level, and sometimes it may have to be assessed at low level. What is meant by assessing inherent risk at high level? For example, if in an organization the auditor finds that there are more number of related party transactions, the financial statements are inherently prone to some material misstatements. Sometimes the auditor may find that untrained personnel have been appointed in the accounts department. In that case, the financial statements are inherently prone for misstatements. Sometimes the organization may have entered into complex transactions in a tax haven jurisdictions. In that case, in tax haven jurisdictions, you would have entered into some type of transactions. In that case, they provide some opportunity to the management to involve in fraud. In that case also, inherent risk would be very, very high. So, audit risk can be classified broadly into three categories. The first one is inherent risk, the second one is control risk, and the third one is detection risk. Audit risk can be calculated by applying a formula. The formula is audit risk is equal to risk of material misstatements in the financial statements into detection risk. This risk of material misstatements is of two types, as already explained to you. The first one is inherent risk. The second one is control risk. Now, audit risk can be calculated by following a formula called as inherent risk into control risk into detection risk. If you apply this formula, you will be able to calculate a risk called as audit risk. So, risk of material misstatements is a function. Risk of material misstatements is a function of dash and dash. Function of inherent risk and control risk. So, inherent risk into control risk is called as dash, risk of material misstatements. Detection risk is already explained to you. If you are able to follow dash procedures, appropriate audit procedures, your failure to detect risks or failure to detect misstatements will be at low level. If you fail to follow appropriate audit procedures, failure of the auditor to detect misstatements would be high. So, if you were the auditor, you need to keep the detection risk. You need to keep the detection risk at a low level, to keep dash at a low level. If you were the auditor, in order to keep the audit risk at a low level, the auditor should try to keep the detection risk at a low level. I will try to explain this point with the help of an example, then only it is understandable. I am expressing these things in percentages. Let us assume that inherent risk is say 50%. Control risk is say 40%. And detection risk is say 60%. This is example number 1. Okay. And inherent risk is 50. Control risk is 40. Detection risk is 20%. It is a raw calculation, but certainly it will be useful to you to understand how to calculate audit risk. 50 into 40. 50 into 40. 50% into 40%. 20%. 20% into 60%. 12%. So what is audit risk here? 12%. 50 into 40, 20. 20 into 20. 20 into 20%, 4%. So in the first case, audit risk is calculated at 12%. In the second case, it was mentioned in the original standard that audit risk can be calculated by this method, either in abstract methods, abstract figures, or even in percentages. For this, you can go through SA 330. You can find these sentences in SA 330 and SA 315 also. So, how the auditor is able to reduce audit risk from 12% to 4%? These two are common. These two are also common. But the auditor is able to reduce the risk, audit risk from 12% to 4%. How it is possible for the auditor to do that? Because the auditor had kept the detection risk at low level. How do you keep the detection risk at low level? By following appropriate audit procedures. So if you were the auditor, if you are able to follow appropriate audit procedures, you can keep the detection risk at low level. Thereby you can keep the audit risk at an acceptably low level. You cannot make audit risk as 0. Audit risk cannot be made as 0. Why? Because there is always some sort of inherent risk. There is always some sort of control risk. Even if you perform your audit with effectiveness, because of existence of inherent limitations of audit or inherent limitations of internal control, even you may fail in detecting all such mistakes. Therefore, there will always be some dash risk to the auditor. Audit risk to the auditor. Auditor should always try to keep dash at an acceptably low level. Auditor should always try to keep the audit risk at an acceptably low level. The auditor cannot make audit risk as 0. So audit risk is a function of dash and dash. Audit risk is a function of dash and dash. Risk of material misstatements and detection risk. Risk of material misstatements is again a function of dash. Inherent risk and control risk. That is the reason why I said to you that being an auditor, you need to apply a formula for calculation of audit risk. The formula is dash. Inherent risk into control risk into detection risk. Inherent risk into control risk into detection risk. Thereby you can calculate audit risk. This is all about the concept of audit risk that is appearing as question number 1 in your material. You can just go through it. I cannot read because of the limitation of time. So define audit risk. What are the components of audit risk? Write about interrelationship between components of audit risk. So, and another important point that I missed is, in case where the auditor is required to provide a modified opinion, but the auditor has given an unmodified opinion, there will be a risk called as audit risk. However, the reverse is not correct. That means auditor is required to provide an unmodified opinion, but the auditor has given a modified opinion. In this case also it is said that the auditor has given an inappropriate opinion. In that case there would not be any risk to the auditor. Why? Because although you are expected to give an unmodified opinion, you have given a modified opinion. You are alerting the people by giving a modified opinion. Therefore there would not be much risk to the auditor in that case. So in case where the auditor is required to give a dash but has given a dash, then only dash will arise. In case where a modified opinion is required to be given by the auditor, but the auditor has given an unmodified opinion, there will be an audit risk to the auditor. If the auditor is required to give an unmodified opinion, but the auditor has given a modified opinion, there would not be any audit risk to the auditor. And things like components of audit risk, inherent risk, control risk, and detection risk have been explained, and with the help of a formula also, audit risk is equal to risk of material misstatements into detection risk. This risk of material misstatements in the financial statements is either due to inherent risk or due to control risk. That is the reason why I said that audit risk is equal to inherent risk into control risk into detection risk. This is about question number 1. Now question number 2. Write about risk assessment procedures in the light of SA 315. I said to you in the past that auditor should have to follow risk assessment procedures depending upon the results of risk assessment, procedures, the auditor shall determine the nature, timing, and extent of audit procedures. Say yes or no. If the auditor finds that risk is very, very high, to reduce if the risk is very high, risk of material misstatements, inherent risk is very high, control risk is also very high, then the auditor should keep the detection risk at a low level. If you really want to keep your detection risk at a low level, what the auditor should do? Auditor should have to follow appropriate audit procedures. When the risk of material misstatements is high, if the auditor decides to follow audit sampling, can you call it as a dash appropriate audit procedure? No. In that case, what the auditor should take a decision? The auditor should take a decision that since the risk is very, very high, it is inappropriate to follow dash. It is inappropriate to follow audit sampling, but to follow full checking, otherwise called as routine checking. So, by following required and appropriate audit procedures, the auditor would be able to reduce the detection risk. When the auditor is able to reduce the detection risk, the auditor is also able to reduce the audit risk to an acceptably low level. That is the reason why you need to follow risk assessment procedures. What is risk assessment procedure? Assessing risk of material misstatements. Should this risk is at high level, or should this risk is at low level? The auditor should assess the risk of material misstatements in the financial statements as at a high level or low level. Risk of material misstatements are the function of dash and dash, inherent risk and control risk. So when inherent risk and control risk are high, dash is also said to be high. When risk of material misstatement is high, the auditor should keep dash at low level. Thereby the auditor can keep dash at low level. Audit risk at an acceptably low level. So if you were the auditor, first of all you need to assess whether the risk of material misstatement in the financial statement is high or risk of material misstatement in the financial statement is low. Thereby you can ascertain how much should be the detection risk. Thereby you can understand what audit procedure should you follow to keep the detection risk at a low level. For that purpose, the auditor is required to carry out some procedures called as risk assessment procedures, which you may come across in SA 500. The following are the audit procedures that are required to be followed by the auditor to obtain sufficient appropriate audit evidence. For obtaining sufficient appropriate audit evidence, auditor is required to follow two types of procedures. What are they? The first one is risk assessment procedures. The second one is further audit procedures. Such further audit procedures were again divided into compliance procedures, substantive procedures, and so on. What we are discussing is about risk assessment procedures. So you need to perform both risk assessment procedures, and depending upon the results of risk assessment procedures, the auditor need to perform further, decide about further. Depending upon risk assessment procedures, the auditor need to decide about further audit procedures to be performed by him. So first of all, it is necessary for you as an auditor to carry out dash procedures, risk assessment procedures. Now the question is, what type of procedure should you follow as an auditor as a part of risk assessment procedures? This is a general discussion. The objective of the auditor is to identify risk of material misstatements at two levels. The first one is at the level of financial statements at assertion level. If a misstatement is able to affect only one or two assertions, then it is called as, or only one assertion, it is called as misstatement at assertion level. If the misstatement is able to affect more than one assertion, then it is said that there is a risk at financial statements level. For example, there are several assertions. You know very well about the concept of assertions that we discussed under the heading audit of items of financial statements. There I said to you that there are 4 assertions relating to balance sheet. There are 5 assertions relating to profit and loss account. What are the 4 assertions that we discussed relating to balance sheet? Existence assertion, rights and obligations assertion, completeness assertion, valuation assertion. If a misstatement is relatable to only one assertion, then it is called as there is a misstatement at assertion level. If the misstatement is affecting more than one assertion, then it is said that the misstatement is at overall level, is at financial statements level. When I say financial statements level, you should be able to recollect one point. The point is, the auditor should ensure that financial statements are free from material misstatements. The financial statements should be free from material misstatements. Financial statements are free from material misstatements. There should not be material misstatements as a whole to the financial statements. If there are material misstatements which are as a whole to the financial statements, they will never reflect a true and fair view. If a misstatement is affecting only one assertion, in that case you may decide to give a qualified opinion. You may decide to give a qualified opinion. For example, there are investments. Investment is in existence. Investment is in existence. The organization is the owner of the investment. The organization, that means organization is having a right on investment. The third one is the investment. All the investments have been completely recorded into books of account. But the valuation of investment is wrong. The valuation of investment is wrong. That is the only mistake the auditor identified in the entire financial statements. In such case, if you were the auditor, would you try to provide an adverse opinion, or would you try to provide a clean report, a qualified report? If I were the auditor, I will try to provide a qualified report. Why? Because out of 4 assertions, only one assertion is getting affected. If all the 4 assertions or more than one assertion is getting affected, then the mistake is said to be at the financial statements level as a whole. That is the meaning of the term assessment of risk of material misstatements at the level of financial statements and at assertion level. Auditor should always try to minimize the audit risk. For this purpose, first of all, to assess all these types of risks, first of all, the auditor should understand the entity and its environment. The entity and its environment. Risk may arise either from fraud or error. It may be intentional or unintentional. If you try to evaluate the risk, you can imagine what can go wrong. What can go wrong means what may be misstated, what may not be misstated is called as what can go wrong. And the most important one is how to carry out risk assessment procedures by the auditor. Risk assessment procedures followed by the auditor shall include risk assessment procedures to be followed by the auditor shall include the following things. 1. Auditor should, these points are very difficult to understand, so be careful. By doing the below mentioned procedures, the auditor would be able to assess. By doing the below mentioned procedures, the auditor would be able to assess the risk of material misstatements. The risk of material misstatements in the financial statements either as high or as low. If the auditor finds the risk of material misstatements in the financial statements as high, then the auditor will try to follow appropriate audit procedures to reduce dash detection risk, thereby to reduce dash audit risk 2 dash to an not zero to an acceptably low level. Are you able to follow my discussion? Yes or no? Done. So what the auditor should do? First of all, the auditor should assess the risk of material misstatements resulting from inherent risk or from control risk. To assess this risk of material misstatements, auditor should follow some procedures. The procedures that are required to be followed by the auditor to assess the procedures that are required to be followed by the auditor to assess the risk of material misstatements in the financial statements either due to dash or due to dash, either due to inherent risk or due to control risk is technically called as risk assessment procedures. This is not the first time I am explaining this point to you. The same point has already been explained to you in this explanation also. The auditor should assess the inherent risk either at high level or at low level. Should also assess the control risk either at high level or at low level. Once you identify inherent and control risks either at high level or at low level, with the function of inherent and control risks, you can assess dash risk of material misstatements. How do you assess these inherent risk at high level or at low level? How do you assess this control risk either at high level or at low level? By following some procedures. Such procedures are technically known as dash. Such procedure, are you getting my point? Such procedures to be followed by the auditor to assess both inherent risk as well as control risk either at high level or at low level is technically called as risk assessment procedures. So if you were the auditor, you need to carry out dash. If you were the auditor, you need to carry out dash. I am coming in another way. If you were the auditor, you need to perform dash risk assessment procedures. What is risk assessment procedure? And why should the auditor perform risk assessment procedure? To assess the risk. And in what steps or in what areas should the auditor assess the risk? What is the inherent risk? What is the control risk? Inherent risk should be assessed by the auditor either at high level or at low level. The control risk is also required to be assessed by the auditor either at high level or at low level. Why you are assessing inherent and control risks either at high level or at low level? Because the function of dash and dash is dash. The function of inherent risk and control risk is risk of material misstatements. Why should the auditor is assessing risk of material misstatements? To assess the level of detection risk. To assess the level of detection risk that the auditor should keep maintaining. To assess if the auditor is able to assess the detection risk, the auditor can be able to select appropriate audit procedures to reduce the detection risk to an acceptably low level, thereby reducing audit risk to an acceptably low level. So simply speaking, the following are the procedures which are called as risk assessment procedures that should be followed by every auditor to assess both dash as well as dash, both inherent risk as well as control risk. They both combined together is being called as dash. Risk of material misstatements. By following the following procedures, the auditor would be able to assess the risk of material misstatements. Are you following? Yes or no? Done. If you say no, I will try to dilute it further. Already I have diluted to the extent possible. If you still say that you are unable to understand, I will try to dilute it further so that you may have better understanding of that. So risk assessment should be done by the auditor. What risk assessment? Whether risk of material misstatements, the possibility of, what is risk assessment? This is a diluted point. The possibility of existence of material, the possibility of the existence of material misstatements in the financial statements is called as risk of material misstatements. This risk of material misstatement is the function of dash and dash, function of inherent risk, and therefore the auditor should assess both dash and dash. Inherent risk should be assessed, control risk to be assessed. The function of inherent and control risk is risk of. If risk of material misstatement is assessed by the auditor at high level, what does it mean? If the risk of material misstatement is assessed by the auditor at high level, what does it mean? There is a high possibility. There is a high possibility that the financial statements that we are going to be audited may contain material misstatements. If the auditor assessed this risk of material misstatements at low level, what does it mean? The possibility of the existence of material misstatements in the financial statements is assessed by the auditor at low level. Depending upon this assessment only, you need to determine the audit, the nature, timing, and extent of audit procedures to be performed by the auditor. Followed or not? Please say yes or no. Done. So, you need to assess risk of material misstatements. For that, you must have to follow some procedures. The procedures to be followed by the auditor were given under the heading risk assessment procedures. So what procedure should the auditor follow? The first one is inquiries of management. The second one is analytical procedures. I don't want to explain anything about analytical procedures because just now we completed SA 520 analytical procedures. I said to you that analytical procedures can be followed by the auditor even before commencement of audit or during the course of audit. If you follow analytical procedures before commencement of audit, they are technically called as part of risk assessment procedures. Yes or no? So analytical procedures is known to you. Observation and inspection. What is that? Observation and inspection. Observation and inspection, I will try to explain that point later. Now, let us focus on inquiries of management and others. If you are able to understand this, I can conclude the process of risk assessment and we can focus on audit program. If it is possible for me to complete audit program today, I will do that. If it is not possible, I will take another 1 hour's class tomorrow and happily I can complete audit planning and audit program. Probably the time is not sufficient. If they allow me to take another half an hour's class, it may be possible for me to complete this audit planning and program and strategy also. If not, I will continue the class in the next tomorrow and I will take another 1 hour of your time to complete that. Is it any problem for you? Even if it is a problem for you, I will do that. Okay, done. So I cannot take this class hurriedly and I cannot say that I completed a discussion on audit planning and audit program. It takes some time to complete. That is the reason why I am taking some more time to explore, to complete a concept called as audit planning. Usually I I deal with the concept of audit planning at the end of my syllabus. In my regular classes also, I focus on audit planning and audit programming as the last chapter. Why? Because without having a overall and holistic approach of auditing, it is quite impossible for the auditor. Even chartered accountants do not know much about the distinction between audit strategy, audit planning and audit program. They are very confusing in nature. Sometimes they use the word planning and audit. Sometimes they use the word audit plan. They both are different. So sometimes you need to understand it in a different way. The same point may have to be understood in a different way. So it is very difficult to understand the chapter called as audit strategy, audit planning and audit program. That is the reason why most of the students, out of 1,95,000 or 98,000 of the students, will try to read only a question called as audit program, including advantages and disadvantages of audit program as a part of audit planning, audit strategy and audit program. And ultimately you will do that. I know it very well. Even if I try to explain the chapter for 1.5 hours, ultimately you will do that only. You will focus on only 3 questions. First one, what is audit program? Second one, what are the advantages of an audit program? And the third one, what are the disadvantages of an audit program? Nothing else could be prepared by the student, because it is very difficult for the student at your level to understand this concept. Practical knowledge is essential to understand the terms audit strategy, audit plan and audit program. Since you lack practical approach, it is very difficult for you to understand. It is very difficult for me to explain that as well. Okay, done. So, risk assessment procedures. The first one, as a part of risk assessment procedures, first of all, the auditor should make an inquiry with those charged with governance. Why should the auditor make an inquiry with those charged with governance? And in what way making an inquiry with those charged with governance help the auditor in assessing inherent risk and in assessing the control risk? This is the reason why in the recent past only I explained you SA 240. In the recent past only I have explained you SA 240. Have I finished off SA 240? What is the heading of SA 240? Fraud and responsibilities of the auditor. If there is a high risk of fraud, there is a high risk of material misstatements. Why frauds take place? Either because of incentives or pressures, or because of opportunities, or because of rationalization, attitude or rationalization. These 3 things have been discussed by us under 2 headings. One is management fraud, the other one is employee fraud. If you are really able to recollect what we discussed in SA 240, you are able to understand my words. Otherwise, it is not at all possible for you to understand my words. I cannot explain it again. Okay? So, there is a close relationship between SA 240. Fraud, misstatements are the results of either dash or dash. Misstatements are the results of either fraud and error. We already completed SA 240. You know very well about what is fraud, how it takes place, who carry out fraud, how they carry out fraud, how to detect them, fraud risk factors, everything is known to you. And fraud risk factors will increase dash. Fraud risk factors will increase the risk of material misstatements in the financial statements. To identify such fraud risk factors, you can follow these procedures as a part of dash risk assessment procedures. What is the first one? The auditor should make an inquiry with those charged with governance. In what way making an inquiry with management or those charged with governance will help the auditor in identifying material misstatements or risk of material misstatements in the financial statements. To understand the environment in which the financial statements are prepared. Sometimes directly those charged with governance would have been involved in preparing financial statements. Sometimes the task of preparing financial statements would have been given by those charged with governance to the management, in which case there is a higher risk of material misstatement when the task is given to the management, particularly when the management compensation is is based on performance, and if you made your management responsible for preparation of financial statements, there is a high chance that to get more dash, management would involve in dash. In order to get more compensation, management of the entity would have resorted to dash fraudulent financial reporting. When there is a fraudulent financial reporting, risk of dash is also more. Risk of material mistake. Are you able to correlate between the terms fraud and risk of material misstatements? Misstatement is the result of fraud. If there occurs a fraud, there occurs a risk of material misstatement. And hence you are trying to analyze who was made responsible for preparation of financial statements. Is it management or is it those charged with governance? If it is those charged with governance, the risk is said to be less. If it is given to management, the risk is said to be high. So that is the reason why you need to make an inquiry with those charged with governance, which may enable the auditor to understand the environment in which the financial statements are prepared. Then this point is very easy to, from this point, it is very easy for you to understand these points. The auditor make an inquiry with internal audit team. Why should the auditor make an inquiry with internal audit team? Internal auditor may have already performed all the procedures that should have to be performed by the statutory auditor. Internal auditor would have already done some risk assessment, carried out some risk assessment procedures. Internal auditor would have already identified some risk of material misstatements in the financial statements. The areas, some areas would have been already identified by the internal auditor as key areas where the risk of material misstatement is very high. By having a discussion with the internal auditor, the auditor would be able to assess whether risk of material misstatements in the financial statements of this entity is high or is low. So, in order to assess the risk of material misstatements either as high or as low, what the auditor is expected to do? The auditor is required to make an inquiry. With whom the auditor had to make an inquiry? With the management or those charged with governance, with internal auditors. You can just go through that sentence, which is self-explanatory in nature. Inquiries with internal audit team may provide the auditor whether management has properly responded to internal auditor's findings. If internal auditor made some findings, management has not properly responded. What does it mean? Internal auditor had evaluated internal controls. Internal auditor had identified some material, some weaknesses in client's internal controls. The same have been communicated by the internal auditor to the management. Some suggestions were also given by the internal auditor to the management to overcome such deficiencies. But management has not yet taken any action on such deficiencies detected and reported by the internal auditor. What does it imply? Should I repeat my question? There is an internal auditor. Internal auditor evaluated supervised internal controls, found some mistakes, found some deficiencies in internal controls, reported the same to the management. Along with the report, internal auditor has given some suggestions to the management to overcome such deficiencies. If you were the management and if you have received some suggestions from your internal auditor, what you are expected to do? You are expected to rectify such deficiencies in our internal controls. Deficiencies in internal controls lead to more control risk, lead to more material misstatements in our financial statements. So you need to follow the suggestions given by the internal auditor, but the management has not followed the suggestions given by the internal auditor. What does it mean? The dash are still in existence. Weaknesses or deficiencies are still in existence. When the weaknesses or deficiencies in internal controls are still in existence, Andy. Sorry. So, I don't know. So the auditor should have to make an inquiry with those charged with governance, should have to make an inquiry with the internal audit team. The auditor should also make an inquiry with the employees. Sometimes the auditor may make an inquiry with employees. This is the reason why in SA 500 it is mentioned that most of the audit evidence is generally gathered by the auditor through the process of inquiry. But if you get some audit evidence through inquiry, you cannot blindly rely on that evidence. Why? Because if you make an inquiry, the other party may say something to you which is correct or incorrect. So in order to prove the correctness, you need to follow some other procedures like inspection also. Have you introduced this system? This was the inquiry made by the auditor with the management. Management has given a reply like this. Yes. In that case, can you rely on the management's words? The system may not have been introduced by the management, but the management may have made a representation to the auditor saying that the system is introduced when the auditor made an inquiry with the management. You need to check it by inspecting the system. So inquiry alone will not provide sufficient appropriate audit evidence to the auditor. Inquiry combined with other audit procedures like inspection, observation, etc. will provide more reliable audit evidence to the auditor. So inquiries with employees may help the auditor to identify unusual or complex transactions. What happens when there occurs unusual or complex transactions? Dash is more. You can refer this with SA 240. In SA 240 also I said to you that when the entity under your audit had entered into some complex transactions, the risk of material misstatement is very, very high. So whether the organization had entered into any complex transactions or not can be ascertained by you as an auditor by having an inquiry with dash, by having an inquiry with employees. Similarly, inquiries with entities legal counsel. Inquiry with entities legal counsel. Example, audit committee or lawyers may help the auditor identifying matters relating to fraud, litigations and provisions, etc. What happens when there is a litigation is very well known to you. What happens when there is a litigation pending before court of law? A provision which should have been created by the management may not have been created by the management. Fearing that if a provision is created, the organization may have to report a loss. In that case, a provision which is required to be created may not have been created. When a provision which is required to be created is not created, can you treat it as misstatement or not? How do you identify this misstatement? By having an inquiry with a lawyer about dash, about litigations in respect of which dash should have to be created but has not been created. Provisions should have been created but have not been created. So making an inquiry with lawyers also sometimes would help the auditor in assessing the risk of material misstatements. And this is very important point. The auditor can also make an inquiry with marketing or sales personnel. Marketing or sales personnel regarding market strategies, sales trends, etc. If the marketing personnel says that the sale trend is decreasing, then the auditor should get a doubt or suspicion. Why? Because marketing people said that there is a reversal in sale trend. There is a decrease in the sale trend. So when compared with the previous year, current year sales have fallen by 50%. In that case, is it possible for the management to resort to fraudulent financial reporting in order to meet the pressures from market? Market is expecting that this year also organization is going to declare a very good amount of profit. But unfortunately, because of reversal in the sales trend, the sales of the entity are very, very less. The entity suffered even with a loss. Although the entity suffered with a loss, there is every chance that management of the entity could have decided to inflate the profits or inflate the sales and thereby inflate the profits to meet dash expectations, market expectations. That is what I said to you as pressures outside the entity. So that is the way in which you would be able to identify whether there is any risk or not by making inquiries with dash. So by making inquiries, you can ascertain whether there is a high risk of fraud or not. If there is a high risk of fraud, there will be a high risk of material misstatement. So all these things are being inquired by the auditor to identify whether the risk of fraud is high, risk of fraud is low. If risk of fraud is high, obviously risk of dash is also high. Obviously risk of Are you getting my point? If the risk of fraud is high, risk of material misstatement is obviously high. Is obviously high. So to assess the risk of material misstatement, first of all, the auditor should assess the risk of fraud. To assess the risk of fraud, you should follow SA 240. Apart from what is specified in SA 240, apart from keeping fraud risk factors in mind, which is mentioned in SA 240, you need to make an inquiries with the management. Making inquiries with the management will certainly help the auditor to detect the possibility of fraud and thereby to detect the possibility of risk of material misstatements in the financial statements. So to whom the auditor make an inquiry? With those charged with governance, with internal audit team, with employees, with entities, legal counsel, with marketing or sales personnel. Inquiry, this point is very difficult to understand, so leave it. There will be some committees in the organizations called as risk management committees, which is a part of corporate governance. If the entity is a listed company, the entity is under obligation. To establish a committee called as risk management committee. It is the responsibility of the risk management committee to always assess business risks. And to make a report to the management. Very soon we are going to face this risk from the competitors. For example, Adani is maintaining a data center. It is a business. And now Reliance had entered into an agreement, a joint venture with Brookfields, a foreign company, in order to maintain data centers. So Reliance is also entering into the field of data centers. When Reliance declared that they are entering into the field of data centers, obviously it will be treated as a risk by their competitors. Yes or no? So risk management committee, if there be any in Adani, will certainly identify this, will make a report. There is a business risk. We are going to face a business risk from our competitor. The competitor is a very tough competitor. So in the near future, we are going to have the impact of this competition. So be careful. Please devise policies. Please devise procedures to mitigate that risk. We are suggesting you the following procedures to mitigate that risk. That is the function of a committee called as risk management committee. By having an inquiry with the risk management committee also, sometimes the auditor, if business risks are more, and if the management is unable to mitigate with the business risks, sales will be in the falling trend, profits will be in the falling trend. To maintain the profits, the organization could have resorted to or may involve in fraud. So when the risk management committee is saying that organization is facing with several business risks, some of which can be mitigated, some of which cannot be mitigated, immediately the auditor should suspect the existence of management fraud. Management could resort to fraudulent financial reporting because there are several threats to business. There is a high business risk. In order to meet the business risk, the organization had to evaluate, prepare some strategies. If the entity is unable to prepare such strategies, then entity may try to resort to fraud to show a rosy picture, to show that everything is going on normal. Although it is not going on normal. There are two ways to mitigate your business risk. Yes or no? You are very soon going to face tough competition from your competitors. That is a business risk to you. How to mitigate it? How to mitigate those risks? Sometimes you may devise some policies, reducing your tariffs, giving advertisements, more number of advertisements, reaching more number of customers. You may try to mitigate with that risk. If you fail to mitigate the risk, what may happen? Your profitability will get affected. If you do not want to show that profit, then what will you do? You may resort to fraudulent financial reporting. That obviously increase the risk of material misstatements in the financial statement. So by having an inquiry with all these personnel, and fortunately since we completed audit under automated environment, this point is also very easy to understand. Auditor can make an inquiry with the information system personal. Auditor can make an inquiry with the information system personal. Very recently, the entire system has been replaced with a new one. The old information system has been replaced with a new one. Will there be any risk in that case? The persons who are operating the system may not have been given proper training in operating the system. If you have not been given proper training in operating Tally, and if you are made responsible to enter details into Tally, what may happen? You have not been given proper training in entering transactions in Tally, but you are made responsible to enter transactions in Tally. In that case, what happens? The risk of wrong entry will be more. The risk of material misstatements in the financial statements would also be more. This is not intentional, but because you changed the accounting system and because the people in the organization had not adopted, because the people in the organization has not adopted to the new system, there is every chance that accounting transactions may have been wrongly entered into the system. Because of that, there will be a risk of material mistake. Practically, these things will not be considered by any auditor. It is highly impracticable for the auditors to consider all these things. But theoretically, it is necessary for you as an auditor to make an inquiry with all these personnel to assess risk of material misstatements, thereby to assess how much should be your detection risk, what procedure should you require to follow to reduce your detection risk at a low level, thereby reducing audit risk to an acceptably low level. Are you able to follow me? Is it useful to you? Done. So inquiries with information system personnel may provide information about system changes, system or control failures, or other information system related risks. System related, that is the reason why we studied internal controls even under automated environment. IT specific risks will be there. Some transactions may have been processed by the system automatically without any human intervention. In that case, there is a chance that transaction may not be processed correctly. And analytical procedures is well known to you. Finally, observation and inspection. By observing, observation and inspection are known to you. So, I said to you that some of the organizations may maintain internal control manual. Yes or no? Internal control manual. If an internal control manual exists, just by inspecting internal control manual, the auditor will be able to assess whether dash are effective or not, whether controls designed and implemented in the organization are effective or not. If the auditor finds that the controls designed and implemented in the organization as effective, then the control risk will be, if you are unable to understand, I can say that I failed in explaining the concept to you. The control risk will be assessed by the auditor at high level. When the control risk is at high level, if they are effective, control risk is at low level. If they are ineffective, the control risk is at high level. Accordingly, you will assess the risk of material misstatements. Accordingly, you will determine the audit procedures to be followed. Understood? So that is the reason why inspecting documents, internal control manuals may provide supporting information in addition to inquiries. Inquiries means you can inquire the management about what procedures have you established in relation to, say, remember, evaluation of internal controls is a part of dash procedures. What is the heading of SA 315? Identifying and assessing the risks of material misstatements through understanding the entity and the environment, including internal control systems. So evaluation of internal controls is also a part of dash. Evaluation of internal controls is also a part of dash. Risk assessment procedures. Yes or no? So internal controls are also required to be checked by you as a part of risk assessment procedures. How do you check the effectiveness of internal controls? First, by making an inquiry, and then verifying whether the results of inquiry are correct or not. To corroborate it, you need to follow inspection. Inquiry coupled with what procedures have you established in relation to your sales department? This is the question being raised by dash to dash. Auditor to management. Management said that we established these procedures, those procedures, etc. Auditor finds them effective, but the auditor shall have to verify whether those procedures are really established or not, for which you need to inspect dash. Internal control manuals. If the same procedures are there in the internal control manuals also, then what the auditor can conclude? So what is mentioned by management is actually implemented by management. For that, what you have done? You have done inspection. So in carrying out risk assessment procedures, you should make inquiries. You should make inquiries. You should carry out observation. What is observation? You can sit along with an entity's personnel. You can start observing whether the established internal controls are real or not. We established a system whereby the head of the personnel department should be physically present at the time of disbursement of wages. In order to check whether such system is actually in existence or not, what the auditor should do? The auditor should observe whether dash is present at the time of dash, whether the head of the personnel department is present at the time of disbursement of wages. So by sometimes by having an inquiry, sometimes by having an observe, you can never understand these points if you try to go through these points on your own. I bet you will never understand even 1% of these points if you try to understand these points on your own. So that is the reason why I am trying to explain the point in detail. All the time is already 11:05. So through inspection, through observation, through inquiry, and again it is inspecting and observing. By following these procedures, the auditor can follow dash procedures, risk assessment procedures. Why should the auditor assess the risk? Why should the auditor assess the risk? In order to determine the level of detection risk. How do you detect the level of detection risk? By following appropriate. How do you maintain level of detection risk? By following appropriate audit procedures. That means to identify the procedures that are required to be followed by the auditor. Nature, timing, and extent of audit procedures to be followed by the auditor. The auditor should carry out dash risk assessment procedures. So what are the risk assessment procedures that you could follow as an auditor? Inquiry, observation, inspection, analytical procedures, etc. can be followed by the auditor. Inquiries are more important in this point. And finally, risk of this point is already explained to you. At the level of financial statements, risk of material misstatement may be there at two levels. First one is at the level of financial statements. The meaning of that has already been explained to you. At the level of assertion, that was also explained to you. At the level of financial statements, if you are having concerns about dash, integrity of the management, if you are having doubts about the honesty of the management, obviously management could involve in fraud through fraudulent financial reporting. In that case, more than one assertion may get affected. Then risk will be there at the level of financial statements. Similarly, when there are unusual pressures on the management, financial statements in entirety may get affected. Similarly, when the persons who are not competent to prepare financial statements made responsible for preparation of financial statements, he doesn't know what is capital expenditure and what is revenue expenditure. He doesn't know what is division 1, division 2, division 3, part 1 and part 2 of schedule 3 to the Companies Act. If that person is made responsible to prepare financial statements, will the risk of material misstatements is high or low? High, as a whole to the financial statement. So in the following three situations, the risk will be there at the level of financial statements. One is when there are doubts about the integrity of the management. The second one is when there are some unusual pressures on the management. And the third one, this point has been elaboratively explained under essay 240. And finally, lack of adequate competence of management to prepare financial statements. For example, a new accounting standard came into existence. Management lacks knowledge of that new accounting standard. Hence, the accounting standard may have been wrongly applied by the management in preparation of financial statements. In which case, what may happen? The risk of material misstatement would be very, very high. And assertion level. If accounting systems are not qualitative, one assertion may get affected. If a transaction is a complex transaction, if any risk other than dash is called as dash. Any risk other than dash is called as dash. Any risk other than risk at financial statements level is technically called as assertion risk. And the last one is a general point. Understanding the entity is a continuous and dynamic process that I will explain in the next chapter, that is audit planning, program, etc. Okay, I will take just 1 hour of your time for explaining that chapter. Tomorrow is the last date for our class.
Hello everyone, greetings of the day. Now you can purchase CA Inter Auditing regular batch videos from our Masterminds online classes app. These videos are taught in 100% English by Professor Sharma sir, having 23 years of rich experience in teaching the subject. Here you will find 175 hours of detailed videos covering all the chapters applicable for November 23 attempt recorded as per 2017 scheme. These are all latest recordings which are recorded in the classrooms but not in the recording theaters. You will find crystal clear detailed explanation for every concept in the subject. And you will definitely have a very good experience which you have never experienced earlier with regard to auditing subject. You can get these HD quality audio video lectures from our Masterminds online classes app. If you are an Android user, please install Masterminds online classes app, and in the search you please search for CA Inter Auditing in the store section. If you are an iOS user, please install Class Plus app and enter our organization code MJGUN and search for CA Inter Auditing in the store section. You can find the links to directly purchase these videos in our comment section. And you have 3 exciting convenient options to buy this course. Option 1, you will have 175 hours of videos for 6 months at 2 views. And the material will be couriered to you, and at the same time you can have PDF material on the screen, and option 1 is available for 5,000 rupees. And option 2, the same duration, 1 month, 1 view for 1,000 rupees, but PDF material only can be read on the screen. And you have option 3, for 175 hours, 3 months, 2 views, material will be couriered, and you can also have PDF material on the screen available for 3,000 rupees. We hope this course will be of great help to you. All the best. Happy learning.
Essay 240, Fraud and Responsibilities of the Auditor, which is the base for understanding Essay 315, Identifying and Assessing the Risks of Material Misstatements through understanding the entity and the environment, including internal control. Fortunately, the chapter relating to internal control is completed. Now, let us try to recollect what we discussed about fraud in the introductory chapter. I said to you that there are 2 objectives behind appointment of the auditor. Objective number 1, forming and expressing an opinion. Objective number 2, or secondary objective, is detection of frauds and errors. And I explained you what happens or what may happen if the auditor fails to detect frauds and errors. Several frauds have taken place in the organization. Several errors have occurred in the organization. Because of the existence of such fraud or errors, there are some material misstatements in the financial statements. The auditor failed to detect frauds. Hence, the auditor failed to detect material misstatements that are in existence in the financial statements. And the auditor concluded finally that financial statements are free from material misstatements and has given a clean report or unmodified report. In other words, in a situation where the auditor is required to issue a modified report, the auditor has given an unmodified report. That means it is said that the auditor has given a wrong or inappropriate opinion, when the auditor expresses a wrong or inappropriate opinion, there will arise some risk to the auditor. Such a risk has been termed by us as audit risk. Simply speaking, when the auditor fails to detect frauds, the auditor may end up in increasing his audit risk. So if you were the auditor, if you want to really reduce your audit risk to an acceptably low level, you must be in a position to identify frauds and errors. In order to identify frauds and errors, even analytical procedures helps a lot to the auditor. Why? Because if you follow analytical procedures, if you identify any deviations or variations or fluctuations in the ratios, you would start investigating into the reasons therefore. On investigation, sometimes you may find some genuine reasons. When there are genuine reasons for variations, there is no further duty on the part of the auditor to make an inquiry. However, when in the absence of genuine reasons, the auditor will suspect the existence of fraud. When the auditor suspects the existence of fraud, the auditor will try to focus more on such areas. Thereby, the auditor would be able to detect fraud. Thereby, the auditor would be able to detect material misstatements in the financial statements. Thereby, the auditor can provide an appropriate opinion. Thereby, the auditor can reduce the audit risk to an acceptably low level. So at least by now, you should be able to understand that there is a close relationship between the detection of frauds and following analytical procedures by the auditor. And auditor is made secondarily responsible for detection of frauds and errors. Since auditor is made secondarily responsible, somebody should have been made primarily responsible for that, and that person is nothing but management. In other words, management is made primarily responsible not only for detection but also for the prevention. So there are two major differences between the duties of the management and the duties of the auditor. Auditor's duty is secondary in nature, whereas management's duty is primary in nature. Auditor's duty or responsibility is limited or restricted only for detection of frauds and errors, whereas management's responsibility extends even to prevention. In other words, management of an entity is made responsible both for prevention as well as detection of frauds and errors. How do they discharge their primary responsibility? The only alternative available for the management to discharge their primary responsibility of prevention and detection of frauds and errors is to establish or introduce some controls called as internal controls. So through establishment of internal controls, organization is able to achieve its are able to discharge its primary responsibility of both prevention as well as detection of frauds and errors. That is point number one that we discussed about frauds. And the second one is such frauds can be classified broadly into two categories. The first one is employee fraud. The other one is management fraud. Whenever any employee of the organization was involved in fraud, it is called as employee fraud. Whenever management itself involves in a fraud, it is called as management fraud. Generally, employees of the organization may involve in fraud or may perpetrate fraud either through defalcation of cash or through misappropriation of assets. Employees will involve in fraud either through defalcation of cash or misappropriation of assets. And cash can be defalcated by the employees in many number of ways. The first one is through suppression of cash receipts. The second one is through inflation of cash payments. The third one is through including fictitious payments. And the fourth one is by adopting a technique called as teaming and lading. And whenever any employee involves in a fraud, I have given you an example for every point. What is suppression of cash receipts? Actual value of sale made by the employee is 100. Assume that employee recorded the value of the sale not as 100 but as 50. In that case, employee is able to defalcate cash to the tune of 50. Hence, it is said that employee was involved in fraud. Whenever any employee of the organization was involved in fraud, there will be a dual impact or multiple impact on the organization. On one hand, the organization will lose its valuable cash, and on the other hand, it is said that the financial statements of such an organization will get adversely affected. And most important thing that you must understand is when an employee involves in a fraud, he will certainly try to conceal it. In order to conceal the fraud, employee will try to record either fraudulent entries or fictitious entries into books of account. Based on such books of account which contains fraudulent and fictitious entries, financial statements are prepared. And hence it is said that financial statements contains mistakes or misstatements. In such case, financial statements may not reflect a true and fair view. That is the reason why I keep on telling you that whenever any employee of the organization was involved in fraud, financial statements do contain some mistakes or misstatements, and if such mistakes or misstatements are material in nature, financial statements will never reflect a true and fair view. And the second way is through inflation of cash payments, for which also I have given another example. Actual amount spent by the employee towards conveyance is 50 rupees, but it has been recorded in the books of account as 100. The third one is including fictitious payments, under which although there is no payment made by the employee, it will be recorded in the books of account that some payments have been made. That is technically called as fictitious payment. And I cannot repeat what we discussed under the heading teaming and leading, which is well known to you. Initially, if you receive some amount from the debtor, some portion of it will be misappropriated or defalcated, and to make adjustment of the debtor account, when you receive some amounts from the second debtor, some portion of the amount will be adjusted to second debtor account and some other portion may be adjusted to first debtor account. If this approach is followed by the employee, it is said that employee defalcated cash through following a method called as teaming and leading. And the other way in which employees of the organization may involve in fraud is through misappropriation of assets. That asset may be either a current asset or even a fixed asset, which is small in size. For example, let us assume that this is an asset to masterminds, and it is very easy for the employee to steal this asset. Done. Over. So, particularly when the asset is small in nature, the employees of the organization may tend to steal even fixed assets, and stealing of inventory is a common process that is followed by every employee. Why? Because when employee steals some inventories, he won't record the details of the items stolen by him either in the inventory records or in the books of account. That is the reason why management is made responsible to make physical verification of inventories at reasonable intervals and to reconcile book stocks with actual stocks so that they would be able to identify the difference. If differences are identified, then the organization will take either corrective action or preventive action, preventing employees from stealing physical stock. So, stock may be stolen by the employee, or else employees may even steal fixed assets, and sometimes employees may even steal intangible assets, for which I have already given you an example. The organization is in the process of development of a particular formula. A pharmaceutical industry is developing a particular formula. That formula is in development phase. Almost crores of rupees have been spent. The entire data has been there in the account, in the computer, and if you do not take proper precautions, an unauthorized person may enter into computer and may steal the data and may sell the data to your competitors. That is also called as stealing of assets. So assets may be physical or intangible assets. Asset may be either current or even a property, plant and equipment which is small in size. So that is another way through which employees of the organization would try to involve in fraud. By now, you should be able to understand that employees of the organization would try to involve in fraud either through defalcation of cash or through misappropriation of assets. And you can call it simply as misappropriation of assets. In that case, employees do record fraudulent or fictitious entries into books of account to conceal it, and hence books contains material misstatements, and hence financial statements prepared or based on such books of account will not reflect a true and fair view. That is point number one. The next one is the management fraud. As already said to you, whenever management of the entity involves in a fraud, it is called as management fraud. Usually management will not involve in fraud like an employee. In other words, management will not try to defalcate cash or misappropriate goods. There are some other ways which may be followed by the management to involve in fraud. Usually, management will try to resort to fraud through fraudulent financial reporting. Remember, this is a technical term. You must have to understand this. What is the way through which management will involve in fraud? Through fraudulent financial reporting. By preparing the financial statements wrongly and reporting such wrong financial statements, management will try to involve in fraud. That is technically called as fraudulent financial reporting. So how employees of the organization may involve in fraud? Through misappropriation of assets, including defalcation of cash. How management will try to involve in fraud? Through fraudulent financial reporting. Why should management involve in fraud? There is a logic behind involvement of employees in fraud, because the amount of salary that is being received by the employee may be very low, and employee may not be able, the means of the employee may not be able to sufficient his needs, and hence obviously because of some pressures, employee would involve in fraud. You can understand employee fraud to some extent. Then why management would involve in fraud? There are several objectives behind involvement of management in the fraud. The objectives include reduction of tax liability. When the management wants to reduce their tax liability, they want to show reduced profits. In order to show reduced profits, management will resort to fraudulent financial reporting. In that case, management may either undervalue the closing stock or overvalue the closing stock, may either overstate sales or understate sales, may either overstate purchases or understate purchases. Everything has been discussed by us in detail under the assertions, occurrence and completeness, both under the heading sales and under the heading purchase, under a chapter called as Audit of items of financial statements. So, and some other expenditure debited to trading account may be inflated. Expenditure debited to profit and loss account may be inflated. Excessive depreciation may be provided by creating wrong provisions or unreasonable provisions. Although an asset becomes bad, although an asset is a good debt, it may be treated as a doubtful debt. A provision may be created. Although asset is a good debt, it may be treated as bad debt, and it may have been written off to profit and loss account. Sometimes even revenue expenditure, capital expenditure may be treated as revenue expenditure. By following any one of these ways, management will try to reduce profits. Thereby management will try to reduce the tax liability. Thereby management can achieve its objective of reduction of tax liability. So there are several reasons why even management could involve in fraud. And we had some discussion about fraud both under section 143 subsection 12 of the Companies Act as well as under section 143 subsection 11 of the Companies Act. Under section 143 subsection 12 of the Companies Act, whenever you are carrying out an audit and when you come across any fraud done by either employees or officers of the company on the company which involves or expected to involve individually an amount of 1 crore rupees or more, then it is the responsibility of the auditor to communicate the details of such fraud either to the audit committee or to the board of directors within 2 days from the date of identification of such fraud, seeking their reply or observations within 45 days from the date of communication. Then the management is under obligation to provide reply or observations to the auditor. After receipt of such reply or observations from the management, within 15 days the auditor had to make a report to the central government through form number ADT4 that is required to be addressed by the auditor to the minister, to the Secretary, Ministry of Corporate Affairs in a sealed cover. It should be sent either through registered post with acknowledgement due or speed post followed by an email, and such ADT4 is required to be printed by the auditor on the auditor's letterhead, which should contain the name of the auditor, address of the auditor, contact number, telephone number, mobile number, email ID, etc. And the auditor should sign ADT4, should affix a seal, should provide his membership number also. This is what we discussed under section 143 subsection 12 of the Companies Act. However, if the auditor identifies a fraud having a value of less than 1 crore rupees, then there is no need on the part of the auditor to communicate the same to the central government. Instead, it is sufficient if the auditor communicates the same to the company concerned, to the board of directors or to the audit committee. In that case, there is no need on the part of the auditor to get any reply or observations from the board of directors. This is what we discussed under section 143 subsection 12 of the Companies Act. Later on, I made some modifications to my explanation also. Initially, on one day, I said that under section 143 subsection 12, it is the duty of the auditor to make a report to the central government only when the auditor is the first person to identify fraud. By the time you identified the fraud, if somebody else like cost auditor or a company secretary may have identified it and reported the same to the central government, there is no duty on your part as an auditor to make a report again. However, very recently NFRA has given a notification wherein NFRA clearly mentioned that although the fraud may have already been identified by some other person, if you identify the fraud, it is your responsibility to make a report to the central government. This is about 143 subsection 12. And the next one is 143 subsection 11. Under CARO, I said to you that whenever the auditor came to notice, or whenever the auditor identifies some frauds done either by the company or on the company, frauds noticed or reported. I said to you that it is not the duty of the auditor under this class to identify frauds. If anybody has identified frauds and they were brought to the attention of the auditor, whether that fraud is fraud on the management or fraud by the management, the same is required to be reported by the auditor to the shareholders under section 143 subsection 11. This is what we discussed about the concept of fraud till date in different areas of our syllabus. Now let us focus on precisely on what is fraud, how it takes place, who may involve in fraud, how they conduct fraud, and so on under essay 240. Fraud and responsibilities of the auditor. What is the definition of fraud? Definition of fraud and the characteristics and types of fraud. Fraud can be defined as per essay 240, fraud can be defined as an intentional act. If you do any activity intentionally to deceive the other party, then that is technically called as fraud. Either employees may involve in fraud, management may involve in fraud, even persons though charged with governance may involve in fraud, sometimes outsiders may also involve in fraud on the organization. Why they are involving in fraud? To get some unjust or illegal advantage by deceiving others. By deceiving others, if you want to get some unjust or illegal advantage, you will try to involve in fraud. That is all about fraud. And another important thing that I explained to you is in internal controls chapter is that sometimes management may try to involve in fraud through overriding internal controls. Through overriding internal controls. Employees will try to involve in fraud through collusion. That is another area we discussed about fraud under the heading internal control. Now read it. Define the term fraud and discuss the characteristics and types of fraud. Essay 240 defines the term fraud as an intentional act by one or more individuals among management. Intentional act by whom? By one or more individuals among management, those charged with governance, employees, third parties, involving use of deception to get or to obtain an unjust or illegal advantage. Characteristics of the fraud. Fraud is intentional in nature. Remember, auditor is concerned with only those frauds which will have an impact on the truthness and fairness of the financial statements. For example, if the managing director of the company has done a fraud in his individual capacity which is unrelated to the business, is it necessary for you as an auditor to report such fraud to the shareholders? No. You are required to focus on such frauds which are having an impact on the entity's financial statements. Personal frauds are not required to be focused by the auditor. Read it. Fraud is intentional, although fraud is a broad legal concept and the auditor is a broad legal concept. The auditor is concerned only with the types of fraud that causes a material misstatement in the financial statements. Remember, misstatements are the results of either dash or dash. Misstatements are the results of either fraud or error. Unless you understand this statement, you cannot understand the importance of fraud in your lifetime and the duties of the auditor in respect of fraud in your lifetime. So be careful. When there is a fraud, there will be a mistake or misstatement. When there is an error, there will be a misstatement. So misstatements in the financial statements are the results of either fraud or error. That is the basic point that every one of you must understand. Types of frauds which are well known to you. I said to you that employees may involve in fraud, that fraud being called as employee fraud, and usually employees will try to involve in fraud through dash. Misappropriation of assets. Generally, management will resort to fraud through dash. Fraudulent financial reporting. So, whenever you find the term fraudulent financial reporting, you can deem it as dash fraud. Management fraud. Whenever you identify a term misappropriation of assets, you can treat it as dash. Employee fraud. That's it. This is about the definition of fraud and the characteristics and types of fraud. What are characteristics of fraud? It is intentional. That is the only major characteristic of fraud. Types of frauds are two. One is employee fraud, the other one is management fraud. Employee will involve in fraud through misappropriation of assets, whereas management do involve in fraud through fraudulent financial reporting. Now, question number 2. Detection of frauds is the responsibility of an auditor. I said to you earlier that it is the secondary responsibility of the auditor. Primary responsibility always lies with management. Management responsibility to prevent and detect frauds. Management is responsible both for prevention and detection. As per SA 240, the primary responsibility for the prevention and detection of frauds rests with both those charged with governance and the entities and the management of the entity. Then what is auditor's responsibilities for detection of frauds and errors? Remember, here management is made responsible for prevention and detection, whereas auditor's responsibility is limited or restricted only to detection. And the points that I am going to discuss are those points which we had a discussion elaboratively in the past. Most of those points have already been covered in our discussion. If anything found to be new, which is not understandable to you, in my opinion, I will try to explain it. If you are having any problem in understanding any of these points, feel free to ask me, I will explain it. Auditor's responsibility for detection of frauds and errors. Point number 1. As per standards on auditing, the auditor is responsible for obtaining a reasonable assurance about whether financial statements taken as a whole are free from material misstatements. You need to check whether financial statements are free from material misstatements. Why? Why? To form an opinion. If you find that financial statements are free from material misstatements, you can conclude that they are reflecting a true and fair view, and hence you may conclude to issue an unmodified opinion. So to decide about the type of the opinion, first of all, the auditor should have to conclude that financial statements are free from material misstatements. What are the causes of material misstatements? What is the root cause of existence of material misstatements in the financial statements? Frauds and errors. If you fail to identify frauds, what may happen? You may fail to identify material misstatements. If you fail to identify material misstatements, what may happen? You may end up in giving a wrong report. If you have given a wrong report, what may happen? The auditors could be more. Remember, this standard focus only on fraud, not on error. Why error is left from this standard? Because fraud is more dangerous than error. Fraud is intentional, error is unintentional. When a person involves in a fraud, he'll get some benefit. In order to get the benefit again and again, the person will again and again try to involve in fraud. That is the reason why dash is recurrent in nature. Fraud is recurrent in nature. In case of error, employee do not know that he is doing something wrong, and hence employee will not get any benefit. When you are not getting any benefit out of an activity, you won't try to repeat it. Therefore, fraud is repetitive in nature, whereas error is not. That is the reason why SA 240 focus more on frauds rather than on errors. So as per standards on auditing, every auditor is responsible for obtaining a reasonable assurance whether the financial statements taken as a whole are free from material misstatements. When obtaining this assurance, the auditor is responsible to maintain an attitude of professional skepticism throughout the period of audit. Unless the auditor maintains an attitude of professional skepticism, it is quite impossible for the auditor to detect frauds. Professional skepticism helps the auditor in asking right kind of questions. Why? Because under the heading professional skepticism, always the auditor is expected to maintain a healthy degree of doubt. Auditor will always have a healthy degree of doubt that either management or employees could involve in fraud in the current year, although they have not involved in the fraud in the past years. So there is every chance that either employees or management could involve in fraud in the current year. Keeping that in mind, if you perform your work, it is said that you are maintaining professional skepticism, which is technically called as healthy degree of doubt, which will help the auditor in identifying frauds. So if you really want to identify frauds, you should have a dash degree of mind, a healthy degree of doubt or healthy degree of mind. Doubt. So, when obtaining reasonable assurance, the auditor is responsible for maintaining an attitude of professional skepticism throughout the audit. This is also explained to you. Auditor failed to detect an error, which is not risky to the auditor. If the auditor fails to detect a fraud, it will be risky to the auditor. Why failure to detect fraud is more riskier to the auditor than failure to detect an error? Because fraud is recurrent in nature. If you fail to detect fraud, the impact on the financial statements would be material. If you fail to detect a material mistake, if you fail to detect a mistake that may be material or may not be material. That is the reason why if the auditor fails to detect a fraud, it is more riskier to the auditor than failure on the part of the auditor to detect an error. The risk of not detecting a material misstatement resulting from fraud is higher than the risk of not detecting one resulting from error. And the risk of this is an important statement. Be careful in understanding this. Fraud is of two types. Just now I proved that fraud is more dangerous than error. So risk of when the auditor fails to detect frauds, then there will be more risk to the auditor. When the auditor fails to detect error, there will be lesser risk to the auditor. In case of frauds also, there are two types of frauds. The first one is employee fraud, the other one is management fraud. Generally, the magnitude, the amounts involved in case of employee fraud may be less when compared with the magnitude of the management fraud. Generally, magnitude in case of management fraud is very, very high. Magnitude of employee frauds is less. If you fail to detect an employee fraud, it may not be much riskier to you as an auditor. If you fail to detect management fraud, it will be more riskier to you as an auditor. Therefore, as an auditor, we should focus more on dash frauds. And as an auditor, we should always try to identify or detect management. We should always try to identify or detect management frauds. So, the risk of the auditor not detecting a material misstatement resulting from management fraud is greater than the employee fraud. Next, these are all just characteristics of fraud, that's it. And because of these reasons, as an auditor, you should be more careful while conducting audit. That is what he wants to prove. The auditor's ability to detect a fraud depends on factors such as skillfulness of the perpetrator. If the perpetrator is more skillful, more experienced in doing frauds, and if the auditor is new to the field, obviously it is very difficult for the auditor to find out such frauds. So, skillfulness of the perpetrator and experience of the person committing the fraud, they both are one and the same. Then the degree of collusion involved. If more and more people colluded with one another, identifying or detecting such type of frauds is very, very difficult. If only one person committed the fraud, detecting the fraud committed by only one person will become easier. Why? Because in case of a collusion, the work carried out by one person will be checked and authorized by another person. All the persons colluded with one another, and hence work carried out by one person has not been verified by another person. In such case, when the number of persons colluded in committing fraud is high, possibility of detecting such fraud is also very difficult. Similarly, it also depends upon whether the auditor is able to detect fraud or not, is also dependent upon the size of the fraud. If the amount involved in fraud is say immaterial in nature, it may be highly impracticable for the auditor to detect fraud. If the amount involved is high are material in nature. Obviously, since we focus on material items, we would be able to identify fraud. So the chances of detection of fraud is more when the value of the fraud is high. The chances of detecting the fraud is very less when the magnitude of fraud is very less. Supposing that an employee involved in a fraud of 10 rupees, in that case, will you try to focus on that fraud? Will you try to focus on the transaction having a value of just 10 rupees? May not. In that case, the chance of identifying or detecting such type of frauds is less. When the value is more, obviously the possibility of occurrence of fraud is more, and hence we focus more on such transactions, and hence it is possible that the auditor may identify or detect frauds. So whether the auditor is able to detect a fraud or not is dependent upon several factors, such as the skillfulness of the perpetrator, otherwise called as experience of the person committing the fraud, the degree of collusion, the amount of fraud, frequency of fraud. If the fraud is frequently committed at one point of time or other, auditor would be able to identify it. If the fraud is not committed frequently, it is only once, it may be difficult for the auditor to identify the fraud. So these are all the factors on the basis of which it depends on whether auditor is able to detect fraud or not. Then the liability of the auditor for failure to detect fraud exists only when such failure is clearly due to not expressing reasonable care and skill, not exercising reasonable care and skill. I proved you lot of times that auditor will not be held liable or responsible when it is proved that he performed his work with utmost skill, care, caution, competence, and without negligence. I repeat, if you are able to carry your work with utmost skill, care, competence, caution, and without negligence, and more importantly, if you are able to prove that, then you will not be held responsible or liable. Supposing that you have given a report which ultimately proves to be a wrong report or inappropriate report. Now, one of the shareholders of the company who made use of your inappropriate report suffered with some loss and has gone to court of law against you, stating that our auditor is very much negligent in carrying out his work. Hence, our auditor has given an inappropriate opinion. Because of that depending on such inappropriate opinion, I made some decisions. My decisions proved to be wrong. I suffered with a loss. This is due to wrong report given by our auditor. Therefore, our auditor shall indemnify this loss. That is the allegation made by a shareholder on the auditor in the court of law. Now, court make the auditor liable. It all depends whether the auditor is able to prove that he performed his work with utmost skill, care, caution, competence, and without negligence or not. In other words, if you were the auditor, if you are able to prove that you performed your work in such a way, then you would not be held responsible or liable even if you issue a wrong report. Simply speaking, as an auditor, you should be able to prove that we carried out our audit in accordance with generally accepted principles of auditing in India. Auditor should be able to prove that he carried out his audit in accordance with generally accepted principles of auditing in India. What are generally accepted principles of auditing in India? Standards on auditing. So if you are able to prove that you performed your work in accordance with standards on auditing, then although the opinion given by you is wrong, you will not be held responsible or liable because you have taken every care while conducting the audit. You performed your audit with the adequate set of skill, competence, care, etc. and hence you are not liable or responsible. This is the reason why in the audit report also it is necessary for the auditor, in the audit report also under the heading basis for opinion paragraph, it is necessary for the auditor to declare that he performed his work his audit in accordance with the generally accepted principles of auditing in India. In accordance with the generally accepted principles of auditing in India. You can just go through the basis for opinion paragraph under SA 700. There you find that the auditor has made a declaration to the users of the financial statements that he has carried out his work in accordance with generally accepted principles of auditing in India. What are generally accepted principles of auditing in India? Standards on auditing are called as generally accepted principles of auditing in India. So if you perform your audit in accordance with standards on auditing, it is said that you performed your audit audit by following generally accepted auditing principles. As a part of following generally accepted auditing principles, the auditor is required to maintain audit documentation, otherwise called as working papers, otherwise called as work papers. If you are able to show the work papers to the court, and if you are able to prove that you performed your audit in accordance with the GAAP, then you will not be held responsible or liable. That is the reason why it is always important for you as an auditor to maintain dash in respect of every independent audit. To maintain audit documentation, otherwise called as working papers or otherwise called as work papers, because auditor had to save his skin. If you want to save your skin, you need to prove that you performed your work in such a fashion. For that, you need to maintain audit documentation. Another important point where another important logic behind the maintenance of audit documentation by the auditor is that sometimes a peer reviewer would have been appointed on the auditor by the CA Institute. In that case, the peer reviewer may ask the auditor about whether he is following audit standards. If the auditor has given a reply saying that yes, then the peer reviewer may ask you to provide audit documentation in respect of a particular audit. In that case, you should be able to prove that you maintained audit documentation to the peer reviewer. That is the reason why every auditor is under obligation to maintain audit working papers or work papers or audit documentation, which was dealt with in SA 230. The liability of the auditor for failure to detect fraud exists only when such failure is clearly due to not exercising reasonable care and skill. In other words, if the auditor acted negligently, then only the auditor would be held responsible or liable. If the auditor can prove with the help of his working papers, that is documentation, that he has conducted the audit in a proper manner, he cannot be held responsible for the same. Now read all the points once again. What are the responsibilities of the auditor in respect of detection of frauds and in respect of detection of frauds and errors? As per standards on auditing, the auditor is responsible for obtaining reasonable assurance whether financial statements taken as a whole are free from material misstatements. When obtaining reasonable assurance, the auditor is responsible to maintain an attitude of professional skepticism. If you are able to maintain an attitude of professional skepticism, you would be able to have some doubt about the existence of fraud. When you are having a doubt about the existence of fraud, you will investigate into the reasons. When you investigate into the reasons, it is most probable that the auditor would be able to detect fraud. So that is the reason why it is said that if auditor maintains dash, there is a high chance that the auditor would be able to detect frauds. When the auditor maintains professional skepticism, there is a high chance that the auditor would be able to detect fraud. Therefore, to detect frauds, what the auditor should do? The auditor is expected to maintain professional skepticism throughout the period of audit. And the next one is the risk of not detecting a material misstatement resulting from fraud is higher than the risk of not detecting from error. That means if you fail to detect a fraud, then your responsibility will be more than failure on your part to detect an error. The next one is the risk of auditor not detecting a material misstatement resulting from management fraud is greater than the employee fraud. The next point is the auditor's ability to detect fraud is dependent upon several factors. The next one is liability of the auditor for failure to detect fraud exists only when such failure is clearly due to not exercising reasonable care and skill. If the auditor can prove with the help of his working papers that the audit is properly performed, then he cannot be held responsible or liable for the same. This is about question number 2. Now let us focus on question number 3. This is a good point. Why management involves in fraud, or why employees of the organization involves in a fraud? What forces them to involve in fraud? What drives them to involve in fraud? Generally, there are 3 factors which may drive either an employee or the management to involve in fraud. The first one is pressures or incentives. If you get some incentive by involving in fraud, you will always try to involve in fraud. That is called as incentive. Sometimes you may not get incentive, but you may be pressurized to involve in fraud. You may be pressurized to involve in fraud. In that case also, to meet the pressures, you may try to involve in fraud. Last time, you got 35 marks out of 100. Now, your parents are asking you to get at least 90 marks in the next examination. You promised your parents that you are going to get 90 marks in the next examination, and in the next examination, you got only 9 marks. Progress report has been given, and it is shown in the progress report that you got 9 marks, and you have already given an assurance to your parents that you will get 90, but you get only 9. In that case, in order to prove yourself, in order to prove that you really got 90 marks, what will you do? You will add 0 as a suffix to 9. That means you made a mistake. You have done a fraud. Why you have done a fraud? Because already you have created some pressure on yourself saying that you are going to get 90 marks in the next examination. Because of that pressures, employees would try to involve in fraud. So pressure or incentive is the first reason why either management or employees would involve in fraud. The second one and the most important one is, although you are having an intention to involve in fraud, if there is no opportunity, it is not done. It cannot be done. Are you able to follow this point or not? There should be an intention on the part of the employee or on the part of the management to involve in fraud. That is point number 1. Or pressure. If you involve in fraud, you will get either incentive or you should have some pressure to involve in fraud. That is all point number 1. Point number 2, if you would really want to involve in fraud, there should be some opportunity to involve in fraud. When there is no opportunity to involve in fraud, although you are having an intention to involve in fraud, it may not be possible for you to involve in fraud. Therefore, there should be opportunity to involve in fraud, which will provide an opportunity either to the employee or to the management to involve in fraud. Deficiencies in internal controls. What is that? Deficiencies in internal controls. If there are some deficiencies in internal controls, if an employee knows such deficiencies, I have proved this also. Management has not established a procedure whereby the head of the sales department is not required to communicate with the stock department before acceptance of the purchase order, taking advantage of that deficiency or lack of internal control, employee was involved in fraud. So, when there is a deficiency in internal control and or where there are no internal controls at all, they provide opportunity either to dash or to dash. Either to employee or to management to involve in fraud. In case of management, they will straight away override internal controls. In case of employees, they will try, if the employee knows that there are some deficiencies in internal controls, they perceive an opportunity to involve in fraud. Employees perceive, expect an opportunity for them. It is an opportunity for them to involve in fraud. What is the opportunity which is giving opportunity to the employee? Non-existence of internal controls or existence of defective internal controls is providing some opportunity to the employees to involve in fraud. And the third one is rationalization. What is that? You know very well that what you are doing is wrong, but still you will support it by saying that since they have done like that, I have done like this, and hence it is not a fraud. For example, you are anticipating an increase in your salary for the last 10 years. And this year, you certainly management has given a promise to you that you will get an increment in your salary. You are expecting an increment of at least 100% in your salary because there is no increment for the last 10 years. Management increased your salary by 1%. By 1%. Previously, you are getting a salary of 10,000. Now you are getting a salary of 10,010 rupees. In order to take revenge, what will you do? You will certainly try on management. You will certainly try to involve in fraud. You know very well that you are doing or committing a mistake. You are doing a fraud, but still you won't feel. Why? Because you will try to rationalize the thing that you are performing. You are doing a wrong thing that is known to you, but still what you will say is, when the management has not given proper increments to us, and if I involve in fraud, it is not wrong with regard to management. I am just taking revenge over the management by involving in fraud. In that way, employee will try to rationalize the thing. That is called as a rationalization. Because of these three things, either employees or management would involve in fraud. What are they? The first one is incentives or pressures. The second one is perceived opportunity to involve in fraud. And the third one is rationalization. Sometimes the attitude of the management or employees are such that although they know that they are doing fraud, they won't feel for anything. They will certainly try to involve in fraud. That in that case, violation of laws would be a major area of concern for the auditor. Read it. What are the factors which cause the fraudulent financial reporting? What are the factors which cause fraudulent financial reporting? That means management fraud or misappropriation of assets. That is employee fraud. So the following three are nothing but dash. The following three are nothing but dash factors. Factors which cause either a management fraud or employee fraud. Following are the factors which lead to cause the fraudulent financial reporting or misappropriation of assets. Pressures. I said to you that pressure bar incentive is reason number 1. Point number 2, perceived opportunity. Point number 3, rationalization by the individuals. Fraudulent financial reporting can occur when the management is under pressure from sources outside or inside the entity, say to achieve an expected earnings target. For the last 5 years, there is a growth of 10% in the net profit of an entity. For this year also, the general public started expecting an increase in the net profit to the tune of 10%. But unfortunately, when the organization prepared their draft set of financial statements, they find that there is no increase in net profit, there is a reduction in the net profit. Organization knows very well about the expectations of the general public. General public are expecting another 10% increase in the net profit, but this time the organization suffered with a loss because they are anticipating or expecting from us in order to meet such expectations or anticipations, which creates pressures on the management. Management could decide to report a dash against a dash. Could decide to report a profit against a loss. Why the management decide to report a profit against loss? Because to meet expectations of the general public over the entity. So, your parents are expecting 90 from you, you got only 9, and hence in order to meet the expectation of the parents, what you did, you involved in fraud. That's it. So, fraudulent financial reporting can occur when the management or even employee is under pressure from sources outside or inside the entity, say to achieve an expected earnings target. Perceived opportunity. When an individual believes internal controls can be overridden. For example, when an individual has knowledge of specific deficiencies in internal control, they perceive an opportunity to involve in fraud. There is a deficiency in internal control. Even if we involve in fraud, nobody is going to identify it. Nobody is going to punish us. That force or drive the employee to involve in fraud. And the last one is rationalization. Individuals may be able to rationalize committing a fraudulent act. Some individuals possess an attitude, character, or set of ethical values that allow them knowingly and intentionally to commit a dishonest act. This is about rationalization. So, this is all about question number 3. What are the factors which cause employee fraud or management fraud? They are 3 in number. First one is incentive or pressure. The second one is perceived opportunity. And the third one is rationalization. Next, question number 4 is not required to be prepared by you because you will come to know about this question in the next questions. But I will try to explain it. There is no need to prepare for this. Fraud risk factors. What is a fraud risk factor and why fraud risk factors are important for the auditor? This is what you must understand. What is a fraud risk factor and why such fraud risk factor is important for the auditor? If the auditor is able to understand fraud risk factors, it is highly possible that auditor would be able to detect frauds as well. If you are able to understand factors which lead to frauds, it is highly possible that the auditor would be able to detect frauds as well. So what factors are driving the employees or management to involve in fraud? If you are able to identify that, then you will be able to detect fraud. That is the reason why every auditor must have some knowledge of dash factors, fraud risk factors. Why they are important for the auditor to detect frauds? What is fraud risk factor? Fraud risk factors refers to events or conditions that indicate an incentive or pressure to commit fraud or provide an opportunity to commit fraud. For example, the examples of even if you are unable to understand the exact meaning of this, don't worry. We are going to have a discussion of almost 3 questions on this point called as fraud risk factors. The first one is fraud risk factors relating to management fraud. The second one is fraud risk factors relating to employee fraud. After understanding those risk factors, there is nothing to read under question number 4. For each of these types of frauds, risk factors are further classified based on 3 criteria. The first one is incentives or pressures. The second one is opportunities. The third one is attitudes of the employees or rationalization. Now, question number 5. This is nothing but management fraud. Read the question and try to understand the question. Why fraudulent financial reporting is committed? Who will commit fraudulent financial reporting? Management. Why should management involve in fraud? Auditors require great intelligence for detection of manipulation of accounts because generally top management is associated with this type of fraud. As already said to you, top level management involves in a fraud through fraudulent financial reporting. Financial statements are wrongly prepared and they are reported. For a wrong preparation of financial statements, accounts will be manipulated by the management, and because the top level management itself was involved in the fraud, it is very difficult for the auditor to identify that fraud. Therefore, you must be very careful with respect to management frauds, and more importantly, magnitude of management fraud is more than the magnitude of employee fraud. Auditors require great intelligence for detection of manipulation of accounts because generally top management is associated with this type of fraud. This type of fraud is generally committed for various reasons. Why management commit fraud? For various reasons. One, to avoid for various reasons or for various reasons to avoid incidence of income tax. To avoid incidence of income tax or other taxes. This has already been explained to you. Second one, for declaring a dividend when there are insufficient profits. Management is having an intention to declare dividend. If you get profit, then only you can declare dividend. Otherwise, you must have to declare dividend out of surplus account or out of general reserve, balance in general reserves. There is no balance in surplus account. There is no balance in general reserves. Still, the organization wants to declare dividend. For the current year, they suffered with a loss. Is it possible for the organization to declare dividend in such case? In that case, how to meet their intention, how to discharge their intention? By reporting a profit, although the organization has not earned any profit. That is nothing but management fraud for declaring dividend when there are insufficient profits. Why I have explained this point elaboratively to you is that there is a link between point number 2 and 3. They are contrary to one another. If you are able to understand point number 2, it is easy to understand point number 3 without explanation. To withhold declaration of dividend even when there is adequate profits. In the first scenario, although you suffer with a loss, you may report a profit. In the second scenario, although you got a profit, you may report a loss. For various reasons, management could involve in fraud. These are some of the reasons why management could involve in fraud. For receiving, this is a very good point. For receiving, fortunately, this was already explained to you. If your remuneration is linked to performance, if your remuneration is or compensation is linked to performance. I am a sales manager. My monthly salary is 1000 rupees. But if I am able to achieve a turnover of 1 crore, I will get a remuneration of 10% of turnover. Now my total turnover is only 88 lakh rupees. If I am able to achieve a turnover of another 12 lakh rupees, then the turnover would become 1 crore. I will be able to get an amount of 10 lakh rupees. In which case, it forces the employees to record a fictitious sale of 12 lakh rupees. Thereby, total value of sale will become 1 crore. I will get an amount of 10 lakh rupees. All this being done by the employee simply because dash is linked to dash. Remuneration or the employees amounts that are required to be paid to the employees is linked to their performance. For receiving higher remuneration, where managerial remuneration is payable by reference to profits. Because of all these reasons, dash may involve in fraud. Management may try to involve in fraud. First of all, to avoid taxes. Second one is to declare dividend when there are insufficient profits. Third one is to withhold declaration of dividend when there are adequate profits. And fourth one, to get higher managerial remuneration, particularly where managerial remuneration is payable with reference to profits. The next question number 6. Discuss the techniques by which fraud can be committed by management, overriding controls in view of fraudulent financial reporting. How do management commit fraud? Previous question is, why do management commit fraud? The present question is, how do management commit fraud? Have you understood the difference between the previous question and the present one? If you do not understand the difference in the question, you cannot understand the answer. Even though you are able to understand the answer, you cannot enjoy it. So in the previous question, they focused on why management could involve in fraud. In the present one, they try to explain us about how management will try to involve in fraud. The first one. And fortunately, the term overriding controls has already been explained to you in the previous session. Discuss the techniques by which fraud can be committed by the management, overriding controls in view of fraudulent financial reporting. Following are the techniques by which fraud can be committed by the management. Overriding controls. What is meant by overriding controls? The person who established internal controls, who is also expected to follow them, may try to violate them. It is technically called as overriding of controls. Several examples were given to you in the past. I don't want to explain it further. Management may ask or direct the employee to record a fictitious entry. If you were the employee, if your management is asking you to record a fictitious entry, would you try to record fictitious entry, or would you try to tell to the management, sir, that sorry sir, this is not acceptable, you are trying to involve in fraud, this is not correct, I don't want to record any fictitious entries in the books of account? Can you say like that to your manager, your management? No. If you say like that, you will lose the employment immediately in the next moment. So management, this is not cinema. ఇదేం సినిమా కాదు, అంటానికి పో అంటాడు కాబట్టి మూసుకుని అడి చెప్పింది చేయాలి. సో when the management is asking the employees to do a particular thing in a particular way, there is no other option for the employee but to do that. So management itself is overriding internal controls. In that case, employee had to follow or obey the instructions given by the management. Therefore, management may instruct the employees to record fictitious entries. By recording fictitious entries in the books of account, management could involve in fraud. I have already proved to you that whenever you want to involve in fraud, either you need to record dash entries or dash entries into books of account. Either you need to record fraudulent entries or fictitious entries into books of account. Read it. Following are the techniques by which fraud can be committed by the management: overriding controls, recording fictitious journal entries, particularly close to the end of the accounting period, to manipulate operating results. So recording fictitious journal entries is the first way through which management could resort to fraud. Next one, inappropriate. Everything is understandable to you, provided you got some knowledge about standards on auditing. Point number 2, inappropriately adjusting assumptions and changing judgments used to estimate account balances. Fortunately for this, I have given you an example. I am a dealer in TV. I am a dealer in TVs. and I create provision to meet warranty claims or guarantee claims. This point has been explained to you when I am explaining the term how to verify contingencies and provisions under the heading Audit of items of financial statements. For example, as per my past experience, 10% of the TVs sold by me will be returned back within the warranty period or guarantee period of 2 years. And I need to spend an average amount of 500 rupees for repairing each and every TV set. I want to involve in fraud. I want to reduce my profit. I want to reduce my tax liability. In that case, what could I do? Instead of taking an assumption that 10% of the TV sets may be returned back within the warranty period of guarantee period of 2 years, I will try to make that assumption as 50%. Instead of taking 500, I will try to take it as 5,000. In that case, I will provide higher amount in respect of warranty claims or guarantee claims. If I provide higher amount in respect as provision in respect of warranty claims or guarantee claims, what does it result in? It results in reduction of profit. Thereby I can achieve my target of reduction of tax liability. That is the way in which management could resort to fraud by by adjusting dash. In the given example, the assumption that should have been taken by the management is 10%, but the assumption taken by the management is 50%. Assumption that should have been taken by the management is 500. Assumption that was made by the management is 5,000. Thereby, management is able to achieve its stated objectives. So, inappropriately adjusting assumptions and changing judgments used to estimate account balances. Why do we understand these things? If the auditor is able to understand these things, auditor will have a generalized idea. Okay, these are all the reasons why sometimes even management could involve in fraud. These are all the ways through which management could involve in fraud. If everything relating to fraud is known to you as an auditor, there is a high chance that you would be able to detect frauds. That is the reason why you are learning all these things under the heading SA 240. If you do not know the objective why you are learning SA 240, there is no point in reading and understanding this. Okay, so all these things will help you as an auditor tomorrow to detect dash, to detect frauds committed either by dash or by dash, either by management or by employees. The third one is, this is very easy to understand. I have explained this in the past lot of times. Omitting transactions in the financial statements. What does it mean? Omitting a transaction from the books of account. If you omit a transaction from the books of account, transaction has taken place. It should have been recorded into the books of account, but has not been recorded into the books of account. By omitting to record a transaction in the books of account, you are making changes to your financial statements and you are achieving your objective of reduction of tax liability and thereby reduction of profit, thereby reduction of tax liability. So, how management could involve in fraud? Although a transaction took place, although transaction is required to be recorded, management may decide not to record the transaction or omit to record the transaction into the books of account. By that way, management could resort to fraud. Similarly, advancing recognition of a transaction, delaying recognition of a transaction. This has been elaboratively explained to you. Revenue pertaining to the next year would have been advanced to the current year. Revenue pertaining to the current year would have been delayed or postponed to the next year. Expenditure relatable to the next year would have been preponed and has been recognized in the current year. Expenditure relating to the current year would have been postponed and recognized in the next year. All this will lead to wrong preparation of financial statements. All these have been done by whom? By the management, with an intention either to reduce profit or to inflate profit. That means management was involved in fraud, either through advancing or through delaying recognition of transactions or completely omitting to record the transactions into books of account. The next one is, this is a very good point, and I hope every one of you should be able to understand this point without any explanation. But unfortunately, even after explaining this to you again, you may not be able to understand it. Please try to read it and please offer your comments on point number 5. What is point number 5? No, 4. Concealing, stop there. Concealing facts that could affect amounts recorded in the financial statements. A case is pending against the organization in a court of law. Litigation. It may even affect going concern, or sometimes the entity would have to create a provision. A provision is required to be created, but may not have been created by the management. Management has not disclosed the fact that there is a litigation pending before court of law. Why the management concealed? Why the management concealed or has not disclosed the fact that some litigation is pending before court of law? If that is disclosed in the financial statements, then auditor would ask the management about what would be the probable future outcome of that case. And if the auditor is of the opinion that the organization is there is a high chance of losing that case, auditor will insist the management to create a provision. If management is forced to create a provision, that would have an impact on their profitability. They don't want their profits reduced, and hence management has not disclosed or has concealed a fact which should have a material impact on the financial statements. So by concealing some facts or by not disclosing facts that could affect amounts recorded in the financial statements, management could resort to fraud. The next one is easy to understand. Management will try to enter into complex transactions. Several transactions have taken place between holding and different subsidiary companies. They are very holding and subsidiary concept is complex. If more and more number of transactions have taken place in between holding and their several subsidiary companies, obviously involvement of management in fraud could be easy by entering into such complex transactions with subsidiary companies, etc. So involving in complex transactions, management would try to involve in fraud, or doing some complex transactions, entering or recording some complex transactions in the books of account. Management could try to involve in fraud. That's it. Enough. And finally, altering records and terms relating to significant or unusual transactions. Alteration of records is another way through which management will try to involve in fraud. An amount of 100 may be made 1000. That is called as alteration. Falsification. Alteration can also be called as falsification. Entering wrong entries into books of account, fictitious entries into books of account, omitting transactions to be recorded from books of account. By doing everything, management will try to involve in fraud. This is about question number 6. Discuss the techniques by which fraud can be committed by the management. Overriding controls. In what we are reading is not a chapter, it is a standard. The number of the standard is SA 240. Responsibilities of the fraud and responsibilities of the auditor. That's it. This is question number 6. Now, question number 7. What are the ways for committing fraudulent financial reporting? In other words, how to manipulate accounts. Please read it. I don't want to explain even a single word out of it. Please read it on your own. While reading it on your own, you should have an intention to understand it. Don't just try to read it. It's of no use. Try to understand it while you are reading. What is the question? What are the ways? Don't try to read question number 1. Instead, try to go through question number 2. What is question number 2? How do management involve in manipulation of accounts? Manipulation of accounts is the last point under the previous question. Yes or no? Altering records is nothing but manipulation or falsification will be done through alteration of records. How do they manipulate accounts? The following are the ways the management follow to manipulate accounts. Methods for committing manipulation of accounts. Manipulation, falsification or alteration of accounting records from which financial statements are prepared, such as inflation of purchase. What is that? Inflation of purchase, inflation of expenses, suppressing purchase, suppressing expenses, inflation of sales, inflation of items of income, suppression of sales, suppression of items of income, making adjustments to the value of inventory. It may be either opening inventory or even closing inventory, omitting to adjust outstanding liabilities or prepaid expenses or misrepresentations. What happened? Outstanding liabilities are not adjusted, financial statements gets materially misstated. Yes or no? Salaries paid 1 lakh, salaries payable 1 crore. This was not reflected in the books of account. What will happen? Books of account will not reflect a true and fair view. That is omitting to adjust outstanding liabilities or prepaid expenses, etc. This is a very good point and fortunately known to you. Misapplication of principles, accounting principles, such as charging items of capital expenditure to revenue or vice versa. These are all the things that the management could do to manipulate accounts. Everything is one and the same. There are several ways, that's it. They have divided the entire standard into different questions by framing questions. Everything is one and the same under essay 240. All these things, you can find all these things under one paragraph in essay 240. They divided into different questions. That's it. Now, this is the most important one. We had a discussion about definition of fraud risk factors. When the auditor identifies a fraud risk factor, it should alert the auditor, and the auditor should exercise more care and caution in respect of such items. I repeat, if during the course of performance of audit, the auditor comes across any one of the following fraud risk factors, if during the course of performance of audit, the auditor comes across any one of the following fraud risk factors, then there is a high chance that management of the entity could have already involved in fraud. Therefore, you must be very careful so that you would be able to detect management fraud in these scenarios. So, you need to search for these indicators. As an auditor, you need to, first of all, understand these indicators. Try to search for these indicators while you are carrying out the audit. If you find any one of these factors or indicators while you are carrying out audit, there is a high chance that already dash could have involved in dash. Management could have involved in fraud. So these factors will help the auditor in detecting dash management fraud. If you observe these factors, there is a high chance that management could have already involved in fraud. If you focus more on those things, you will be able to detect such frauds. So that is the reason why they are called as fraud risk factors relating to management fraud. Instead of management fraud, they use the word fraudulent financial reporting. Are you able to follow me? Write about risk factors relating to misstatements arising from fraudulent financial reporting. As already said to you, risk factors were always divided into three broad categories. The first one is incentives or pressures. The second one is opportunities. And the third one is attitudes or rationalization. Okay. Now read it. The following are the risk factors relating to misstatement arising from fraudulent financial reporting. This point is very difficult to understand unless you try to understand the introductory point. If you are able to understand this point, understanding all these things is very, very easy to you, because all these things relate directly to this point. All the 7 points that are appearing under point number 1 are directly relatable to the introduction. So first of all, try to understand the introduction so that these points need not be elaboratively explained to you. Ready? Sometimes the profitability of the entity, sometimes the profitability of an entity may get affected, or may get threatened. Sometimes the profits of the entity under your audit, the profits of the entity under your audit may get affected or threatened by economic or industry or other operating conditions. Because of several reasons, the profits of the entity under your audit may have been threatened, may have been impacted. In that case, what the entity could try to do, since there is a negative impact of these economic, industry or operating conditions on the entity's profitability, although entity got a loss, they will always try to show a rosy picture. They will try to portray a rosy picture, although they are suffering with a loss. In order to do, it is nothing but technically called as window dressing in auditing. What is that? I don't know whether you know very well about what is window dressing. That is the reason why instead of using the term window dressing, I am using the term rosy picture. The entity is suffering with losses, but still they want to show to the general public that nothing is happening, everything is good, everything is going on well, and for that purpose they may try to report dash. So on one hand they are suffering with losses. To cover it up, they are trying to show profits. In that case, the possibility of management involvement in fraud through fraudulent financial reporting would be very, very high. What factors may create or threaten the profitability of the entity? What type of factors may threaten the profitability of the entity? For example, if the entity under your audit is facing high degree of competition, if you find that the entity under your audit is facing a high degree of competition accompanied by declining margins, soon you will identify this example in real-time situations also. Very soon. Remember me, in the coming 2 to 3 years, Bajaj Finance will have a tough competition from the Jio Financial Services that has been originated from Reliance Industries Limited on 20th July of this month. Very soon, within 2 to 3 years, they are going to get a tough competition from Jio Financial Services Limited, because Reliance is having crores of customers base. They are having data of crores of general public, and most of them are their customers, and it is very easy for them to offer different types of loans without going into market. Customer will come to them. Customer will try to purchase some item. They will offer some credit to the customer concerned. Customer happily purchase the item without spending any money by taking finance from them. Later on, they will collect the monies from the customer in the form of EMIs. And what is being done by Bajaj Finance today will be done by Reliance Jio Financial Services very soon. In that case, Bajaj Finance will get tough competition, and in such case, they may experience a falling profits or falling margins. In order to show that everything is right, they may resort to dash fraudulent financial reporting. So once your profitability is getting threatened by different factors, in order to show that everything is going on well, although it is not going on well, you may try to resort to fraudulent financial reporting. Have you understood the basis of fraudulent financial reporting? Why do management will resort to fraudulent financial reporting? Because their profitability is being threatened. Their profitability is being threatened. They are getting lower amount of profits. To show that everything is going on well, although it is not going on well, management will try to resort to dash fraudulent financial reporting. Read it. When the financial stability or particularly when the profitability of the entity is threatened by the following things, like when the entity is facing high degree of competition accompanied by declining margins, when there are some technological changes or rapid, there are technological changes which are rapid in nature, then also the entity's profitability will get threatened. For example, my name is Idea. I am using a 2G spectrum. Very recently, Reliance Industries paid an amount of 1,88,000 crore rupees to the central government for purchasing 5G spectrum, and very soon Reliance Industries is going to offer 5G services at a price which is less than the price being charged by a 2G service provider. I am a 2G service provider. My name is, say, Idea. Your name is Reliance. I am providing 2G services. Per month I am charging 500 rupees from you. And you are going to provide 5G services to me, which are very lightning fast, and you are providing it at only 400 rupees to me. In that case, the customer will obviously prefer dash services over dash services. 5G from 2G. That is what Reliance is doing by offering a handset at just 2000 rupees and offering 5G services to the holders of the handset. Just for 2000 they are selling a handset which is capable of operating under 5G, and they are providing 5G network at very low prices. So obviously dash of dash will get threatened. Profitability of Idea, which is using a old technology, will get threatened because you are not using latest technology. You got outdated from the market. You'll be thrown away from the market. Your profits will get affected. To show that everything is right, you may try to resort to fraudulent financial reporting. That is the reason why at the outset itself I made it clear to you that if you are able to understand that for the following reasons dash will get threatened, for the following reasons profitability of the entity gets threatened, entity would try to involve in fraud in that situation or situations. So when the entity under your audit is facing high degree of competition accompanied by declining margins, when the entity is operating in under a highly vulnerable environment which is subjected to rapid changes such as changes in technology. The next one is easy to understand. There is a significant decline in customer demand. There is a significant decline in customer demand. Very soon, even Airtel will declare that their customer base is shrinking. Very soon, within 3 to 4 months, you will observe this data from Airtel, wherein Airtel will declare that their customer base is shrinking from this much to this much. Now, in the previous month, we have 10 lakhs customers. Now we are having only 8 lakh customers. All the remaining 2 lakh customers may have been migrated from Airtel to Reliance because they are offering 5G services. Airtel is also offering 5G services, but the speed and the value, the price at which they are being offered by Reliance is lesser than Airtel. So gradually you are losing your customer base. When your customer base is getting reduced, your profitability will also get reduced. To show that everything is right and normal, you will try to resort to fraud or fraudulent financial reporting. That's it. Every other thing is relatable to only profitability being threatened. You can correlate every point given under this heading to the term dash, profitability is being threatened in that case. When the profitability of the entity under your audit is under risk, when the profitability of the entity under your audit is under the risk, there is a high chance, because of several reasons, there is a high chance that the entity could involve in fraudulent financial reporting. Followed or not? Done. The next one is opportunities. After completing this question, I will try to provide you a break of maximum of 15 minutes, not more than that. Okay, please try to understand me. Opportunities. The nature of the industry or entities' operations themselves provide opportunities to engage in fraudulent financial reporting. Following the best examples are, when the entity enters into a related party transaction, obviously it offers a scope for the entity to commit fraud. In fact, to commit fraud only, entities do enter into dash, related party transactions. Next, point number C, leave point number B, point number C. This is easily understandable to you. That is the reason why I am trying to explain this. Assets, liabilities, revenues, expenses, based on, everything is based on estimates. Who make estimates? Management. Is it possible for the management to make wrong estimates or not? Obviously, yes. So, when financial statements include more estimates, there is a high possibility that management could involve in frauds or fraudulent financial reporting. The P&L account of the company is like this: to provision for depreciation, to provision for taxation, to provision to meet warranty claims or guarantee claims, to provision for retirement benefits, to provision in respect of pending lawsuits, to provision for doubtful debts, to provision for that, to provision for this, to amortization of preliminary expenses, to amortization of goodwill. Everything is dash. Judgment. Everything is estimate. If everything that is appearing in the profit and loss account is dependent upon the estimate of the management is having an authority to make wrong estimates, thereby preparing a wrong set of financial statements. Are you able to follow this point? Read it. Assets, liabilities, revenues or expenses based on significant estimates that involve subject to judgments of the management or uncertainties that are difficult to corroborate. And highly complex transactions, this point also appear under the heading, under the previous headings that we discussed. This is a complexity of the transactions that we discussed under the heading overriding of controls. And the last one is, this is a very good point to understand. You must understand these things. Generally, frauds or fraudulent transactions will be entered by Indian companies with foreign entities which are not having any base in India but are having base in countries like Dubai, Singapore, Mauritius, etc. Why fraudulent transactions are entered by Indian companies only with those companies which are registered under as per laws of Mauritius, Singapore, UAE, etc. They are called as tax haven countries. So it is easy to enter into such type of transactions with those organizations in those countries. So if you observe, if the organization is having the opportunity of entering into such type of transactions with entities which are there in tax haven countries, they provide an opportunity for them to involve in fraud. So nature of operations being performed by the entity may provide an opportunity to the management to involve in fraud. Therefore, it is necessary for us to consider even the nature of operations being performed by the organization to assess whether involvement of management in fraudulent financial reporting is high or is less. And the last one, attitudes or rationalization. When there are known history of violations of security laws or other laws and regulations, management is having a tendency to violate laws and regulations. That may happen in the current year also. Excessive interest by management, this is an easy point to explain. Excessive interest by management in maintaining entities inventory price or earnings trend. For the last 5 years, you are getting an average profit of 5 lakhs. But for the current year, you got a profit of only 1 lakh. In order to maintain earnings trend, what the organization could decide, they could decide to resort to fraudulent financial reporting. That's it. Enough. This is attitude or rationalization. These points are sufficient. Don't expect this question in the examination. This question or these things that we discussed today will help you to understand what is fraud, what are the types of the fraud, who commit fraud, why they commit fraud, how they commit fraud, what situations lead them to commit fraud. If you are able to understand these things as an auditor, it will be easier for you to have a good risk assessment, which will influence the nature, timing and extent of audit procedures to be performed by you as an auditor. In that way, for getting conceptual knowledge, this standard is more useful to you and not for the sake of examinations, in my opinion. Auditors do give only an opinion. He won't give any guarantee or certificate because of the existence of inherent limitations of audit and inherent limitations of internal controls. And question number 9. Can you please spare me with another 3 minutes, please? I am not listening to your answer. You need to observe that. Just I am asking you, that's it. Explain misappropriation of assets. Who will involve in misappropriation of assets? Employees. What is misappropriation? How do misappropriation takes place? Stealing the assets. It involves theft of entities' assets by employees in relatively small and immaterial amounts. Pilferage is a term that was used by me under audit of hotels. It can also involve management. Sometimes misappropriation of assets may be done even by the management, who are usually more able to conceal misappropriations in ways that are difficult to detect. How do misappropriation of assets took place? Embezzling receipts, misappropriating collections on accounts receivable through scheming and lading, stealing physical assets, no need to explain, stealing intellectual property, no need to explain. Stealing inventory for personal use is stealing physical assets. Colluding with a competitor by disclosing technological data is nothing but stealing intellectual property or intangible assets. Either tangible assets may be stolen or intangible assets may also be stolen. That is the way in which employees will misappropriate assets. This is very easy to understand. Making payments to fictitious vendors, making payments to fictitious employees. That means recording fictitious payments. Next, using entities' assets for personal use. For example, this is the property of the entity in which I am working. I have taken a loan and this property has been offered as security for that loan without taking any permission from the management. Is it acceptable to you? No. These are all the ways through which employees may misappropriate assets. Original essay 520. That is more easier for you to understand rather than the material. So let us go through essay 520. Several aspects have already been discussed by us under the heading essay 520. Already I declared to you that 30% of the standard has been explained to you. I explained you about interfirm comparison, intrafirm comparison, comparison with budgets, comparison with industry averages, what the auditor should do when the auditor identifies any deviation or variation or fluctuation, several things, what is ratio, several things have been explained to you in the past relating to analytical procedures. If you are able to recollect it, fine. If you are not confident of recollecting it, ask me. I will try to repeat the same things again and again within 5 minutes. What we discussed about analytical procedures, I said to you that analytical procedures can be defined as analysis or comparison of significant ratios and trends and investigating into the resulting fluctuations. Such comparison of information or comparison of ratios is of 4 types: interfirm comparison, intrafirm comparison, comparison with budgets, and comparison with industry averages. What is interfirm comparison? Comparison of the data or information relating to the entity under audit or ratios of the entity under under audit with the ratios of other entities operating under the same or similar industry. What is intra-firm comparison? Comparison of the information of the entity under your audit with the information of the previous years of the same entity. That is called as intra-firm comparison. Then I explained you about comparison with budgets and comparison with industry averages also. And I said to you that auditor should not only consider relationships or amounts, but auditor should also consider trends. For that, I have given you an example as well. So considering the trend, in the first year, GP is 15%, 20. In the second year, it is 15. In the third year, it is 10. In the fourth year, it is only 5. In that case, you can accept that for the simple reason that the trend is in a decreasing trend, and every year there is a fall of 5% in the net profit ratio. For the current year also there was a fall of 5%, which need not be inquired into or investigated by the auditor. So auditor should consider ratios, should consider trends. And I also said to you that comparison of information is of two types: comparison between financial information and financial information. The second one is comparison between financial information and non-financial information, for which I have given you an example also. What is comparison with financial information with non-financial information? Power bill. Comparison of the power bill with the number of units produced. Financial information with non-financial information. Comparison of salary per employee with the total revenue. That is called as comparison with the non-financial. Number of employees is non-financial. Revenue is financial. If you try to compare financial and financial information, it is called as analytical procedures. If you try to compare financial information and non-financial information, it is also called as analytical procedures. And even I said to you that comparison of abstract figures. What is that? Comparison of abstract figures is also called as analytical procedures. Now let us go through the original standard of SA 520 analytical procedures. I will try to explain most part of it in detail, and everything that is there will be available to you in your material. I don't want to read your material. Please excuse me. Time is not sufficient to read the material, but I assure you that everything given in the material will be covered once we are able to complete SA 520 original standard. Another important point that we discussed in the past is that there is a difference between the terms analytical procedures and substantive analytical procedures. If you follow analytical procedures before commencement of audit, they are called as analytical procedures. If you follow analytical procedures during the course, if you follow analytical procedures before commencement of audit as a part of risk assessment procedures, they are called as analytical procedures. If you try to follow analytical procedures during the course of performance of audit, then they are called as substantive analytical procedures. Unfortunate thing is that I am not the person who explained you SA 500. In SA 500, you may know very well, you may come across a point which specifies that auditor can obtain sufficient appropriate audit evidence either by following RAP or by following FAP. RAP means risk assessment procedures. The other one is further audit procedures. Further audit procedures were divided into compliance procedures and substantive procedures. Substantive procedures are further divided into, the first one is tests of details of transactions and balances and analytical procedures. Substantive analytical procedures. This point has also been explained by me to you at the beginning of a chapter called as Audit of Items of Financial Statements. So, read this point, standard. This standard on auditing deals with auditors' use of analytical procedures as substantive procedures. So, what we are going to discuss under SA 520 are nothing but the audit procedures that are required to be followed by the auditor during the course of performance of audit, not in the beginning of audit, which is as a part of risk assessment procedures. Now we are not discussing about analytical procedures to be followed by the auditor as the risk assessment procedures. We are discussing about analytical procedures to be followed by the auditor as substantive procedures during the course of performance of audit. Are you able to understand the difference between the term analytical procedure and substantive analytical procedure? What is the only difference between analytical procedures and substantive analytical procedures? What is the only difference between analytical procedures and substantive analytical procedures? Analytical procedures are the procedures that are required to be followed by the auditor prior to commencement of audit as a part of risk assessment procedures. Substantive analytical procedures are the procedures that are required to be followed by the auditor during the course of performance of audit to ascertain the accuracy, validity and reliability of financial information. This standard on auditing deals with auditors' use of analytical procedures as substantive procedures, and hence these are called as substantive analytical procedures. That is point number 1. Next, the use of, this is a good point to understand, the use of analytical procedures as risk assessment procedures. So analytical procedures can also be used as risk assessment procedures. That is, before commencement of audit, were dealt with in SA 315. Were dealt with in SA 315. SA 330, we are not having or going to have any discussion on 330, so leave it. Next, why should the auditor follow analytical procedures? Instead of focusing on the objectives, let us first try to understand the definition of analytical procedures. The definition that I explained to you is slightly different from the original definition given in SA 520. I made this point clear at the time of explaining that definition to you. What was the definition that I have given to you for analytical procedures? Analytical procedures can be defined as analysis or comparison of significant ratios and trends and investigating into the resulting fluctuations. Then I said that comparison is of 4 types: interfirm, intrafirm, with budgets and with industry averages. Abstract figures may also be compared. Financial information can be compared. Financial information and non-financial information can also be compared. Another important point that I highlighted in our discussion is that when you follow analytical procedures, the results of analytical procedures does not by themselves identify the area in which fraud has taken place. They will provide useful indications to the auditor as to the areas in which fraud may have taken place. This point was also explained to you. I cannot prove it. Right? Now let us focus only on SA 520, not about the things that we discussed in the past. Definition of analytical procedures. Analytical procedures means evaluation of financial information. Analytical procedures means evaluation of financial information. Why do you evaluate financial information? How do you evaluate financial information? There are 2 questions. Why should the auditor evaluate financial information? That is question number 1. How should the the auditor evaluate financial information? That is question number 2. I will try to provide answer for question number 2. You need to provide answer for question number 1. Please try to understand the question first. What is the question? Why should the auditor evaluate financial information? To get a reasonable assurance about the truthness and fairness of such financial information and to express such opinion to the users of the financial statements. That is the objective behind following any procedure by the auditor, including substantive analytical procedures. Yes or no? Right. Analytical procedures means evaluation of financial information. Now we answered 1 out of 2 questions. Why should the auditor evaluate financial information? To get reasonable assurance that such financial information is free from material misstatements, thereby it is reflecting a true and fair view. Now question number 2. How the auditor can evaluate financial information? Read it again. How financial information is evaluated? Through analysis. Through you will analyze financial information to evaluate financial information. What the auditor will do? The auditor will analyze. The auditor will analyze the financial information to evaluate whether the auditor will analyze the financial information to evaluate whether such financial information is free from material misstatements and hence is reflecting a true and fair view. Are you able to follow this or not? I can explain this definition within less than half a minute, but you cannot understand it. You cannot understand even a small word out of it. But if you are able to understand this definition in this way, it will be more easier for you to get conceptual knowledge of what is the definition of analytical procedures. So, by following analytical procedures, the auditor will try to analyze. By following analytical procedures, the auditor will try to assess or evaluate the truthness and fairness of the financial information. For that, for evaluating financial information, auditor shall carry out some analysis. That is the reason why in my definition, I said that analytical procedures can be defined as analysis or comparison of significant ratios and trends and investigating into the resulting fluctuations. So you should carry out some analysis. Analysis of what? What should be analyzed by the auditor? Auditor should analyze plausible relationships. Plausible here implies acceptable. Plausible means you are not required to consider every relation. You are required to consider only acceptable relationships. Acceptable relationships. You should analyze relationships. At least try to understand in that way. You need to analyze relationships. Why the auditor is analyzing relationships? Why the auditor is analyzing relationships? To evaluate financial information. Why the auditor is evaluating financial information? To get a reasonable, very good, to get a reasonable assurance that such financial information is free from material misstatements, thereby it is reflecting a true and fair view. Very good. Now read it. For the purpose of standards on auditing, the term analytical procedure means evaluation of financial information through analysis of relationships. Such relationships can be established between financial data and between financial and non-financial data. Are you able to follow this definition or not? Please say yes or no. Done. Analytical procedures also includes, encompass means say include, investigation. Not only comparison, analytical procedures also includes investigation. What is to be investigated by the auditor? Investigation of identified fluctuations. Investigation of identified fluctuations. I call in my discussion fluctuations as variation or deviation or fluctuation. Now, what is the old definition that we discussed about analytical procedures? Analytical procedures can be defined as analysis or comparison of significant ratios and trends and investigating into the resulting fluctuations. Now, what is the definition given in SA 520? Analytical procedures can be defined as or means evaluation of financial information through analysis of acceptable relationships between financial and non-financial data, and it also includes investigating into the resulting deviations or variations or fluctuations. If you do these two things, it is said that you are performing analytical procedures, otherwise called as analytical review procedures. What are the steps in analytical procedures? Analysis or comparison, investigating into resulting fluctuations. These two combined together shall have to be technically called as dash analytical. I repeat, analysis or comparison and investigating into resulting fluctuations. They both combined together is to be technically called as analytical procedures. That's it. Read it again. Analytical procedures means evaluation of financial information. Evaluation of financial information through analysis of acceptable relationships among both financial and non-financial data. Analytical procedures also encompass such investigation as is necessary of identified fluctuations, or let us leave this portion for further discussion. I cannot explain this point as of now. Or relationships that are inconsistent with other relevant information or that differ from expected values by a significant amount. Let us have a discussion about this part of the definition after some time. Okay? Right. Now, the next one. Substantive analytical procedures. There are 4 steps involved. These 4 are the steps involved when the auditor wants to follow substantive analytical procedures. Where the auditor wants to follow, what is meant by substantive analytical procedures? What is meant by substantive analytical procedures? When you try to follow analytical procedures during the course of performance of audit, they are technically called as substantive analytical procedures. Initially, it is very hard for you to understand, but after some time, I am sure you will get a very good understanding of SA 520. SA 520, once I am able to complete 520. So please wait so that you will be able to have a good understanding of the standard. 4 steps are involved when the auditor wants to follow substantive analytical procedures. They are explained elaboratively later on. Step number 1. First of all, this is confusing in nature. If you do not read it correctly, you will end up in understanding the point wrongly. Auditor shall determine the suitability of a particular substantive analytical procedure for a given assertion. At least you know very well about what is assertion. Yes or no? Right. The auditor shall determine the suitability of a particular substantive analytical procedures for given assertions. That is step number 1. Step number 2, the auditor shall evaluate the reliability of data. Step number 3, auditor shall develop an expectation. Step number 4, auditor shall determine amount of any difference that is acceptable without further investigation. These 4 are the steps. No, I know very well that you don't understand even a single sentence out of it. But I'm sure you'll be able to understand everything once I complete essay 520. Now, let us focus first on this explanation given by the CA Institute under the heading Application and Other Explanatory Material. What are analytical procedures? When I am reading, you need to respond. And what you have responded will be written by me on the screen. Ready? What are analytical procedures? Analytical procedures include comparisons, and they also include relationships. Analytical procedures includes comparisons, they also include relationships. Are you able to follow? Done. What is comparison? Analytical procedures include comparison of entities' financial information with comparison of entities' financial information with comparable information for prior periods. With the comparable information of prior periods. What is the definition that I have given for you for interfirm comparison and intrafirm comparison? I explained you about interfirm and intrafirm comparison. What is interfirm comparison? Interfirm comparison can be defined as the comparison of the ratios of the entity under audit or comparison of information of the entity under your audit, including ratios, with the information or ratios of other entities operating under the same or similar industry. Then what is intrafirm comparison? Comparison of information or ratios of the entity under audit with its previous year's information or previous year's ratios. That is called as intrafirm comparison. Are you able to follow point number 1 at least? Please read it again. If you want to follow substantive analytical procedures, you need to compare. What is to be compared? Current year financial information shall have to be compared with the previous year financial information. That is being called by as dash. Intrafirm comparison. Next, you can compare current year financial information with the anticipated results of the entity. With the anticipated results of the entity, such as budgets. I call it as dash. Comparison with budgets. I call it as comparison with budgets. Are you able to correlate? Done. Read it again. Point number 2. Comparison of financial information with the anticipated results of the entity, such as budgets or forecasts. Stop there. As of now, stop there. Next, comparison of entities' financial information with similar industry information. That's it. Comparison with industry averages. Very good. So out of 4, 3 were covered. I said to you about 4 types of comparison. What are they? Interfirm comparison, intrafirm comparison, comparison with budgets, and comparison with the industry averages. Out of 4, 2 or 3 are completed, right? Now, are you able to really understand what is meant by comparison? Comparison of what? Comparison of financial information with prior periods, with anticipated results, with similar industry information. We are calling them as intrafirm comparison. with budgets and with industry averages. If you start comparing information like this, it is said that you are following substantive analytical procedures. Followed? Now, it also includes, I haven't explained you the term expectation of the auditor. Very soon I am going to explain it. In the next class, I am going to explain what is expectation of the auditor. Next, analytical procedures also include consideration of relationships. Previously, you have considered comparisons. Now you need to consider audit in order to evaluate financial information and in order to get a reasonable assurance that such financial statements are free from material misstatements. The auditor had to consider comparisons. The auditor is also required to consider relationships. Under the heading consideration of comparisons, you are expected to compare current year financial data with either previous year's data or with previous year's budgets or with industry averages. That is technically called as consideration of if you consider comparisons, if you consider relationships, then only you can come to know whether financial data or financial information is reasonably correct or not, accurate or not, valid or not, reasonable or not, is free from material misstatements or not. So, analytical procedures not only includes consideration of comparisons, but it also includes consideration of relationships. What is meant by relationship? Analytical procedures also include consideration of relationships. For example, among elements of financial information and between financial information and relevant non-financial information. Let us first focus on point number 1 for today. In the next class, I am going to complete the syllabus. That is, I am going to complete analytical procedures. I will also deal with another chapter was missed in my previous discussion. That is audit planning and program sampling. Audit planning and program. I don't want to deal with audit sampling. I am not having time. I'm having time, but there is another batch to be completed by August 15th. So I cannot do audit sampling. I can deal only with audit planning, strategy and programming. Okay, audit program. Done. So these two are pending for the discussion for tomorrow's, for day after tomorrow's session. In the next class, I'm going to complete the syllabus. Right? Now let us have a discussion about only point number 1. That is relationship, considering relationships between or among financial information only. The next one is relationship between financial information and non-financial information. Among elements of financial information, that would be only for this point. I haven't explained you expectation of the auditor, the term expectation of the auditor. That would be expected to conform to a predictable pattern based on entity's experience, such as gross margin percentages. What was the example that I have given to you for this? For the last 10 years, the entity is getting a gross profit of 20%. You were the auditor of that entity. You came to know that for the last 10 years, they are getting a gross profit of 20%. How much is the percentage of gross profit that you predict as an auditor that shall appear in the trading account for the current year? Oh, how it is possible for the auditor to expect the gross profit? Because it is already following, the gross profit is already following a predictable pattern. The pattern of gross profit is 20% for several years. So you are able to predict that the same, as an auditor, you are able to predict, as an auditor, you are able to predict the same percentage of gross profit for the current year. So what is the prediction or expectation of the auditor of, what is the prediction or expectation of the auditor in respect of gross profit of the current year? What is the expectation of the auditor in respect of gross profit of the current year? 20%. If the actual gross profit is say only 2%, now can you say that there is a difference between your expectation, there is a difference between your means auditor's expectation and actual? When there is a fluctuation, what the auditor should do? The auditor should make an inquiry into the reasons for such deviation or variation or fluctuation. I also said to you that on an investigation, sometimes you may find some genuine reasons. When you find genuine reasons, stop investigating further. When you do not find genuine reasons, certainly you should expect the existence of a fraud. There are no genuine reasons for such fall in the gross profit ratio. For that only I have explained you that point. For the last 10 years, it is getting a gross profit of 30%, but for the current year, they got a gross profit of only 5%. Auditor started making an inquiry with the management. Management has mentioned that, sir, previously we used to get a commission of 3 rupee 50 paisa per every soap worth 10 sold. Now we are getting a commission of only 1 rupee. There is a drastic fall in the commission being received by us from the other company, and hence there is a fall in the gross profit ratio. You checked the same with the documentary evidences, and you find that what is explained by the management is correct. In that case, there is no further duty on the part of the auditor to probe into the matter. Are you able to recollect it? Read it again. Analytical procedures also includes considering relationships among elements of financial information that would be expected to conform to a predictable pattern based on entities' experience, such as gross profit or gross margin, that is nothing but gross profit ratio. Next, sometimes not only relation between elements of financial information, the auditor may also be required to consider relationship between financial information and non-financial information. I will stop here for today, but I want to show you the appendix given by the CA Institute at the end of this standard. This is the appendix. Under this heading, CA Institute explained you about trends also. Nowhere in the original standard you find the term trend, but it has been given in the appendix. That is the reason why I included the term trend in my definition. Next, what are the ratios that you can consider? What are the relation? Ratio is nothing but a relationship. Relationship may be established between financial and financial information. A relationship can be established between financial information and non-financial information. We just now had a discussion about relation between financial information and non-financial information. The best example is dash. Gross profit ratio. He has given some more examples. Ratios. Analysis by computation of ratios. If I fail to show you this appendix, you won't agree that ratio means relationship. If you see this and if you understand this, you can conclude that ratio is nothing but a relationship between financial information, and sometimes it may be established between financial information and non-financial information. Analysis by computation of ratios includes study of relationships between financial statement amounts. That means financial and financial information. Commonly used ratios are elements of income or loss as a percentage of sales. Sales are taken both for calculation of gross profit is income, net profit is also income. That is element of income or loss as a percentage of sales. Gross profit turnover, accounts receivable turnover, inventory turnover, profitability, leverage and liquidity. Everything is establishing a relationship between one financial information and other financial information. Are you able to understand these ratios? Very good. Now let us stop the discussion for today. In the next class, I am going to certainly complete the syllabus. Take it for granted. Okay. Say 520 analytical procedures in the previous session. We haven't completed that. Some key points under SA 520 have already been discussed. The most important points that we discussed under SA 520 is about the concept of analytical procedures as well as the concept of substantive analytical procedures. There is a lot of difference between the terms analytical procedures and substantive analytical procedures. As already said to you, analytical procedures are followed generally by the auditor as a part of risk assessment procedures, whereas substantive analytical procedures are followed by the auditor as a part of substantive procedures. You know very well about the concept of compliance procedures and substantive procedures. Such substantive procedures are classified broadly into two categories. The first one is tests of details of transactions and tests of details of balances, and the second one is substantive analytical procedures. So substantive analytical procedures are followed by the auditor as a part of substantive procedures. If you still are not getting the clarity about this point, I will try to explain you the audit procedures that are required to be followed by the auditor to obtain sufficient appropriate audit evidence. You know them very well. What are the audit procedures that can be followed by the auditor for obtaining sufficient appropriate audit evidence? The first one is risk assessment procedures. The second one is further audit procedures. Such further audit procedures are classified broadly into two categories. The first one is compliance procedures, otherwise called as tests of controls, and the second one is substantive procedures. Such substantive procedures can again be classified broadly into two categories. The first one is tests of details of transactions and tests of details of balances, and the second one is substantive analytical procedures. Under the heading risk assessment procedures also, auditors do follow some analytical procedures. Under the heading substantive procedures also, auditor will follow some analytical procedures. The audit procedures that were followed are analytical procedures that were followed by the auditor before commencement of audit falls under the category of dash. Risk assessment procedures and analytical procedures that are to be followed by the auditor during the course of performance of audit are technically known as substantive analytical procedures. That is the basic difference between the terms analytical procedures and substantive analytical procedures. Without knowing that, even if you go through SA 520, you may not be able to understand the soul of SA 520. That is the reason why at the outset I want to make it clear to you that there is a lot of difference between the terms analytical procedures and substantive analytical procedures. Now, what aspects we have discussed under the heading analytical procedures? I said to you that analytical procedures are nothing but evaluation of financial information. Auditor shall have to evaluate financial information. How the auditor shall evaluate financial information, and why the auditor shall evaluate financial information. Why the auditor shall evaluate financial information? The answer for this has already been explained to you. Why should the auditor evaluate financial information? To get a reasonable assurance. In order to get a reasonable assurance that the financial statements or financial information is free from material misstatements resulting either from fraud or from error. So, when the auditor gets a reasonable assurance that, remember, there is no much difference between the terms financial statements and financial information. In some cases, the term financial statements are used. In some other cases, the term financial information is used. Both are one and the same. Why? Because financial statements contain some financial information. financial information is the base on which financial statements are prepared. So logically speaking, there is no difference between the terms financial statements and financial information. They both mean one and the same. Don't get confused between the words financial statements and financial information. So why should the auditor follow? Why should the auditor follow analytical procedures in order to get reasonable assurance that financial statements or financial information is free from material misstatements resulting either from frauds or from errors, and hence it is reflecting a true and fair view. If the auditor concludes or got a reasonable assurance that financial statements are reflecting a true and fair view, then the auditor may give an unmodified opinion, and such an opinion given by the auditor after thorough analysis will become appropriate. When the auditor gives an appropriate opinion, the audit risk to the auditor will get naturally reduced. So if you were the auditor, if you want to reduce your audit risk, you need to provide an appropriate report. In order to provide an appropriate report, first of all, you need to satisfy that financial statements are free from material misstatements resulting either from fraud or from error. For that, auditor should check financial statements or financial information. Such checking of financial statements or financial information can be done by the auditor by following several procedures. Out of such procedures, one such procedures is analytical procedures. So analytical procedures also help the auditor in evaluating financial information. Analytical procedures also help the auditor in determining whether financial statements are free from material misstatements resulting either from frauds or from errors. That is the base on which the concept of analytical procedures has been developed. That is the reason why, although I know very well that these aspects have already been discussed in the previous session, this is the reason why I am trying to repeat those points. Unless you understand the basic logic of following analytical procedures, it's of no use to learn about analytical procedures. So analytical procedures are nothing but evaluation of financial statements or financial information. How do you evaluate financial statements or financial information? Through analysis. Through analysis of acceptable relationships. Plausible means acceptable relationships. So the auditor will try to analyze acceptable relationships for the purpose of evaluation of financial information, and such acceptable relationships may exist among both financial data as well as financial and non-financial data. So such analysis will be done with regard to financial data as well as with regard to financial and non-financial data. Primarily, we focus on studying or analyzing the relationships. Under analytical review procedures, we primarily focus on studying the relationships between financial data or between financial and non-financial data or information. And analytical procedures, once you carry out such analysis of relationships, sometimes you may find some deviations or variations or fluctuations. When auditor identified any fluctuation in the results of such analytical procedures, it is the responsibility of the auditor to investigate into the reasons of such fluctuations or deviations. On an investigation, sometimes the auditor may find some genuine reasons. When you find genuine reason, you can simply ignore the process. In other words, there is no further duty on the part of the auditor to probe into the matter. However, when in the absence of genuine reasons, the auditor should suspect the existence of fraud. When you are suspecting the existence of fraud, you should be more careful while carrying out the audit. Thereby, auditor will focus more while carrying out audit. By that, the auditor would be able to detect some of the material misstatements in the financial statements resulting either from fraud and error. So that is the reason why I said to you in the past that substantive analytical procedures or analytical procedures will certainly help the auditor in locating frauds and errors or in detecting frauds and errors. This is what we discussed about the term analytical procedures. So analytical procedures is nothing but evaluation of what? Analytical procedures is nothing but evaluation of what? Evaluation of financial information. Why should the auditor evaluate financial information? To get reasonable assurance about the truth, about whether financial statements or financial information is free from material misstatements resulting from frauds and errors. Why should the auditor evaluate the financial information? Because to get reasonable assurance. And how it is done by the auditor? How it is done by the auditor? By having a thorough analysis of relationships. Thorough analysis of relationships between both financial data and financial and non-financial data. Analytical procedures also encompass such investigation as is necessary of identified fluctuations or relationships that are inconsistent with other relevant information or that differ from expected values by a significant amount. The term that differ from expected values by a significant amount is not yet discussed by us, and that is point number 1. Point number 2. Substantive analytical procedures. Probably I may have explained about the term analytical procedures in the previous session up to that point, and I focused later on with regard to two important aspects under the heading substantive analytical procedures. What are they? The first one is just a minute. We focused on this point also. Nature of analytical procedures to be performed by the auditor. I said to you that analytical procedures involves consideration of two things. Analytical procedures involves consideration of two things. Auditor should consider comparisons. The auditor should also consider relationships. First one is consideration of comparisons. The second one is consideration of relationships. I repeat, for the purpose of evaluation of financial information. For the purpose of evaluation of financial information, the auditor shall consider both dash as well as dash. Shall consider comparisons as well as relationships. Then I started having a discussion about what to be compared. What to be compared. The comparison may be intra-firm comparison. What is that? The auditor may compare the amounts and other ratios. The auditor can compare the amounts and other ratios of the entity under his audit with the amounts, with the previous year's amounts and previous year's ratios. That is technically called as dash. Comparable analytical procedures include consideration of comparisons of financial information. So financial information is required to be compared. I repeat, financial information is required to be compared by the auditor with what? With comparable information of prior periods. When you try to compare current year figures with prior period figures, it was called by us technically as intra-firm comparison. That is the reason why I said to you that analytical procedures involves intra-firm comparison, intra-firm comparison, comparison with budgets, comparison with industry averages, and so on. So considering comparisons, considering relationships, you will try to evaluate the correctness or otherwise of financial information. Thereby, you will try to evaluate whether financial statements are reflecting a true and fair view. That is what analytical procedures implies. So nature of analytical procedures. Analytical procedures include consideration of comparison of entities' financial information with comparable information for prior periods, anticipated results of the entity. What is meant by anticipated result? You can compare the financial information with budgets or forecasts prepared by the management, prepared by the management, and sometimes this comparison may be done by the auditor either with budgets or with auditor's expectations. I feel this point was also covered in our previous discussion. So if you compare financial information with prior periods, it is called as dash intra-firm comparison. If you compare financial information with budgets, it is called as comparison with budgets. And as a part of it, sometimes the auditor may try to compare financial information with the expectations of the auditor. For example, estimated depreciation. Generally, examples are given to have better understanding of a point. Here also, an example is given like estimation of depreciation. Estimation of depreciation is nothing but an example to understand the term expectation of the auditor. But unfortunately, here understanding example is also difficult. So that is the reason why I want to give some elaborative discussion on estimation of depreciation. How do the auditor estimate the depreciation? By recalculation. Very good. Point number one. And before recalculating the depreciation, what the auditor should do? First of all, the auditor is expected to take a list of assets from the management. As said earlier, in that list, management should always try to include dash, dash, dash and dash. The list of assets supplied or provided by the management to the auditor must contain the following four minimum details. What are they? The first one is opening balance of respective asset. The second one is any additions made thereto during the financial year. The third one is any deletions made from during the financial year. And sometimes in order to check whether all additions are completely recorded, the auditor can focus on deletions part. If you observe that some of the assets have been deleted or sold off, you can make an inquiry with the management about the reason why the asset has been deleted and sold off. The management may say that we replaced this with a new asset. Then immediately the auditor should check whether such asset which is newly replaced, the existing old asset, is included in the additions. If that was not included in the additions, what does it mean? An addition has been made, but it has not been completely recorded in the books of account. That is the reason why in our discussion on audit of items of financial statements, it is mentioned in the CA Institute's material that whenever any asset is sold, it is the responsibility of the auditor to inquire the management about why the management has sold off the asset. Management may try to provide some reasons for it. From such reasons, sometimes you may cross-check some other thing. That is the reason why you need to have an inquiry with the management to ascertain dash the reason why the existing asset has been sold. So, information like opening balance, additions, sales, and information relating to closing balance. Sometimes the amount of depreciation provided along with the method followed by the management for the purpose of calculation of depreciation may be provided to the auditor. And by going through the list of the assets, the auditor identified that huge capital expenditure has been incurred by the organization during the year in making new purchase of assets. But so when you find that several assets have been newly purchased by the entity during the year, what would be your expectation as an auditor in respect of amount of depreciation? Would it be higher than the previous year's depreciation, or would it be lower than the previous year's depreciation? Are you able to follow me? The auditor had gone through dash. The auditor had gone through list of assets provided by the management. There the auditor identified that several additions have been made. by the organization during the year in respect of their assets. When more and more assets have been added to the basket, then what does it imply? It implies that more and more amount of depreciation should have to be provided by the organization when compared with the previous year. Yes or no? So, auditor started expecting that this year the amount of dash will be more than the amount of dash. The auditor started expecting that for this year amount of dash is more than the amount of dash. Amount of depreciation to be provided on the assets should be more than the amount of depreciation that has been provided by the entity in the previous year. When the auditor started comparing current year with depreciation with previous year depreciation, the auditor identified that the current year depreciation is lower than the previous year. What was the expectation of the auditor and what has been done? The expectation of the auditor is that there would be an increase in the amount of depreciation, but actually there was a reduction in the amount of depreciation. That creates suspicion to the auditor about whether depreciation has correctly been calculated or not. In that case, as an auditor, you can perform a procedure called as recalculation. Thereby, you can confirm whether depreciation has been properly calculated or not, or whether assets were not included or not. This is all about dash. Expectations of the auditor. Another example that has been given by me to you in the previous session about expectations by the auditor is, for the past several years the entity under your audit is getting a gross profit of 30% consistently. So obviously for this year also you will make an assumption or you will anticipate or expect that the entity is going to get a gross profit of 30%. Against your anticipation, if you find that the current year gross profit is not 30% but it is only 3%, obviously there is a difference between auditor's expectation and actuals. Then also the auditor should get a doubt. So, how to compare information, financial information by the auditor? Financial information can be compared by the auditor with dash. Financial information should have to be compared by the auditor with dash. With the financial information or comparable information of prior periods, with budgets prepared by the management, or even with expectations made by the management. Expectations made by the auditor. And you can also compare financial information of the entity under your audit with financial information relating to industry information. This is what I said to you as comparison with industry averages. So everything that we discussed about analytical procedures in the past is appearing in SF520 with some difference in the wording. That's it. So you need to understand the difference in the wording, not the concept. Concept is already known to you. So how do you perform analytical procedures? Auditor shall perform analytical procedures. That means auditor shall evaluate entities' financial information through comparisons. Such comparison may be done with prior periods. Such comparison may be done with budgets. Such comparison may be done with the auditor's expectations. Such comparison may be done by the auditor with dash. Similar industry information, such as comparison of entities' ratio of sales to accounts receivable with industry averages or with other entities of the comparable size in the same industry. This is nothing but with other entities of the comparable size in the same industry is nothing but interfirm comparison. What is that? Comparison with industry averages is different from comparison with interfirm comparison. What is the difference between interfirm comparison and comparison of industry average? I have given you two examples, one for the first one and the other one for the second one. What was the example that I have given to you for industry averages? All these are companies manufacturing cloth. These are all different independent companies manufacturing cloth, and hence all companies are said to be operating under textile industry. And in a textile industry, usually any organization will get a gross profit of around 50%. So 50% is said to be dash. while explaining that point, I explained you even about pricing strategies that are followed by the entity. The first one is penetration pricing, the second one is skimming pricing, and the third one is competitive pricing. Usually organizations do follow competitive pricing. So sale price is very much similar. Cost is also very much similar. So margins are also very much similar. That is the reason why we call it as dash industry average. Whatever be the organization, if they are carrying on, say, textile business, they do get an average of 50% gross profit. You are the auditor of a particular textile industry. You started comparing the gross profit of the company under your audit with industry average. They got a gross profit of 5% against industry average of 50%. In that case, obviously the auditor will get a doubt. I said to you earlier that if you follow analytical procedures, you may not be able to conclude about anything. Yes or no? You may not be able to conclude anything. Why the auditor is unable to conclude anything? Even when the auditor follows analytical procedures, you may identify some deviations, but you need to inquire, make an inquiry, make an investigation into such deviations. After making an inquiry or investigation of the deviations, sometimes the auditor would find dash reasons, genuine reasons. If there are genuine reasons, even where there is a difference, you can simply leave it. If there are ungenuine reasons, then only you should try to focus on those things, and in that case you would be able to detect frauds and errors. In that case, the auditor would be able to detect material misstatements in the financial statements or financial information. So analytical review procedures or analytical procedures does not by themselves give any conclusion to the auditor. Results of analytical procedures are to be used by the auditor for carrying out some other procedures. So with other entities of comparable size in the same industry is nothing but means interfirm comparison. That is the reason why I said to you in the past that comparison is of 4 types. Interfirm comparison, intra-firm comparison, comparison with budgets, and comparison with industry averages. Everything is covered now. Okay? This is about consideration of comparisons. So for the purpose of evaluation of financial information, the auditor should consider comparisons. That means the auditor should follow comparisons and should also consider relationships. What to follow under the heading comparisons? Comparison with interfirm comparison, intrafirm comparison, comparison with budgets, and comparison with industry averages. Now, A2 paragraph. Analytical procedures also include consideration of relationships. Apart from comparison, you should also consider relationships. As said earlier, such relationships exist between dash and dash data, between dash and dash data, and between dash and dash data, between financial and financial data, or between financial and non-financial data. So this is all about consideration of comparisons. Next, analytical procedures also includes consideration of relationships. For example, relationships do exist among elements of financial information. Relationships do exist among elements of financial information. Like this wording is very, 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 very important for you. Unless you understand this sentence, you cannot understand the basis of analytical procedures and substantive analytical procedures. So this sentence is very much important for every CA student. Analytical procedures also includes consideration of relationships. For example, among elements of financial information, that is easy to understand. Among elements of financial information is easy to understand. But the next sentence is difficult to understand. Generally, such elements of financial information are expected to conform to a predictable pattern based on entity's experience, such as gross margin percentages. That means you can consider relationships only in respect of such financial information which is expected to conform to a predictable pattern, which is expected to conform to a predictable pattern based on entity's experience, such as gross margin percentage. Usually there will be a consistency or predictability over gross margin percentages. Year to year, gross profit margin is almost similar. So you can predict the gross profit percentage or gross profit margin over a period of time. And this relationships shall be considered by the auditor only in respect of such predictable pattern of financial information. I don't know how many of you students are able to understand this. So I will try to provide you another example. I am the auditor. Auditor number 1 started comparing gross profit and sales. Auditor number 2 started comparing, say, research expenses with sales. Auditor number 1 started comparing gross profit with sales for the current year, and he tried to compare the same with the previous year's gross profit ratio. So this is nothing but gross profit by sales is nothing but a gross profit ratio. Will it conform to a predictable pattern? Will gross profit percentage conform to a predictable pattern? Yes. Now, auditor number 2, what the auditor number 2 is trying to do is, in the previous year, sales are 1 lakh. In the previous year, sales are 1 lakh. Research and development expenditure incurred by the organization. In the previous year, sales are 1 lakh. Research and development expenditure incurred by the organization in that particular financial year is 10,000. That means research and development expenditure are 10% of sales. And for the current year, the sales are, what is the sale of the previous year? 1 lakh. What is the sale of the current year? The current year sales were, say, only 2 lakh rupees. Current year sales are, say, 2 lakh rupees. Now, what the auditor could expect? If you were the auditor, could you expect anything? Question number 1. If you are able to expect, what is your expectation? Could you expect anything? Question number 1. If your answer is yes, what is your expectation from this? In year number 1, sale is 1 lakh. In that year, research and development expenditure is 10,000. In year number 2, that is current year, sale is 2 lakhs. Could you predict or expect anything out of this? That is question number. Don't say anything. That is question number 1. If you say yes, what is your prediction? You cannot predict anything out of this. Why? Because there is no relationship or direct relationship between research and development expenditure with sales. Although your sale is less, you may have decided to incur more and more research and development expenditure. Such research and development expenditure is discretionary expenditure. Yes or no? Gross profit shall have a relation with sale, but research and development expenditure which are discretionary in nature won't have any relationship with sale or even with any other item of expenditure or any other item of revenue. That means you cannot predict. You can predict regular expenditure. You cannot predict. You can predict regular expenditure. You cannot predict discretionary expenditure. Yes or no? From day 1, she is coming regularly to the class without absenting from a single class. And now, today I started expecting that she would also come today. This is based on the past experience, and she is following a predictable pattern. And he is not attending the classes from day 1 onwards. He is regularly irregular. In that case, is it possible for me to predict whether he will come to the class today or not? Certainly not. It is purely dependent on his discretion. Whether to attend the class or not to attend the class is his discretion. So discretionary expenditure will not follow a dash pattern. Discretionary expenditure like research and development expenditure, advertisement expenditure, etc. may not follow a predictable pattern. Therefore, relationships cannot be established between or among everything. Relationships can be established only in respect of items which will conform to a dash pattern. which will conform to a predictable pattern. Are you able to understand the term conform to a predictable pattern? Done. Now, analytical procedures also include consideration of relationships. For example, among elements of financial information that would be expected to conform to a predictable pattern based on entity's experience, such as gross profit margin, and between financial information and non-financial information. The best example is payroll costs to number of employees. If the number of employees are 100 and average salary per employee is say 20,000 rupees, and if the number of employees increased from 100 to 120, what you can expect as an auditor? And what relationship could you establish between these two? When the number of employees is 100 and the average salary is 20,000, salaries is this much. When the number of employees increased to 120, what would be the salaries of the employee? That is to be expected by the auditor. Then the auditor should compare dash with dash. Compare that expectation with the actual amount of salaries debited to profit and loss account. If there is any deviation or variation or fluctuation, the auditor should investigate into such deviation or variation or fluctuation. Remember, here the auditor is trying to establish or has tried to establish a relationship between average salary, which is called as dash, financial information, and the number of employees, which is called as non-financial information. So you can establish relations between financial information, and you can also establish relations between financial information and non-financial information. Read it. So relationships can be established by the auditor either among financial elements of financial information or between financial information and non-financial information. And the most important point that every one of you must understand in this discussion is that analytical procedures can be followed by the auditor only in respect of those items which follow a predictable pattern or which conform to a predictable pattern. If the item is unpredictable, if relationship is unpredictable, don't try to follow analytical procedures in respect of such items. This is about paragraph number A2. All this is with reference to analytical procedures only. We haven't started discussion on substantive analytical procedures. At least by now, I hope you have an understanding of the terms analytical procedure and substantive analytical procedure. They are completely different. The stage at which you are following analytical procedures will decide whether you are simply following analytical procedures or you are following dash, substantive analytical procedures. If you follow analytical procedures before commencement of audit, that is stage number 1, then they are called as part of risk assessment procedures. If you try to follow the same analytical procedures during the course of performance of audit, they are to be technically called as dash, substantive analytical procedures. Followed or not? Now, various methods may be used to perform analytical procedures. These methods range from performing simple comparisons. That is the reason why I said to you that analytical procedures not only include relations, they also include comparison of abstract figures. They also include simple comparison, is also technically called as dash. Simple comparison is also technically called as dash, analytical procedure. So various methods may be used to perform analytical procedures. These methods range from performing simple comparisons to performing complex analysis using advanced statistical techniques. That's it. That is enough. Now let us focus on the term substantive analytical procedures. Till now we had a discussion, a general discussion about dash, analytical procedures. Now we are going to have a discussion about dash, substantive analytical procedures. They both are one and the same, excepting the time at which they are required to be applied. If you apply that before commencement, it is called as risk assessment procedure. If you apply that during the course of performance of audit or at the end of audit, it is called as substantive analytical procedures. Remember, Substantive procedures are 2 in number. What are they? Substantive procedures are 2 in number. What are they? No. What I am asking you is about substantive procedures. Substantive procedures are 2 in number. What are they? The first one is 2 types of procedures are available to you as an auditor under the heading substantive procedures. What are they? 1. Tests of details of transactions and tests of details of balances are substantive analytical procedures. Now my question to you is, if you were the auditor, would you like to follow tests of details of transactions and tests of details of balances, or would you like to follow substantive analytical procedures, or as an auditor, would you like to follow both the tests of details of transactions and balances and substantive analytical procedures? Remember, most of the students gets confused between these 2 words. Substantive procedures is different from dash. Substantive analytical procedures. If you follow analytical procedures as a part of substantive procedures, they are called as substantive analytical procedures. So don't get confused between the terms substantive procedures and substantive analytical procedures. Substantive analytical procedures is a part of dash. Substantive analytical procedures is merely a part of substantive procedures. So substantive procedures is general in nature. Substantive analytical procedure is specific in nature. Do you understand that? Done. Now, if you were the auditor, my question is, if you were the auditor, would you try to follow tests of details of transactions and tests of balances, or would you try to follow substantive analytical procedures, or would you try to follow both tests of details as well as substantive analytical procedures during the course of performance of your audit? It is up to you to decide. It is up to you to decide. Nobody will tell you that you need to follow tests of details only. You need to follow substantive analytical procedures. You need to follow both the tests of details and substantive analytical procedures. This is the reason why under SA 200, it was mentioned particularly that during the course of performance of audit, the auditor is required to make several professional judgments. What are the areas in which auditor had to make professional judgments? What are the areas in which auditor had to make professional judgments as per SA 200? I haven't explained you SA 200, but you are having knowledge of it. That is the reason why I am asking you, what are the areas in which as an auditor you are expected to take professional judgments under SA 200 during the course of performance of your audit? 1. Whether a particular item is material or immaterial. Who should decide? Auditor himself. The nature, timing and extent of audit procedures to be followed. Which procedure is to be followed? Should we follow tests of details of transactions and balances? Should we follow substantive analytical procedures? Or should we follow both the tests of details of transactions and balances and substantive analytical procedures? Should we follow inspection, observation, inquiry, confirmation, recalculation, reperformance? Who will decide all these things? You, the auditor. So you need to take some professional judgments while you are carrying out audit. What are the areas in which audit is expected to take professional judgments? One, with respect to materiality. 2, with respect to what type of procedure should the auditor follow. The nature, timing and extent of audit procedures to be performed by the auditor shall have to be decided by the auditor on his own. The third one is, during the course of audit, you may start getting audit evidence. You need to decide whether evidence gathered by you is sufficient or is it necessary for you to gather some more audit evidence, whether the evidence is sufficient, or should we try to gather some more audit evidence, is another decision to be taken by the auditor on our own. Nobody will tell you that the information that you obtained is sufficient. There is no need for you to gather some more information. It is up to you to decide whether information gathered by you is sufficient, or is it necessary for you to gather some more information. And finally, the type of the report that the auditor had to issue at the end of the audit. The type of the report to be issued by the auditor at the end of the audit. Who should tell you that you need to issue a modified opinion, an unmodified opinion? Nobody. It is up to you to decide whether to issue an unmodified opinion or to issue a modified opinion. At least by now, you should be able to understand the importance of the term professional judgment. And another most important thing that a student must understand in this context is that unfortunately, nobody will help you in taking such professional judgments. You alone are made responsible to take judgments, and nobody is helping you in taking such judgments. When nobody is helping the auditor in taking professional judgments, and if the auditor is not careful, when the auditor is not careful while taking such judgments, ultimately dash taken by dash will prove to be wrong. Judgments taken by the auditor proves to be wrong. What will happen when the judgments made by the auditor prove to be wrong? Very good. The opinion given by the auditor may become wrong, and hence there will be an increased risk to the auditor. So if you were the auditor, if you want to reduce your audit risk, you need to give appropriate opinion. For that purpose, you need to take appropriate professional judgments. While taking judgments, nobody will help you. You should be very careful while taking such judgments. This is what is mentioned in Essay 200 under the heading Professional Judgment. So this is an area where it is necessary for you as an auditor to take a professional judgment about whether it is sufficient to follow dash, or it is sufficient to follow dash, or to follow both. So whether to follow tests of details of transactions and balances, or to follow substantive analytical procedures, or to follow both is purely dependent upon dash, the professional judgment of the auditor. Coming back to the original discussion, substantive analytical procedures. The wording is very important. This is the basic reason why I am ignoring what is mentioned in our material. Instead, I am trying to focus only on the original standard. This is one of the reasons. When designing and performing, till now we had a generalized discussion not about dash but about dash. Till now we had a generalized discussion not about dash but about dash. Not about substantive analytical procedures but about the general meaning of the term analytical procedures. Now we are going to have a discussion on what is substantive analytical procedures. Okay. Right. When designing and performing substantive analytical procedures, first of all, try to focus on designing only. While designing substantive analytical procedures, either alone, while designing substantive analytical procedures, either alone or in combination with tests of details. What is the literal meaning of that sentence? You can follow only substantive analytical procedures, or you can follow only tests of details, or the auditor can follow both substantive analytical procedures and tests of details. That is the meaning of that sentence. So, sentences that are given in standards on auditing are not easily understandable. You need to understand the soul of the sentence to have a better understanding of the sentence. So while designing substantive analytical procedures, either alone or in combination with tests of details as substantive procedures, everything seems to be one and the same in this sentence. This is one sentence. This is having one meaning. This is having one meaning. This is having one meaning. Substantive procedures and substantive analytical procedures, are they both one and the same? No. Substantive procedures are different. Substantive analytical procedures are different. Substantive procedures is a broader concept. Substantive procedures is a broader concept which includes both dash and dash, which includes both tests of details as well as substantive analytical procedures. Substantive analytical procedures means only substantive analytical procedures. Now read it again. When designing and performing, for some time from now, please ignore the term dash, performing. When designing substantive analytical procedures, either alone or in combination with tests of details as substantive procedures in accordance with SA 330, the auditor shall. So, the following are nothing but the steps to be followed by the auditor. The following are nothing but the steps that are required to be followed by you as an auditor while you are deciding whether to dash or to dash or to dash. Whether to follow only tests of details or to follow only substantive analytical procedures and or a combination of the two. Particularly the first step is most important for that. What is the first step? The auditor shall determine, as already, that is the reason why I said to you that you cannot follow analytical procedures in respect of discretionary expenses. Yes or no? You cannot follow analytical procedures in respect of discretionary expenses. They do not follow or they do not conform to dash a predictable pattern. When they are not conforming to a predictable pattern, it is not possible for you to follow substantive analytical procedures. In that case, you may have decided or you must have to decide to follow only dash, tests of details. So that is the reason why sometimes it may be necessary for you to follow dash, sometimes it may be necessary for you to follow dash, and sometimes both. So while deciding whether to follow tests of details or to follow tests of details or to follow substantive analytical procedures or both in combination means both, the auditor shall have to consider the following, or the following are the steps to be followed by you to decide whether to follow dash or to follow dash or to follow dash and dash. You know it very well. First of all, the auditor should determine the suitability of, the auditor shall determine the suitability of particular substantive analytical procedure for a given assertion. For a given assertion. Out of all these things, the only thing that is known to you is about dash, assertion. What is assertion? What is assertion? Assertion is nothing but declarations made by the management or claims or representations made by the management to the auditor. In most of the cases, they are embodied in financial statements. In other words, assertions are implied in nature, but in some cases there may be explicit also. Probably you may have heard about the term negative assertions also. Such negative in SA 200 or SA some other standard, while having a discussion on standards on auditing, you may come across the term negative assertion, particularly under SA 500. I don't know whether it was included in our material or not. And such negative assertions are also two in number. The first one is implied and the other one is explicit. For example, if the management says in the financial statements that there are no contingent liabilities, it is called no. Therefore, it is called as a negative assertion. And it was declared by the management. And hence it is called as explicit negative assertion. 2. Management has not included any building in the balance sheet. What does it mean? They are not having buildings. It is a So management is declaring that we are not having any buildings. It is a negative assertion. And here the management is not declaring explicitly, just they have not included buildings in their balance sheet. That implies that the entity is not the owner of the buildings, or entity do not own any buildings. That is called as a negative assertion. So I have explained you, that is very important concept. It seems nobody is having an understanding of the term negative assertion. That is the reason why I said it to you about what is negative assertion and what is implied negative assertion, what is explicit negative assertion, with the help of example. Right. So the only thing that is known to you under that heading is assertion. First of all, the auditor shall determine the suitability of a particular substantive analytical procedure for given assertion, taking account of assessed risk of material misstatements and tests of details, if any, for these assertions. This had to be discussed further. You cannot just understand by going through the side heading. It takes some more time for you to understand what exactly is the meaning of suitability. Suitability of a particular substantive analytical procedure. Okay, done. The second step is, this is somewhat easy to understand. The second step is, auditor should try to focus on the reliability of data. The reliability of data. If the data on which auditor made expectations, if the data which is being used by the auditor for the sake of comparison is not reliable, then what may happen? The data being used by the auditor for the purpose of carrying out analytical procedures is not reliable, then what may happen? The results of analytical procedures are not at all reliable, so are dependable. So if you want to really depend on the results of analytical procedures, the data that is being used by you for the purpose of following such analytical procedure should be accurate, valid and reliable. That is the reason why the auditor should focus on dash reliability of data. So what is the first step involved? What is the first step involved in designing substantive analytical procedures? In designing substantive procedures, the first one is, auditor shall consider suitability of particular substantive analytical procedure for the given assertion. The second one is, the auditor is required to evaluate the reliability of data. And the third one is, the auditor should develop an expectation. You know very well already about how to develop an expectation. And finally, this is nothing but relatable to the concept of materiality. I haven't explained you about the concept of materiality till now. As a part of the last point, I will try to explain concept of materiality, which was included as a part of audit plan and audit program in our material. So I am not explaining anything which is not there in our material. Concept of materiality is there in our material. SA 320 is there, and hence I will try to explain the point materiality in point number D, so that that aspect is also covered. Now these four are the steps. Step number 1, determining the suitability of a particular substantive analytical procedure. Point number 2, determining the reliability of data. Point number 3, developing an expectation. And point number 4, identifying the materiality levels. That's it. Now let us focus. So at least by now you should be able to understand that standard, every auditing standard will have two parts. The first part is the substance of the standard. The second part is called as application and other explanatory material. If you read only the first part, you cannot understand what you need to do. So the first part of standard on auditing is required to be read in conjunction with the second part. What is the second part? Application and other explanatory material. So if you go through a standard in entirety, including application and other explanatory material, then only you may be able to understand the standard. So this approach is very much relevant for you, probably not at CA inter level, but it is certainly necessary for you to go through the original standards on auditing, at least at your CA final level. Without reading, without understanding standards on auditing, you cannot become a chartered accountant at all. It's next to impossible. Don't try to neglect standards on auditing. Auditing is nothing but standards on auditing. What to do, what not to do in auditing has been explained in detail in various standards on auditing. Without understanding standards on auditing, you cannot understand auditing at all. That is the reason why at one point of time or other, you must understand this point. At one point of time or other, you must go through original standards on auditing to have a better view of the standard. Okay, right. So we completed under the heading application and other explanatory material, we completed 2 paragraphs, A1 and A2. Now, the explanation for the term substantive analytical procedures is given. That is the reason why, what is this para? A4, isn't it? And adjacent to the term substantive analytical procedures, the term refer para 5 is mentioned. What is the refer para 5? In para 5 of the first part, the term substantive analytical procedures has been used. In para 5 of the first part, this is para 5. Para 5 of the first part, the term substantive analytical procedures is used. In paragraph number A3, A4 to so and A4 to so and so, that has been explained. The last chapter for our discussion is about audit planning, audit strategy and audit program. First of all, I will try to focus on the terms audit strategy and audit plan. Out of these 3 things, the last one is easy to understand. The first 2 things are very difficult to understand, and even students at CA final level face problems in understanding the differences between the terms that were used in SA 300. Basically, 3 terms are used in SA 300. Actually, they are, the first one is audit strategy. What is that? Audit strategy. That is the first term used. The second one is audit plan. The first one is audit strategy. The second one is audit plan. And the third one is audit program. Actually, the term audit program has been used only once in SA 300. It was not elaborated anywhere in SA 300. And what is all given in our material is elaboration done by the CA Institute in their CA Inter syllabus. The original standard do not contain anything about the term audit program and the term planning and audit. Planning and audit. Generally, students will face difficulty in understanding the terms planning and audit and audit plan. Planning and audit is different. Audit plan is different. Planning and audit is different. Audit plan is different. Most of the students fail in understanding the fact that planning and audit is completely different from audit plan. This is the area from where students start difficulty in understanding SA 300. If you do not understand the fact that these 2 are different from one another, even if you go through SA 300 100 times, you may not be able to understand what is specified in SA 300. So you should be very much careful while listening to this, and you should be able to understand that the terms dash and dash are different from one another. Planning and audit is different from the term audit plan. They are not one and the same. The words appearing therein are one and the same, but the meaning is not one and the same. That is the first point that you must understand. So what is the heading of SA 300? Planning and audit of financial statements. You know very well about the general importance of planning any work. Without planning a work, if you try to perform it, you may end up in completing the task beyond the time schedules. If you really want to complete a work within the time schedules and in the most effective and efficient manner, you need to plan for the work. I repeat, if you want to complete your work within the given time and cost constraints, that too, if you want to carry out your work to be most effective and efficient, you need to plan for the work. And auditing is not having any exception to that. So if the auditor wants to carry out an effective and efficient audit, if the auditor wants to complete his audit within the given time and cost constraints, it is necessary for the auditor to plan for the audit. And how the auditor should have to plan his audit has been explained in a standard called as SA 300. There is nothing difference, there is no difference between the terms SA 300 and what is given in your material, and you will certainly observe very soon that what is given in SA 300 has been reproduced in our material by dividing it into different questions. There is no difference between SA 300 and what is appearing in your material, and hence even though because of time constraints I may fail in going through your material, don't worry, everything that is given in your material is going to be covered under SA 300. Probably I may not be able to cover 1 or 2 points under the heading Audit program, which is well known to you. Okay, done. So SA 300 deals with planning and audit of financial statements. Try to read this standard and try to understand each and every word in detail. The time available is very less or limited, and hence I will try to throw the subject to you. If you are unable to understand, feel free to ask me. I will try to slow down so that you may have better understanding of this. Scope of this standard on auditing deals with auditor's responsibility. That means it is the responsibility of the auditor to plan an audit of financial statements. To plan it is not audit plan, planning an audit. Audit plan is different from planning an audit. Planning an audit is a wider term. What is that? Planning an audit is a wider term. Planning an audit is a wider term and includes 2 things in it. They are audit strategy and audit plan. So, if you prepare an audit strategy and if you prepare an audit plan, it is said that you planned an audit. So, planning an audit involves 2 stages. Planning an audit involves 2 stages. What are they? Preparation of or formulation of an audit strategy and formulation of an audit plan. They both combined together is technically called as dash. Planning an audit. And hence it is said that planning an audit is a wider term, whereas audit plan is a narrower term. So try to understand that planning an audit is a wider term which also includes dash. Dash includes dash, but dash do not include dash. Planning an audit includes audit plan. Audit plan do not include planning an audit. Are you able to understand the exact difference between the terms planning an audit and audit plan? Now read it. This standard on auditing deals with auditor's responsibility to plan an audit of financial statements. And another most important thing which every student must have to understand, if you really want to understand the soul of SA 300, is that this standard has been designed by the CA Institute keeping in view the fact that you are trying to plan for the audit in case of dash audits, in case of recurring audits. So what is mentioned in SA 300 is primarily applicable for planning dash audits. For planning recurring audits. What is meant by recurring audit? Recurring audit means you were the auditor of the entity in the previous year and you have been continued to be the auditor of the same entity for the current year also. In that case, it is said to be a recurring audit. What is mentioned in SA 300 is primarily applicable in case of dash. In case of recurring audits, if the audit engagement that you are going to carry out is a new audit engagement. Since it is a new audit engagement, it is also called as initial audit engagement. Yes or no? You know very well about SA 510, which deals with the concept of initial audit engagements and opening balances. What is initial audit engagement as per SA 510? Initial audit engagement has been defined in two ways in SA 510. What are they? The first one, when the previous year financial statements have been audited by some other auditor and you are made responsible for carrying out the audit of the current year, then since you are conducting audit for the first time in the current year, it is said to be an initial audit engagement for you. In the previous year, no audit has been carried out. The financial statements of the entity under your audit for the current year have not been previously audited by any other auditor. You are the first person to conduct audit. In that case also, it is technically called as dash initial audit engagement. So, all the points that we are going to discuss are required to be understood in the context of audit planning or planning an audit in recurring audits, not in case of initial audit engagements. The procedures that are required to be followed by the auditor for planning an audit in case of initial audit engagements is somewhat different from the procedure to be followed in case of recurring audits. That is the reason why at the starting itself, the standard made it clear to you that the things that we are going to discuss are more applicable for a dash rather than dash, are more applicable for recurring audits and not for initial audit engagements. If at all you want to carry out an initial audit engagement, some additional considerations were given in the standard as the last point in the standard. What we go through is the first point in the standard, paragraph number 1. This is the last paragraph of the standard, which deals with additional considerations that the auditor shall have to take into account while planning for the audit. If the auditor wants to plan for the audit, particularly when the audit is dash an initial audit engagement, some additional considerations shall have to be kept in mind by the auditor. What are the additional considerations that the auditor should take into account while planning an audit in respect of dash were given separately. Planning of audit in respect of initial audit engagements has been given separately. At least by now, you should be able to understand that this standard, most of the parts of the standard are made applicable for dash audits and not for dash audit. The procedures that you are required to follow are somewhat different when you are trying to carry out a initial audit engagement. These are all applicable only for recurring audits. So this standard on auditing deals with auditor's responsibility to plan an audit of financial statements. This standard on auditing is framed in the context of recurring audits. Additional considerations in initial audit engagements are separately identified and given in paragraph number 12. Just now we have gone through the heading of paragraph number 12. Yes or no? So now, are you able to understand what is given in paragraph number 1? Say yes or no. So this standard on auditing deals with the auditor's responsibility to plan an audit of financial statements. This standard on auditing is framed in the context of recurring audits. Additional considerations in initial audit engagements are separately identified. To have better understanding of this standard, we need to go through A1 to A4 paragraphs. As I said earlier, application and other explanatory material will be provided below the standard, and by going through that application and other explanatory material, you will get some more knowledge of the standard. So if you really want to understand what is mentioned in paragraph number 1, you are required to go through paragraph number A1 to A4. I will try to focus only on few points. You are also expected to focus only on those points. They are sufficient. As of now, once I am able to complete the entire standard, those points that were left from our discussion are automatically understandable to you. So try to focus only on those points which are being explained to you. This is application and other explanatory material. And paragraph number A1, only you need to understand some portion of it. Once we complete essay 300, you will be able to understand the remaining portion on your own without any further explanation. Planning an audit. What is that? Planning an audit. That is a wider concept. Planning an audit is a wider concept. Dash is a narrower concept. Audit plan is a narrower concept. Planning an audit is a wider concept. Planning an audit involves establishing overall audit strategy. That is step number 1 in dash. What is step number 1 in dash? Planning an audit. Step number 1 in planning an audit is auditor shall establish dash the overall audit strategy for the engagement, and auditor shall also develop an audit plan. Planning an audit is different from audit plan. Planning an audit involves two things. What are they? Establishing overall audit strategy and developing an audit plan. I repeat, planning an audit involves two things. What are they? The first one is establishing overall audit strategy, and the second one is developing an audit plan. That is the reason why I said to you that planning an audit is a wider term, whereas developing an audit plan is a narrower term. The term developing an audit is a part of planning an audit, but planning an audit is not a part of development of an audit plan. Followed? Are you really able to follow this point? If you fail to understand this point, don't listen to the remaining discussion. It is not understandable to you. Okay? What is the gross concept? Planning an audit. What is included in it? Audit plan is included in it. So planning an audit involves establishing overall audit strategy as well as developing an audit plan. That's it. This is what you need to understand as of now in paragraph number A1. And in fact, out of these things, I have already explained you this point. Planning will certainly help the auditor in carrying out his audit in the most effective and most efficient manner. So out of several advantages are benefits of planning the audit. Out of several advantages are benefits of planning an audit. One benefit is already known to you. We will discuss the other benefits later. Now, A2. In A2 paragraph, first of all, you need to understand planning activities. Otherwise, you cannot understand A2. These two are technically called as planning activities. What is that? These two are technically called as dash. Planning an audit involves some activities. Planning an audit involves some activities. Activities involved in planning an audit are called as planning activities. What are planning activities? Planning activities are two in number. What are they? First one is establishment of overall audit strategy, and second one is development of an audit plan. They are part of planning an audit, and hence they are technically called as planning activities. Planning activities. So you can understand only that point under A2. The nature and extent of planning activities will vary according to the size of the entity as well as the complexity of the entity, the team members' previous experience, etc., etc. All these points you are going to understand all these points in very near future, within few minutes. This is about paragraph number A2. Now, first of all, just go through paragraph number A9. What is the heading of paragraph number A9? Planning activities. What are planning activities that we discussed just now? What is this is again explained in paragraph number 9. Planning activities were explained in paragraph number 9. Paragraph number 9 are planning activities include what? Establishment of overall audit strategy and development of an audit plan. They are technically called as planning activities. So planning an audit. Planning an audit involves planning activities. Planning an audit involves planning activities or includes planning activities. Planning activities are 2 in number. What are they? The first one is establishment of overall audit strategy. The second one is development of an audit plan. These two are part of planning activities. Planning activities are required to be performed for the purpose of planning an audit. Are you able to understand at least now? Done. So this is about paragraph number A2. The next paragraph is very important, very, very important. Planning is not a separate phase of an audit. Discrete means not separate. Not discrete means it is not separate. Planning is not a separate phase of an audit, but rather a continual and iterative process. Iterative means a repetitive process. I repeat, planning is not a discrete phase of an audit, but rather a continual and iterative process that often begins shortly after the completion of the previous audit and continues until the completion of the current audit engagement. So by this, what you need to understand is the auditor should start the process of planning an audit immediately after completion of a particular audit engagement. Because just now you have completed audit engagement, you know very well about how the books are maintained, you know very well about how internal controls are working, you have just now given a report, you know very well about the type of the report that you have given. Everything is within the knowledge of the auditor. The auditor is having very good knowledge of the entity because just now the auditor completed dash. The auditor is having very good knowledge of the entity because just now the auditor completed the audit. What he is saying, this standard is applicable only generally for dash. Recurring audits. Recurring audits means in the previous year you were the auditor, for the current year also you were the auditor. Just now you have completed your previous year audit. Now you should start planning for the current year audit. Yes or no? Just now you have written your examinations. You will take rest for 1 or 2 days. Then you start analyzing yourself honestly. And if you are having a slightest doubt, any slightest doubt that you may not be able to clear the exam that you have just now written, what will you do? Will you wait for the result or will you start your preparation immediately? At least you should plan your preparation. When do you plan your preparation? Not after issuance of the results, but immediately after writing your examination. Similar to that, here also, once you complete current year, previous year audit, you should start planning for the audit of the next financial year. Are you able to follow me? Read it. Planning is not a discrete phase, a separate phase of an audit, but rather a continual and iterative process that often begins shortly after the completion of the previous audit and continues until the completion of the current audit engagement. And this is a very difficult point to understand. So be careful while trying to understand this point. And this point is having some link with some other point. Are you able to recollect what you have listened to in essay 220? Quality controls while carrying out an independent audit. In fact, in essay 220, there is a specific point called as acceptance and continuance of client engagement and client relationships. What aspects have been discussed under the heading acceptance and continuance of clients relationships and client engagement? The first one is you need to consider the integrity of the management. If you are confident that the management integrity is not in doubt, that means management is honest. Why the auditor is considering the honesty of the management? If the management is honest, they don't try to follow fraudulent financial reporting. Everything will be reported perfectly by the management when management is honest. So the risk to the auditor will also be very, very less when the management is honest. Are you able to follow it? If the management's integrity is in doubt, then what is the problem to the auditor? If the management integrity is in doubt, there is every chance that management could have involved in fraudulent financial reporting. When the management involves in fraudulent financial reporting, then there is a higher risk of material misstatements in the financial statements. If by any chance the auditor fails to detect such material misstatements in the financial statements, the opinion given by the auditor will also become wrong or inappropriate. When the opinion given by the auditor becomes wrong or inappropriate, there will be an increased risk to the auditor. And that risk is technically called as audit risk. If you were the auditor, will you try to keep your audit risk at a high level, or will you try to reduce your audit risk to an acceptably low level? As per the previous class discussion, you must have to understand that there will always be some risk to the auditor. Auditor cannot reduce his audit risk to zero, but auditor can certainly reduce audit risk to an acceptably low level. How it is possible for you to reduce the audit risk to an acceptably low level? By checking the integrity of the management. If the management's integrity is not in doubt, management could not have resorted to fraudulent financial reporting. In that case, the possibility of risk of material misstatements in the financial statements is less. In that case, failure to detect material misstatements would also be less. Therefore, the auditor's risk would also be less. If you do not want to take risk, first of all, you need to focus on the integrity of the management. The second one is, you should also consider whether you are really able, based on the audit just now you have concluded, you need to consider whether you are really able to be independent or to maintain independent. Sometimes during the course of audit of the previous financial year, management could have imposed some restrictions or limitations on the scope of audit. And such limitations lead to issuance of a disclaimer of opinion. As I said earlier, I don't know whether I have explained that point to you or not. You are carrying out the audit. Management is trying to impose several limitations or restrictions on the rights of the auditor as well as on the duties of the auditor. That means management is trying to impose several limitations or restrictions on the scope of audit. Because of that, the auditor is unable to obtain sufficient appropriate audit evidence. Because of such limitations, auditor is unable to obtain sufficient appropriate audit evidence. Because of that, the auditor is of the opinion that it may not be possible for me to continue the audit because management is imposing several limitations or restrictions. Even if I continue this audit, I would have to issue a disclaimer of opinion. What is the situation in which auditor is required to issue a disclaimer of opinion? When the auditor is unable to obtain sufficient appropriate audit evidence, and when the auditor concludes that the undetected misstatements in the financial statements could be material and pervasive. The impact of undetected misstatements on the financial statements could be both material and pervasive. Why you are unable to obtain sufficient appropriate audit evidence? Because the management is trying to impose several limitations or restrictions either on the rights of the auditor or on the duties of the auditor. So during the course of performance of audit, management is trying to impose several limitations or restrictions either on the rights of the auditor or on the duties of the auditor. Because of such limitations or restrictions, the auditor is of the opinion that it is highly impracticable for him to obtain sufficient appropriate audit evidence. In a situation where the auditor is unable to obtain sufficient appropriate audit evidence, the auditor may have to issue either a qualified opinion or a disclaimer of opinion. In the given case, the auditor is of the opinion that it is not possible for me to issue a qualified opinion, but I may have to issue a disclaimer of opinion if I continue to carry out this audit. In that case, the auditor is not expected to carry out or continue the audit. Instead, the auditor had to withdraw. This point should have been explained to you under SA 705. The auditor has to withdraw from his audit engagement when the law permits. When the law permits. When the law is not permitting the auditor to withdraw from the audit engagement, then what the auditor should do? The auditor had to continue with the audit engagement, and finally the auditor is required to issue a disclaimer of opinion. All these things happens in the past year. And ultimately you have continued the audit and you have given a disclaimer of opinion. You are not satisfied with the way in which you have been dealt with by the management in the past. Can you continue this audit for the next coming financial year? Why? Why? Because you are having some doubts on the integrity of the management, and you are having some doubts about whether you are able to maintain independence or not. Apart from these two most important things that the auditor must consider before continuing. What is that? Before continuing the dash with dash, a relationship with the client. That is the reason why the heading of SA 220 appears as dash. Acceptance. What is meant by acceptance? Whether to accept a new engagement, and continuance. What is meant by continuance? Or to continue with the existing engagement. In both the cases, if you are trying to accept a new engagement or if you are trying to continue with the existing engagement, you must have to consider your relationships with your client. You must have to consider your relationships with your client. And after considering the relationships, you need to take a decision about whether to accept this audit or not, or about whether to continue this audit engagement or not. What aspects should you consider either before accepting the client relationship or before continuing the client relationship? The first one is integrity of the management. The second one is whether you are capable of maintaining independence if you accept that audit or if you continue that audit. Apart from that, you need to consider things like whether you are having adequate expertise in carrying out that audit. That audit engagement. Sometimes for the previous year you were the auditor. For the current year also you are proposed to be appointed as the auditor. The company is entering into a new line of business which is not known to the auditor. Auditor is not having knowledge of carrying out audit in respect of such type of business operations. In such case, you may not be confident to carry out that audit. You may not have competence to perform the audit. When you are not having competence to perform the audit, then it is better for the auditor not to accept the audit engagement or not to continue with the audit engagement. If I have explained you SA 220, I would have given you an example, but unfortunately I haven't explained you SA 220. I carried out some type of audit in Times of India, Hyderabad branch, and that audit is technically called by them as waste management audit. What is that? Several waste will be generated in the production of paper, in the publication of paper and other journals that is valuable in nature, and hence they do appoint an auditor called as waste management auditor. The auditor is required to check whether waste management is being done properly in the organization or not. It is called as waste management audit. After a few years, I received a call from Times of India, Hyderabad branch, asking me to accept a GST audit. That concept of GST audit is very new those days, and I don't know how to carry out GST audit. In fact, no other auditor in India knows about what is GST audit, what areas are required to be focused on while conducting GST audit. Truly, I am not having any knowledge about GST audit. They proposed me to appoint as their GST auditor. I said that please give me a time up to evening. Please call me in the evening. I will confirm whether I am going to accept this audit or not. I know very well that I am not having competence to carry out GST audit. Later on, I spent almost 4 to 5 hours of time searching for what is to be carried out in GST audit, what special aspects are required to be focused while conducting GST audit of printers and publishers, etc. After spending almost 5 to 6 hours of time, now I got a confidence that I am able to carry out GST audit. I am competent to carry out GST audit, but unfortunately I haven't received any further call from them later on. I haven't accepted the audit immediately after receipt of the proposal. I think of whether I am capable of, I am competent to perform that audit or not. Another example is very recently Masterminds proposed me to take CA final classes also. Particularly there is a subject called as Auditing in CA final, and they asked me to take the final classes. I said that I am not able to take that class because there are some standards in ICAA final cost auditing called as cost accounting standards. They are 22 in number. I don't know the cost accounting standards. I may have a generalized view about the subject. I don't have specific knowledge of cost accounting standards, and it takes much of my time for preparation. I am not having time to prepare, therefore I cannot take the class. So I assessed my competence and said that I am unable to take that class only purely because of the existence of cost accounting standards. Every other chapter is known to me. Every other chapter has been explained by me to thousands of students in the past, accepting cost accounting standards. Only because of that, I rejected their proposal. So what I try to communicate to you is that if you get any new engagement, don't try to accept it straight away. First of all, you need to consider whether you are competent to carry out that work or not, whether you are having time to carry out that work or not, whether you are having manpower to carry out that work or not. After evaluating all these things only, first of all, you need to decide whether to continue with the existing engagement or not. I am not saying that whether to accept this engagement, because in SA 300 it was clearly mentioned that this is applicable only for dash audits, recurring audits. You were the auditor in the previous year and you are proposed to be continued as the auditor for the current year. In that case, you need to say to the management whether you are going to continue this audit or not. First of all, you need to take a decision about whether to continue this audit engagement or not. Once you decide to continue the audit engagement, then you have to plan for the audit. Planning an audit is necessary when you decide to continue the audit. When you decide not to continue the audit, is it necessary for you to plan the audit? So what is precedent of planning an audit? What is the precedent of planning an audit? Whether to continue with the audit engagement or not is the first thing that the auditor should have to decide. If you decide to continue with the audit engagement, then you need to plan for the audit engagement. Are you able to understand this point or not? So don't try to plan the audit straight away. First of all, take a decision about whether to continue the relationship with the client, whether to continue the current year audit engagement. What aspects do you consider before taking a decision about whether to continue with the current audit engagement? The integrity of the management, whether you are able to maintain independence or not, whether you are having competence to carry out the audit, whether you are having manpower to carry out the audit, whether you are having a time to carry out the audit. All these things are required to be considered. Then you need to make a decision about whether to continue with this audit engagement or not. Once you made a decision to continue with the audit engagement, then you are expected to follow SA 300. Then you are required to follow planning and audit. That planning and audit involves two activities called as planning activities. What are they? The first one is establishing an overall audit strategy, and the second one is designing an audit plan, which includes designing a program called as audit program. Followed? Read it. Now you may be able to understand what is about preliminary engagement activities. Preliminary engagement activities are different from planning activities. Preliminary engagement activities are different from planning activities. There are two terms. The first one is planning activities. The second one is preliminary engagement activities. Both are activities. Which one is precedent to other? What is the first one to be carried out by the auditor? First of all, the auditor should carry out preliminary engagement activities. After carrying out preliminary audit engagement activities, if the auditor decides to continue with the client, to continue the relationship with the client, to continue the audit for the current year, also since you want to continue the audit for the current year, you need to carry out planning and audit. That planning and audit involves carrying out two activities called as planning activities. Those are establishing an audit strategy and establishing or designing an audit plan. So which is precedent and which is successor? Preliminary engagement activities is precedent, planning activities is a successor. So first of all, if the client asks you or if the client requests you to continue the audit engagement for the current year also, what the auditor should do? First of all, the auditor is required to carry out dash activities, preliminary engagement activities. What are the things that are required to be considered by the auditor while carrying out or performing preliminary engagement activities? Whether you are able to maintain independence or not, whether you are having an ability or competence to perform that engagement. You need to consider about the integrity of the management. And there should not be any misunderstanding with the client as to the terms of audit engagement. What is this? In SA 210, what is that? In SA 210, it is particularly mentioned. What is SA 210? Agreeing the terms of audit engagement. Sometimes client may request the auditor to make changes. Client may request the auditor to you are turning on pages. Client may request, don't try to turn the pages, try to recollect what you have listened in the class. If you have really listened to the class, you will be able to recollect it, at least some portion of it, without referring to the material. Every time if you want to refer to the material, it means you are lacking in listening. So don't try to go through the material. First of all, try to recollect what you know about that particular topic. What is that topic? Audit engagement letter. Sometimes management may have requested the auditor to make changes in the terms of audit engagement. When the management requested the auditor to make changes to the terms of audit engagement, if you were the auditor, will you straight away make changes to the terms of audit engagement? First of all, you need to make an inquiry with the management about why management is asking you to make the changes in the terms of audit engagement. And management may provide some reasons for you. And if such reasons were found to be genuine by the auditor, if the auditor satisfies that there is a reasonable justification, if the auditor satisfies, and ఒక పావు గంట పెరగచ్చు కాస్త చెప్పండి వాళ్ళతో, ఓ పావు గంట మ్యాక్సిమం ఎక్స్ట్రా పావు గంట, 10వ గంట కల్లా వదిలి తీరేస్తా, ఎంత అయితే అంతే, రైట్? వాట్ ఈస్ దట్? You can take the break after 15 minutes, no problem. The next lecturer will come 15 minutes late, okay? Done. What is that? I don't want to delay this for the next day. I need to complete it today itself, because I am planning to go to Tirupati today is night or tomorrow morning, and I haven't informed the same to the organization also. I will try to do that later. Okay. Tuch, నేనేం చెప్పలా, మీరేం వెళ్ళా ఎక్కడున్నాం? So చెప్పినా పర్లేదే. So first of all, the auditor should try to evaluate things like the independence of the auditor, whether the auditor is competent to perform the audit, the integrity of the management. Apart from that, sometimes management would have requested the auditor to make changes in the terms of audit engagement. Then the auditor should verify whether the reasons why the management is asking the auditor to make changes to the terms of audit engagement are reasonable or not. If there is some reasonable justification to the request made by the management, there is no problem for the auditor to make changes to the terms of audit engagement. If there is no reasonable justification, or if the client is trying to impose, the client is trying to no restrictions were imposed in the previous year, but now for the current year, before accepting your continuation as an auditor, the client is trying to impose some dash to the auditor, on the rights and duties or on the scope of audit, which are not at all acceptable to you. Client is asking you to make changes to the terms of audit engagement. You are not willing to make the change. So there will be some dispute between the auditor and the management with regard to making changes to the terms of audit engagement. In such case, what will happen? Don't try to continue with the audit engagement. Why? Because the client is not allowing you to carry out the audit without making necessary changes. You are not willing to make the changes. Are you able to follow this? Client is asking you to make some changes to the audit engagement and then continue the audit engagement. You are of the opinion that there is no need to make any changes to the audit engagement, and if you are expected to make changes, you don't want to continue the audit engagement. When you do not want to continue the audit engagement, what is the need to plan for the audit? Therefore, whether the client has asked you to make any changes to the existing terms of audit engagement or not, and whether there is a reasonable justification for the same or not, is also required to be considered by you under the heading dash. Under the heading dash, preliminary engagement activities. After considering all those activities, and the auditor's consideration of client's continuance and ethical requirements, including independence, occurs throughout the audit engagement as changes in conditions and circumstances occur. Performing initial procedures on both client continuance and evaluation of independence at the beginning of the current audit engagement means that they are completed prior to performance of other significant activities for the current audit engagement. For continuing audit engagement, such initial procedures often occur shortly after the completion of the previous audit. That is the reason why I said to you that just now you have completed the previous year audit, and you know very well about what are all the restrictions that have been imposed by the management on you while you are carrying out audit of the previous year, and several restrictions were imposed. Because of such restrictions, you were compelled to issue a dash opinion, a disclaimer of opinion, and you know very well that you need to withdraw from the audit engagement in the previous year itself, but law has not permitted you to withdraw from the audit engagement. Hence you continued the audit. You have given a disclaimer of opinion. Why you have given a disclaimer of opinion? Because the already client has imposed some limitations on your work in the previous year. Would you like to continue with the same client for the current year? No. That is the thing that you need to check before accepting the continuance of the current year audit. And that activity or those activities are technically called as dash. Preliminary engagement activities. Once you perform preliminary engagement activities and once you satisfy with the results of the preliminary engagement activities, then the auditor should start planning the activity, planning the audit. Under the heading planning the audit, you need to perform planning activities like establishing an audit strategy and designing an audit plan. So what we are reading was A3. Planning is not a discrete phase of an audit, but rather a continual and iterative process that often begins shortly after the completion of the previous audit and continues until the completion of the current audit engagement. This is the most important point. Planning includes, audit planning includes. That means once you decided to continue with the audit, engagement, the next step to be followed by the auditor the next step to be followed by the auditor is to take decisions about these things. It is also planning, but even before commencement of planning the audit, you need to take some more decisions relating to audit. Read it. Planning includes consideration of timing of certain activities and audit procedures. Consideration of timing of certain activities and audit procedures that need to be completed prior to performance of further audit procedures. For example, planning includes need to consider prior to auditor's identification and assessment of risk of material misstatements, such matters as So planning includes, you need to take a decision. As a part of planning, you need to take a decision about dash. The analytical procedures to be applied by you as a part of dash procedures, as a part of risk assessment procedures. You need to determine the materiality levels. You need to determine whether there is any need to involve any expert. I will try to establish some link between these points and the points that I am going to discuss in this standard, and the performance of other risk assessment procedures. Leave this, try to focus on point number 1, 2 and 3 and 4. Analytical procedures to be applied as risk assessment procedures. You need to determine the materiality. You need to decide about whether any expert is required to be involved in carrying out your work. This is technically called as dash. This is technically called as dash. Planning and audit includes things like, matters like analytical procedures to be applied as risk assessment procedures, materiality determination, involvement of experts, etc. And now let us go through the original standard. These are all explanations that we read till now. Scope of this standard, paragraph number 1 is over. There is no need to discuss anything about paragraph number 2. Paragraph number 2 contains effective date or the date of applicability of the standard. This is applicable from 1st April 2008. Objective is also well known to you. Why the auditor should plan an audit to perform the audit in a dash manner, in an efficient and effective manner. What are the requirements of this standard? Out of the requirements, the first one is involvement of key engagement team members. The second one is preliminary engagement activities. Fortunately, we had a discussion about dash preliminary engagement activities. We completed that discussion. What is given under the heading preliminary engagement activities? Just go through it and accept that you understood the concept of preliminary engagement activities. The auditor shall undertake the following activities at the beginning of the current audit engagement. Performing procedures required by SA 220, quality control for an audit of financial statements regarding continuance of client relationship and the specific audit engagement. Evaluating compliance with ethical requirements including independence as required by SA 220 and establishing an understanding of the terms of the engagement as required by SA 210. Be honest, are you able to understand these 3 points? If you fail to understand these points, I can say that you failed to listen to the heading preliminary engagement activities. I said to you about 3 points under the heading preliminary engagement activities. All those points have been taken from this only. So preliminary engagement activities is very well known to you now. Now let us focus on the most important one, planning activities. What is that? Once you perform dash, you can perform dash. Once you perform preliminary engagement activities and decides to continue with the existing audit engagement, then you need to plan for the existing audit engagement, and that planning involves some activities. Such activities are called as planning activities, which includes dash and dash, which includes establishment of an overall audit strategy and designing an audit plan. Now let us first focus on the first one. What is that? Establishing an audit strategy. Later on we can focus on audit planning. Once you are able to understand these 2 things, it is easier for you to understand audit program and its importance, right? So planning activities. The auditor shall establish an overall audit strategy. This is nothing but step number 1 in planning activities. What is step number 1 in planning activities? Auditor shall have to establish an overall audit strategy that sets the scope, timing and direction of the audit. That sets the scope of audit, timing of not scope of audit procedures, not timing of audit procedures. Scope of audit, what to be carried out, what not to be carried out, when to carry out such procedures, how to direct the people, etc. Overall, in general, will be decided by the auditor while establishing dash. Overall audit strategy, which will guide the auditor in dash, which means establishment of an audit strategy will guide the auditor in development of dash, in development of audit plan. That is the reason why I said that first step involved is establishment of overall audit strategy, which will help the auditor in designing or developing a plan called as audit plan. These two are the part of dash. Planning and audit. Planning and audit includes planning activities. Planning activities includes establishment of overall audit strategy and audit plan. Now let us focus on the first thing. What is that? Establishing an overall audit strategy. In establishing the overall audit strategy, the auditor shall identify the characteristics of the engagement that defines its scope. The auditor should also ascertain reporting objectives. The auditor should also ascertain reporting objectives. The auditor should also consider results of preliminary engagement activities. You know very well about what is preliminary engagement activity. Results of preliminary engagement activities, where applicable, whether knowledge gained on the other engagements performed. That I will explain you later. And ascertain the nature, timing and extent of resources necessary to perform the engagement. If you really want to understand what is overall audit strategy, first of all, you need to understand the first two things in detail. The first one is characteristics. The second one is reporting objectives. In order to understand the characteristics, an appendix has been given to this standard. All the points in the appendix are very difficult for you to understand. I will try to explain 2 to 3 points under each and every heading, the most important points. They were given in your material also. Try to listen and understand these points, then you can just simply read your material and try to understand them. So what we are discussing now, auditor is in the process of developing or establishing overall audit strategy. In order to develop or establish overall audit strategy, first of all, the auditor should consider dash, the characteristics of the engagement. But before explaining you the term characteristics of engagement, okay, I'll do it now. Later on, I will try to explain you the other 4 points like resources, timing of resources, number of resources, etc. When to employ resources, etc. What are characteristics of the engagement while auditor is designing or establishing an overall audit strategy that the auditor should consider. The first one is this one, the expected audit coverage, including number and location of components to be included. For example, if the company is having a head office and say having 100 branches, and if you are made responsible to conduct audit of both head office as well as all the branches, then the number of persons required, the resources required to carry out the audit would be more. Yes or no? How many number of people should be assigned to the task? How many number of people should be assigned to the task of carrying out this activity effectively? That the auditor should ascertain. How many people are to be involved in carrying out the audit? How many people will you involve in carrying out an audit engagement? It depends. It depends upon the size of the organization. It depends upon the size of the organization being audited. If the organization is a very big organization, you will try to employ more and more people. If the organization is less in size, you will try to employ lesser number of persons. So number of persons to be engaged for the purpose of carrying out this audit shall have to be determined by the auditor as a part of overall audit strategy. I repeat, number of persons required for carrying out the audit is required to be decided by the auditor as a part of dash, as a part of overall audit strategy. To decide about number of persons required, several aspects are required to be considered by the auditor. How many number of people are required for you for the purpose of carrying out audit? It depends on several factors, or it depends upon the characteristics of the engagement. What are the characteristics of the engagement the auditor should consider? What characteristics of the engagement should the auditor consider? First of all, the auditor should consider about how many number, what is that? How many number of components are included in the financial statements? How many number and number ఏమండి పెన్ రాయట్లో ఒకసారి మీకు తెలిస్తే చెక్ చేయండి. హౌ మెనీ నెంబర్ అండ్ లొకేషన్ ఆఫ్ కాంపోనెంట్స్ టు బి ఇంక్లూడెడ్. సిస్టమ్ షట్ డౌన్ చేయమని మాత్రం చెప్పొద్దు, అయితే అవుతుంది లేకపోతే లేదు. సరే సరే. సో ఓకే, సో హౌ మెనీ నెంబర్ ఆఫ్ components are to be audited, how many locations are required to be audited. If all the 100 branches are in different locations, you need to employ more and more people, you need to employ more and more resources to complete the audit within the given time constraints. Therefore, the characteristics of the engagement are required to be considered by the auditor while establishing the overall audit strategy. What are the characteristics that the auditor should consider? The number of components to be audited, the location of components to be audited. And you can also consider this aspect, the extent to which components are audited by other auditors. Supposing that there are 100 branches, out of which 50 branches are required to be audited by some other person, and you are made responsible for conducting audit of only the remaining 50 branches, then the resources to be employed by you for the purpose of conducting audit would be less. So how many number of people are required to be allocated for this? How many number of people are required to be allocated for this audit engagement? What resources are required to be allocated for this audit engagement is required to be decided by the auditor first as a part of overall audit strategy, for which the auditor is required to consider things like characteristics of the engagement. Under that heading, the auditor should consider things like number of components to be audited, location of components to be audited, the extent to which components are audited by other auditors. And another important point which is not there in our material is the availability of the work of internal auditors and extent of the auditor's potential reliance on such work. You know very well about SA 610. If internal auditor is there, if the work of the internal auditor is more effectively carried out and efficiently carried out, the external auditor can place reliance on the work of the internal auditor. If you are trying to place reliance on the work of the internal auditor, or if you are trying to make use of the internal auditor as your direct assistant, obviously the number of persons to be employed for the purpose of carrying out your audit engagement would be less. Yes or no? So how many people are required to be recruited, or how many people are required to be assigned for carrying out this particular audit assignment is to be decided by you as an auditor as a part of dash. As a part of dash, establishment of an overall audit strategy under SA. So for that purpose, you need to consider all these things, the availability of the work of the internal auditors and the extent of auditors' potential reliance on such work. That is sufficient for you. And the expected use of audit evidence obtained in previous audits. For example, audit evidence related to risk assessment procedures and tests of controls. Already you carried out the audit in the past. Now you are continuing the same audit engagement. In the previous year, you have already evaluated, you have already carried out compliance procedures, otherwise called as tests of control. In the previous year, you have already completed risk assessment procedures. If you want to rely on those procedures, the number of people required will be less. If you do not want to rely on those things and you want to start afresh, then the number of people to be assigned for this specific task will be more. So how many number of people are required to be assigned to this task of carrying out audit engagement is required to be decided by the auditor as a part of establishment of overall audit strategy, which requires consideration of characteristics of the engagement. Under that heading, I explained you 4 points. And the second one, I can explain several points, but lack of time, I may not be able to do that. The effect of information technology on the audit procedures, including availability of data and expected use of computer-assisted audit techniques. If you want to follow computer-assisted audit techniques, the number of people to be assigned for the task would be less. If you want to carry out everything manually, the number of people required for conducting audit would be more. So, to decide about the number of people to be assigned to that particular task, you are required to carry out or consider all these things. The next one is reporting objectives. This point is the only important point under this heading, although there are some other points given in our material. Don't try to read them, try to read only this point. Ask the management about the timetable. What is the date by which the management is expecting the auditor to submit his audit report? What is the date within which management is expecting the auditor to submit his audit report? If the management is giving you a time of only 10 days, you need to employ more and more people for the purpose of conducting audit. If the management is giving enough time to carry out the audit, the number of people to be assigned to this task will be limited. So, number of people to be assigned for this particular task is decided by the auditor, keeping in view dash and dash. Keeping in view the characteristics of the engagement as well as the reporting objectives, particularly the timetable. Sometimes organization may ask you to make an interim report and final report. If the number of reports to be issued is more, the number of people to be employed would also be more. And significant factors, preliminary engagement activities and knowledge gained in other engagements. The determination of materiality and where up, that point has already been explained to you. Determination of materiality in accordance with SA 320 and where applicable materiality for components, etc. Preliminary identification of areas where there may be higher risk of material misstatement and so on. There is no need to go through each and everything. The timing and extent of resources. This is most important. Selection of the engagement team. Selection of, this is why the auditor is establishing overall audit strategy. Why the auditor is establishing overall audit strategy? To decide the extent of resources to be employed. The first point is, I will do one thing. I will try to explain these 3 points in our material, which are very easy to understand in our material. That is very difficult to understand in the original standard and easy to understand in our material. So I will try to show you the material. Just 1 minute. జీవితం టైం అయిపోతుంది, ఇది అవ్వదు అదో జీవితం. సో audit planning, why do the auditor shall establish a overall audit strategy? That is question number 2. Question number 2. How overall audit strategy assist the auditor while developing a detailed audit plan? Or what are the benefits of overall audit strategy? First one, overall audit strategy. In determining overall audit strategy, the auditor should decide about the number of persons to be allotted for some specified audit areas or time to be allotted for some specific audit areas. That is the number of persons from audit team to observe inventory count at various godowns. Then the next one, how allocation of manpower should be made. It is based on complexities involved in the areas. In complex audit areas, generally experienced team members will be assigned, or sometimes experts help may be taken. For example, if the organization is carrying out an insurance business, the services of an actuary may have to be used by the auditor as a part of performing his audit procedures. The expected date of starting the audit and expected date of completing the top item to be verified, and coordinating, directing and supervising the resources. For doing all these things only, the auditor is required to establish overall audit strategy. Out of these things, at least try to understand the first three. What are they? How many number of people are required to be assigned to a particular task? Whether that team should contain only experienced persons or inexperienced persons or a combination, for which work which person is required to be allotted. These things are required to be decided by the auditor by going through dash, by establishing dash overall audit strategy. This is about audit strategy. Once the auditor is able to establish overall audit strategy, like number of people required to carry out the audit, the number of the persons who are required to perform a particular task, etc. Then based on that, the auditor is required to develop a plan called as audit plan. Now you can just go through the term overall audit strategy. Why should the auditor establish overall audit strategy? First, go through point number 2. To decide about amount of resources to allocate. Why the auditor should establish overall audit strategy? While establishing overall audit strategy, the auditor has considered characteristics of the engagement and other aspects. After considering all those things, the auditor may be able to decide about dash, may be able to decide about the amount of resources to allocate to specific audit areas, such as the number of team members assigned to observe inventory count, extent of review of work, etc. The resources to deploy, such as use of appropriately experienced team members for high risk areas or involvement of experts on complex matters. When these resources are to be deployed, should these resources be deployed from day one, or these resources are required to be deployed at the interim stage or at the final stages of audit? How these resources are to be managed, directed and supervised. These are all the things that are required to be decided by the auditor while the auditor is establishing dash overall audit strategy. Now, are you able to understand at least 3 out of these 4? What is the first one? Amount of resources to be employed can be decided by is to be decided by the auditor. The resources to be deployed is to be decided by the auditor. When these resources are required to be deployed, what are the things to be directed and supervised? You know very well that initial work will be carried out by article students. Later on, a senior assistant will supervise the work performed by the article students, and finally engagement partner will review the audit work. Who should perform the audit work? Who should supervise the audit work? Who should review the audit work? To plan all these things, the auditor is required to establish dash overall audit strategy. This is first activity under the heading planning activities. And the second one, the appendix list examples of considerations in establishing the overall audit strategy. So what is there in the appendix is required to be considered by the auditor when the auditor is developing dash establishing an overall audit strategy. Some of the same have already been explained. Once the overall audit strategy has been established, an audit plan can be developed to address various matters identified in the overall audit strategy, taking into account the need to achieve audit objectives through the efficient use of audit resources. But this is a very most important point which students may fail to understand. These two are not sequential. The establishment of overall strategy and detailed audit plan are not necessarily discrete or sequential process, but are closely interrelated. What they are trying to say to us is, there is no need for the auditor first to develop a dash and then to develop dash. First to establish overall strategy and then to design an audit plan. Instead, these two activities can be performed by the auditor concurrently, simultaneously, one after another or one by one. So, there is no rule that first of all the auditor should establish audit strategy and then only the auditor should develop an audit plan. But these two things can be carried out by the auditor concurrently or simultaneously. And the next one is developing an audit plan. The audit plan is more detailed than overall audit strategy. Audit plan includes the nature of audit procedures to be followed, the timing of audit procedures to be followed, the extent of audit procedures to be performed, nature of audit procedures, timing of audit procedures, extent of audit procedures to be performed will be detailed by the auditor, not in dash, but in dash. Not in audit strategy, but in a plan called as audit plan. So the audit plan is more detailed than the overall audit strategy that includes the nature, timing and extent of audit procedures to be performed by engagement team members. Planning for these audit procedures takes place over the course of audit. Over the course of audit, as the audit plan for the engagement develops. For example, planning, this is a very important point. You cannot understand this point on your own even after passing CA final. For example, planning the auditor's risk assessment procedures occurs early in the audit process. However, planning the nature, timing and extent of specific further procedures depend on the outcome of risk assessment procedures. You ask any lecturer who is dealing with auditing subject about a question, a doubt. Your doubt should be like this. Sir, should we establish audit strategy first or should we carry out risk assessment procedures first? Should we establish audit strategy first or should we carry risk assessment procedures first? Why? Because strategy is also dependent upon risk assessment procedures. If you assess the risk at high level, then you need to change your strategy because more number of people are required to be deployed. Are you able to follow me? So my question to you is, if you were the auditor, would you try to follow risk assessment procedures first or would you try to establish overall audit strategy first? Nobody will give you an answer except me. Trust me. If you are carrying out a recurring audit, first of all, establish overall audit strategy. Why? Because you are already having knowledge of the risk assessment procedures which you have just completed in your previous year audit. Therefore, in that case, straight away the auditor should go to establishment of overall audit strategy. But if you are carrying out an initial audit engagement and if you know nothing about the organization, in that case, what should the auditor do? First of all, the auditor is required to perform risk assessment procedures. Based on the results of the risk assessment procedures, the auditor should design overall audit strategy. Later on, slowly the auditor can develop an audit plan. Trust me, you are not going to listen this point in your lifetime. This is the first and last time that you are listening to this. Take it for granted. You don't listen it even in your CA final. Ask anyone about whether he is capable of explaining this point to you or not. It is very difficult to understand. If you do not have an overall view about SA 300, you cannot understand when to follow audit strategy, when to establish audit strategy, and when to follow risk assessment procedures. And now you can read the point, you can have better understanding of this point. Planning for these audit procedures takes place over the course of audit as the audit plan for the engagement develops. For example, planning of the auditor's risk assessment procedures occurs early in the audit process. However, planning the nature, timing and extent of further audit procedures depend on the outcome of those risk assessment procedures. In addition, the auditor may begin the execution of some of the further audit procedures can be started by the auditor even before following risk assessment procedures. So, the only point that they have explained under the heading SA 300 about audit plan is audit plan includes dash, nature, timing and extent of audit procedures. That's it. And then changes in planning decisions during the course of audit. You haven't performed dash. You haven't performed risk assessment procedures while establishing overall audit strategy as well as while designing an audit plan. Why the auditor has not performed risk assessment procedures? Because this is a dash audit. This is what if the audit is a recurring audit? We have already performed this audit in the past. In the previous year, we performed dash and dash risk assessment procedures, including internal controls. So we have some knowledge about risk assessment procedures. Based on that knowledge, you develop dash. You established overall audit. You haven't performed risk assessment procedures afresh. You are dependent upon the risk assessment procedures that you performed in the previous audit. Based on that, you established audit strategy, based on which you developed an audit plan. But during the course of performance of audit, you come to know about some new information, which you consider it as, which will increase the risk. So your previous assessment of risk is low because you know about some important aspects during the course of performance of audit. You revised your risk to dash. You revised your risk to high level. When you revise your risk to high level, what will you do? You will try to employ more and more personnel, and you will try to follow extended audit procedures, in which case there is a need to make changes to both dash as well as dash. There is a need to make changes to both dash as well as dash, to both the audit strategy as well as audit plan. Why you are making changes to audit strategy and audit plan? Because you came to know about certain important important information during the course of audit, which contradicts with your original knowledge. What is your original knowledge? We performed risk assessment procedures in the past. We performed evaluation of internal controls in the past. They are reliable. That is your original knowledge. But during the course of performance of audit, you came to know about some information which contradicts your original knowledge. In such case, what the auditor should do? Auditor should make changes to both dash as well as dash. Audit strategy and audit plan. So they are not constant. They need to be flexible. Read it as a result of unexpected events. Or changes in conditions, or audit evidence obtained from the results of audit procedures. The auditor may need to modify the overall audit strategy and audit plan, and thereby resulting planned nature, timing, and extent of further audit procedures based on revised consideration of assessed risks. This may be the case when information comes to the auditor attention that differs significantly from the information available when the auditor planned the audit procedures. For example, audit evidence obtained through the performance of substantive procedures may contradict audit evidence obtained through tests of controls. Your original knowledge is different. Now you came to know about certain events or transactions because of which you are of the opinion that dash has been increased. Risk has been increased. In that case, to mitigate that risk, what the auditor should do? Auditor should make changes to both dash and dash. Overall audit strategy and audit procedures. And documentation. Whatever you done is required to be documented as per SA 230, including changes in dash and dash, audit strategy and audit plan. The documentation of overall audit strategy is a record of key decisions considered necessary to properly plan the audit and to communicate significant matters to the engagement team, etc. And the only case where the term place where the term audit program is used is the only place where in the entire standard the term audit program is used is here. That's it. Except here, nowhere in the standard the term audit program has been used. But most of the lecturers focus more on audit program. I focus more not on audit program but on dash and dash. Audit strategy and audit plan, which are more important than audit program, which are more difficult to understand than audit program. You know very well about what is audit program. You can read it. Now, the auditor may use standard audit programs. This is the only point where The term Auditing program is used in the entire essay 300. Taking this point into account, they have given 2 questions for the term Auditing program. You can just refer to that and you will have an understanding of that. They are very easy to understand provided you are having knowledge of establishment of overall Auditing strategy and designing of an Auditing program. By this, I can take some another 30 minutes class to have a better explanation of the term Auditing program as well. But because of the things that I have already explained to you, it is already late, and I know very well that I am confident that you are able to understand Auditing program on your own. So I am leaving it to you, and by this I can say that I completed the discussion on allotted topics to me. I wish you all the best in your future endeavors. Be dedicated to your work and try to focus on the coming examinations.